See the next topic, foreign exchange exposure and risk management. Foreign exchange exposure and risk management chapter. So you need to understand, you have to understand the basics. If you understand basics, then this topic will be easy. Forex, foreign exchange exposure and risk management chapter. So what is the content in this chapter? Introduction, foreign exchange market, determinants of exchange rate, basics in Forex. Mainly you have to understand the basics in Forex. Forward contract, exchange rate selection. If it is receivable, payable, dealer problems, how to select an exchange rate, purchasing power parity theory, interest rate parity theory. And next, covered interest arbitrage. Covered interest arbitrage. Okay. And next, covered interest arbitrage. Next, hedging techniques, forward contract, leading and lagging, currency futures, currency options, currency swaps, money market hedging, fate of a forward contract, types of exposure and risk, Nostro, Ostro, and Loro account. Loro account. So these are the contents in Forex, but one by one let us understand these contents. First one, introduction. First, before approaching any chapter, first we should learn the objective. What is the learning objective in this chapter? So mainly in this chapter, we are going to do two things. One is hedging the foreign exchange risk. Hedging the foreign exchange risk. Second, arbitrage process. Nothing but making an arbitrage profit out of a market imperfection. So two concepts we are going to learn. First one, how to reduce the foreign exchange risk. Second one, how to make an arbitrage profit out of a market imperfection. So to understand the hedging techniques, first you should know what is the foreign exchange risk and you should learn basics. What is the foreign exchange risk? Foreign exchange risk means an uncertainty arising due to the foreign exchange fluctuation. Uncertainty in cash inflows or a cash outflows arising due to the foreign exchange fluctuations. First of all, what is the meaning of a risk? We already know that risk means possibility of occurrence of a loss or uncertainty. So generally organizations are exposed to two types of a risk, business risk, finance risk. Business risk means arising due to the nature of a business and cost structure. For example, okay, business risk, sometimes we call it as an operating risk. It depends upon a cost structure. So what is this cost structure? So cost structure means the amount of a fixed cost you use. Amount of a fixed cost you use. Example, if you are having a high amount of a fixed cost, then what happens? Automatically, your operating risk will increase. Okay. If you are having a low amount of a fixed cost, your operating risk will be less. So this concept we have already learned in CA interlevel. So, and also business risk depends upon the nature of a business. Example, if you are doing a corporate farming, if you have taken a land on a lease, 200 acres of a land on a lease, and you are doing a corporate farming, nothing but you have formed a company to do a farming, corporate farming, you are doing a farming at large scale. So that will have a high risk, high business risk. So when compared to what other businesses, if you see the food processing unit, the risk comparatively less. So business risk means risk arising due to the nature of a business and cost structure. Finance risk means risk arising due to the capital structure. If the amount of debt used in capital structure increases, then what happens? Your finance risk will also increase. Finance risk. So we already discussed about business risk and finance risk at CA interlevel in leverages chapter extensively. Okay. Now we are talking about what? Foreign exchange risk. Certain firms will get exposed to foreign exchange risk if the following conditions are satisfied. Generally, a business may face foreign exchange risk if the following conditions are satisfied. Okay. Example, payment or receipt is to be made in future. Next, billing is done in foreign currency. And if there is a cross-border transaction. So let me give an example. First, suppose Mamata Banerjee, she wanted to do CA final. Okay, let us assume she cleared CA inter. Now she wanted to do a CA final. She is interested in buying AFM class in BCCA. Okay, now tell me. Okay, and she asked me to give a 3 months credit. She agreed to pay money after 3 months. She agreed to pay money after 3 months. So today itself she is entering into a contract. She wants AFM class as on today, but she agreed to pay after 3 months. So first condition is satisfied. Payment or receipt is to be made in future. Yes or no? So I'm going to receive money in future. What is the second condition? If there is a cross-border transaction. Sir, Mamata Banerjee, she is in West Bengal, we are in Andhra Pradesh, so there is a cross-border transaction. Here the cross-border transaction means not the state, country. So there should be a cross-border transaction. Cross-border transaction. Okay. So next, second case. For suppose, okay, Pakistan Prime Minister Nawaz Sharif, he wanted to do a CA final. Okay. So he wanted to do a CA final. He became a refugee and he wanted to do a CA final. Now, he asked me to, give a credit. He agreed to pay money after 3 months. So payment or receipt is to be made in future. Okay. So cross-border transaction, India and Pakistan, it's a cross-border transaction. Okay. But he asked me to do a billing in Indian currency. He asked me to do a billing in Indian currency. Nothing but I am billing. I have raised my invoice in Indian currency. Okay, so AFM class price 11,999 rupees. Okay, he agreed to pay 11,999 rupees after 3 months. Now tell me, for me, is there a foreign exchange risk? Is there an uncertainty? Is there an uncertainty? So there is one uncertainty that is different. That is a default risk. Okay, so default risk means what? Nawaz Sharif may or may not repay 11,999 rupees at the end of 3 months. That is a default risk. That is a different thing. We are not going to discuss about default risk in this chapter. We are talking about a foreign exchange risk. So what is this foreign exchange risk? I will explain you. So here in this case, I will not have any foreign exchange risk. Why I will not have a foreign exchange risk? Simple. I am doing billing in Indian currency. My currency is Indian currency and I am doing billing in Indian currency. Even though there is a cross-border transaction, receipt is to be made in future, but still there is no foreign exchange risk because billing is done in Indian currency. Okay. For example, India and Iran. So India is importing goods from Iran and sometimes we make a payment in Indian rupees. Okay. That means what? So instead of paying in dollars or foreign currency, so we are making a payment in Indian rupees means our foreign currency risk will reduce. Okay. So and our foreign currency reserves will also improve, right? Foreign currency reserves will also improve. So that's why we have a good relations with Iran. Okay. So now next point is what? Okay. So in second case, in Mamata Banerjee case, there is no foreign currency risk. Why? There is no cross-border transaction. Nawaz Sharif case, receipt is in future, cross-border transaction, but billing is done in home currency. Okay. Now Donald Trump, he wanted to do a CA final. Donald Trump. So Donald Trump, he purchased AFM class on a condition that he agreed to pay after 3 months. Okay. And he requested to make a billing in dollars. That fellow, selfish fellow, he asked me to do a billing in dollars because he do not want foreign currency risk. He want to make a payment in dollars. Okay, he agreed to pay $110. He agreed to pay $110 after 3 months. Okay. So for him there is no foreign currency risk. But for me, there is a foreign currency risk. Why there is a foreign currency risk? He agreed to pay after 3 months and billing is done in foreign currency. My currency is Indian currency, but billing is done in dollars and there is a cross-border transaction. Okay, generally if there is cross-border transaction, then only there can be a billing in foreign currency. If there is no foreign cross-border transaction, why do we do billing in foreign currency? Yes or no? Okay. So what is the foreign currency risk? Now you can understand. So Donald Trump, he agreed to pay $110 after how many months? 3 months. Yes or no? Now, for me, there is a foreign currency risk for me. Uncertainty in cash inflow arising due to the foreign exchange fluctuation. Example, let us find out the dollar rate as on today. What is the dollar rate as on today? Dollar rate. 90? It is around 94 rupees. ₹94. So 93.03 Indian rupee. So this is the present dollar rate. Okay. So what is the price agreed? What is the price agreed? $110. For suppose if he is paying as on today, what is the amount I am going to receive? What is the amount I am going to receive? 110 into 93.03. 10,230 rupees. 10,230 rupees is the amount I am going to receive as on today. But he agreed to pay after 3 months. So tell me, in next 3 months, dollar price will remain same or what? No. Dollar price will not remain same. So dollar rate may increase or decrease. Yes or no? So dollar rate may increase or decrease. So what happens? For suppose, I expect the dollar rate to increase or decrease. Here I am the exporter of a service. Yes or no? I expect the dollar rate to increase. For example, I am imagining that dollar price might increase to 110. Actually not, I will not expect, but generally. Okay, for suppose. General exporter will expect an increase in foreign currency. So example, dollar rate increases to 110. What is the amount I am going to receive? 110 into 110. So 12,100 rupees. Okay. For suppose, if the dollar price decreases to 80 rupees. Okay, then what is the amount I am going to receive? 8,800. That means I don't know the exact inflow after 3 months. So my inflow after 3 months will be uncertain. Why there is an uncertainty? The uncertainty is because of a exchange rate fluctuation. So okay, this uncertainty in cash inflow or a cash outflow arising due to the exchange rate fluctuation is called as a foreign exchange risk. Okay. Example, X Limited exported goods worth $1 lakh, receivable after 3 months. Present exchange rate $1, 70 rupees. After 3 months, case 1, if $1 is equal to 80, cash flow 80 lakhs. If $1 is equal to 60 rupees, what is the cash inflow? 60 lakhs. So this fluctuation in the amount of a cash outflow, exported cash inflow. So cash inflow can be said to be foreign exchange risk. Okay, the strategies used to tackle these risks are called as hedging strategies. We use strategies to reduce the uncertainty in cash inflow or a cash outflow. Those strategies are called hedging strategies. Hedging strategies are as follows: forward contract, money market hedging, currency future, currency option, currency swap, leading, lagging, netting. Okay, in this chapter we're going to learn 2 points: how to reduce foreign currency risk, how to make a profit out of a foreign exchange market imperfection. So what is the foreign exchange market? Foreign exchange market is similar to a stock market. In stock market, we buy or sell share. Likewise, in foreign exchange market, it is a market in which individual, firm and bank buy and sell foreign currency. Foreign exchange market includes spot market, forward and futures market, currency options market. Currency options. So you already know about the futures, options and forward. We already discussed in derivatives chapter. Next, the foreign exchange market participants can be categorized as follows: hedger, speculator, arbitrator. So this concept we have already discussed in derivatives chapter. Hedger means a person who has an objective to reduce the risk. Speculator means a person who has an intention to make a profit by taking a risk. Arbitrator means a person who identifies the market imperfection and will always earn a profit without taking any risk. Okay. Next, determinants of exchange rate. So what are the determinants of exchange rate? Exchange rate determinants. So first factor, interest rate differential. Generally, so this concept we are going to discuss in interest rate parity theory. Interest rate parity theory. So for the timing, just remember the point. If the interest rate increases, the currency value decreases. Currency value decreases. If interest rate decreases, currency value increases. Okay. So from Mumbai to Ahmedabad bullet train project, Indian government has taken a loan from Japanese yen for a nominal interest rate. The interest rate is around 1% per annum. Okay. So the government has promoted like we got a loan at a cheaper interest rate. Okay. So the point is, generally in developed countries, interest rates are lesser than the interest rates of a developing country. Okay. So the interest rate in Japan is 1%. Now the question is, okay, so when you see the government promotion, so their argument is what? They have taken a bullet train loan from a Japanese government at a nominal interest rate, that is the credit goes to the government. But the point is, so this loan has to be repaid in a Japanese yen. This loan has to be repaid in Japanese yen with interest. Yes or no? So generally if interest rates are low, the currency value increases. So that means in future what is going to happen? The Japanese yen value is going to increase in the future. That means in future, after 10 years or 15 years, Indian government has to repay the loan with interest in Japanese yen. By the time it repays the loan, what happens to the Japanese yen value? Japanese yen value increases. We are saving interest, no doubt in that. But at the same time, we have to pay an extra amount in the form of increase in currency value. So what are the determinants? Interest rate increases, currency value decreases. Interest rate decreases, currency value increases. Likewise, inflation rate. If inflation rate increases, currency value decreases. If inflation rate decreases, currency value increases. So that's why, so the RBI, central bank of any country, objective is to control the inflation and interest rates and the government policies. And the government policies will also determine the exchange rate. Government policies. Example, the government, so in the year 2015, it has brought a good policy to control the exchange rates, especially the dollar rate. To increase the rupee value in the international market, it wanted to what? So bring one policy. So it has brought one policy, that is the gold scheme, gold bond scheme. What is a gold bond scheme? One of the factors which is influencing the dollar and rupee rate is gold imports. Okay, so India is one of the largest importer of gold. Okay, so why we are importing the gold? So because many households are purchasing the gold, and they are purchasing the gold, and instead of wearing the ornaments, what the Indian government has observed is, instead of wearing the ornaments, what they are doing is they are putting these ornaments in locker, bank locker. That means, so everyone, so okay, whoever putting the ornaments in locker, they have to pay locker charges. They have to pay locker charges. So that means all the gold, so most of the gold is put into a lockers in the bank. It is of a no use, yes or no? It is kept idle. So that's why the government has came up with a gold bond scheme. What is this gold bond scheme? Instead of putting a gold in locker, okay, give this gold to the government and the government will give you a gold bond. So it's like a debenture. You deposit gold to the government. If you deposit the gold to the government, government will give a bond. What is this bond? This bond is redeemable after a certain period of a time. Let us example, gold bond is issued with a 5 years maturity. What is this meaning? 5 years maturity. After 5 years, you can redeem the gold bond. What do you get back? Again, you can take back your gold. For the next 5 years, you can earn interest, and at the end of 5 years, you can take back the gold. Okay. Now, what the government is going to do with the gold? Simple. The government will take the gold from the public, issue the gold bond. Okay. Instead of importing the gold from other countries, instead of importing the gold, what the government is going to do is, government is going to circulate this gold taken from the public in the market again. Are you able to understand my point? Instead of importing from the foreign countries, government will circulate this gold again in the market. So whenever the maturity date comes, public ask for the gold back. So government will take back from the market and will give back it to the public. Are you getting my point? Give back to the public. So this is the point. Now, my point is, okay, you're taking a gold, right? So, but this scheme has failed. Why the scheme has failed? Because government is taking ornament from the public and will give back the gold bar. Gold bar. So that means public, as a public, what is the public thought? I will be giving an ornament to the government, and at the end of 5 years, I will take back the gold bar. Again, they have to pay making charges. Again, they have to pay making charges. So that's why this scheme has got failed. Who will bear the making charges? Are you getting my point? So that's why the scheme failed. But the government policies definitely what will affect? Will affect exchange rate. Yes or no? Example, BRICS. In BRICS summit, Russian government has proposed proposed one common currency for BRICS nation. Instead of using the dollar, instead of what increasing to decrease the demand of a dollar in the international market, they proposed a new currency for BRICS nation. Okay, in BRICS summit. So that will obviously what affect the foreign exchange rates. Next, the market expectations. Market expectations, investment opportunities. If there are investment opportunities in a particular country, then automatically what happens? The currency value will increase. Speculations, obviously speculations will affect what? Exchange rates. Now let us come to the basics. So what are the basics? Home currency. First of all, you should know what is home currency. Country's own currency. Country's own currency is known as a home currency. Home currency for India, rupee. Home currency for India, rupee. Okay. Rupee spelling, I'll check. Okay. So India, rupee. Clear? Foreign currency for any country. Currency other than home currency is called foreign currency. Foreign currency for India, dollar, euro, pound, Hong Kong dollar, etc. All these are foreign currencies to India. Clear? Next, exchange rates. Whatever the exchange rates provided below are as on 17 January 2025. Exchange rate means what? It refers to the rate at which one currency can be exchanged for another currency. It is nothing but price of one currency in terms of another currency. For example, pen costs 50 rupees, yes or no? Pen costs 50 rupees. Nothing but price of a pen is equal to 50 rupees. Okay, likewise, price of dollar 90.71. Price of a dollar 90.71 rupees. That means if you want to buy $1, what is the amount you are going to spend? 90.71 rupees. Okay. So price of 90.71 rupees is equal to $1. That also we can say. Okay. Clear? Exchange rate means the rate at which one currency can be exchanged for another currency. In this we have a two again, spot exchange rate. Spot exchange rate. It is the rate at which one currency is exchanged for another currency for immediate delivery. Example, so this 90.71 is the rate as on 17 January 2025. So this 90.71 rupees, $1, what is this? So this is as on 17th January. That means on 17th January, if you want to buy the dollar, what is the rate applicable? 90.71 rupees is the rate applicable. The spot exchange rate is for immediate delivery. Spot exchange rate is for immediate delivery. Clear? Forward exchange rate. What is this forward exchange rate? It is the exchange rate agreed today for the exchange of a currencies at a specified future date. Example, USD INR 3 months forward 91.449, 91.469. Here two quotes are given. What are these? The quote given in the examination can be one-way quote or a two-way quote. But practically you will find two-way quote. Two-way quote. So what is this two-way quote? This 91.449, it is a bid rate. 91.469 is ask rate. Bid rate means buying rate for a dealer, Forex dealer. Forex dealer. Ask rate means a selling rate for the dealer. Selling rate for the dealer, not for the customer. So these are the rate given from the perception of the dealer. So bid rate, buying rate for dealer, ask rate, selling rate for dealer. So right side, ask rate, left side, bid rate. Selling rate, always greater than buying rate. That is a simple common sense. Sometimes ask rate may be given on the left side. Ask rate may be given on the left side. Bid rate may be given on the right side. But most of the cases, bid is given on left side, ask will be given on the right side. So you should understand the difference. I mean, you should understand the logic. The logic is ask rate will always be greater than bid rate. Any business person, the business basic principle is what? We buy at a lower rate, sell at a higher rate. So that's a foreign exchange dealer, he is doing a business with foreign exchange, right? So that's why he sell at a higher rate, buy at a lower rate. So ask rate will always be greater than bid rate. Clear? So this is a foreign exchange rate. So 3 months forward rate. What is the 3 months forward rate? 3 months forward rate means from 17th January, If you are entering into a contract to buy or a sell foreign currency after 3 months, then this rate is applicable. Forward rate. So these rates are not applicable for immediate delivery. These rates are applicable for delivery after 3 months. After 3 months. Are you getting my point? Okay. Next, European code. These are not that important. European code. It is a quote. It is quoted in amount of foreign currency per US dollar. $1 US is equal how many rupees? $1 is equal how many euros? $1 is equal how many Canadian dollars? So then it is called as a European quote. Next, American quote. American quote means it is quoted in amount of US dollar per unit of foreign currency. 1 rupee is equal to how many dollars? 1 Hong Kong dollar is equal to how many dollars? 1 Australian dollar is equal to how many dollars? If the quote is given in the amount of US dollar per unit of foreign currency is equal to is American quote. Okay, clear? So now, one-way quote. One-way quote is an exchange rate in which only one rate is quoted for a currency. In this case, ask rate and bid rate are same. Example, $1 is equal to 90.71. What is the meaning of this $1 90.71? $1 90.71. First, suppose if I want to buy $1, what is the rate applicable? 90.71. If I want to sell $1, what is the rate applicable? 90.71. Clear? Okay. Done. So this is one-way quote. So direct quote. You should understand direct quote and indirect quote. What is this direct quote? Direct quote. Exchange rate expressed as the amount of domestic currency required to buy 1 unit of foreign currency. Nothing but in simple words, it is a quote per unit of foreign currency. Quote per unit of foreign currency. Okay. Example, this 93.03. What is this 93.03? It is a direct quote for Indians. It is a quote per unit of foreign currency. What is the foreign currency? Dollar. So here the quote is per $1. Per $1. It is a direct quote for Indians. Okay. Clear? So euro to INR. 1 euro is equal to 107.29. This is also direct quote. This is also what? Direct quote. Pound to INR 122.71. So this is also what? Direct quote. So 1 pound is equal to 122.71 Indian rupees. It is also a direct quote. Clear? Pound to INR. Okay? Clear? So Canadian dollar to INR. What is the Canadian dollar? 1 Canadian dollar is equal to 66.84. All these are direct quote for Indians. What about others? For others it is indirect quote. For others it is indirect quote because quote is given per unit of home currency for them. Clear? So for us it is direct quote, but others it is indirect quote. So what is indirect quote? Indirect quote means quote given per unit of home currency. Example, 1 rupee is equal to 0.011 USD. 1 rupee is equal to. 1 rupee is equal to how many dollars? 1 rupee is equal to how many Hong Kong dollars? 1 rupee is equal to how many Canadian dollars? So this is a indirect quote. Indirect quote. Are you getting my point? Expressed as a percentage. Exchange rate expressed as the amount of foreign currency required to buy 1 unit of a domestic currency. Quote per unit of home currency. 1 rupee is equal to $0.011. So this is what? Indirect quote. Are you able to understand this? Okay. How do we get this indirect quote? Simple. $1 is equal to 90.71. Now we need 1 rupee is equal to how much? Yes or no? You already know cross multiplication. 1 divided by 90.71. Yes or no? Nothing but how do we convert the direct quote into indirect quote? Conversion of a direct quote into indirect quote. How do we convert the direct quote into indirect quote? Simple. Direct quote is equal to 1 divided by indirect quote, or indirect quote is equal to 1 divided by direct quote. Example, in this case, indirect quote is equal to 1 divided by 90.71. Yes or no? That is based on the logic. For rupees 90.71, $1. For 1 rupee, how many dollars? So indirect quote is equal to 1 divided by direct quote. What about direct quote? Direct quote is equal to 1 divided by indirect quote. So nothing but $1 is equal to 1 divided by 0.011. You will get 90.71. Clear? Now comes to two-way quote. What is a two-way quote? Two-way quote is an exchange rate in which both buying and selling rates are quoted. For a currency. Ask rate and bid rate are different. $1 is equal to 91.449, 91.469. These are the two-way quotes. What are these two-way quotes? Left side, that means the lower amount is bid rate, higher amount is ask rate. Yes or no? So lower amount buying rate, higher amount selling rate. For whom? Dealer. For the dealer. So let us understand which rate we have to apply. So generally in Forex, you will find difficulty in rate selection. First you should understand these basics. If you are strong at basics, then advanced questions you can solve it very easily, because already you know futures and options. You have learned in derivatives, right? But you should know how to select the rate. Example, for suppose I'm an exporter. I'm the exporter. I'm selling my AFM class to Donald Trump. Now the Donald Trump is paying $150. $150. So tell me, which rate is applicable for me? Which rate is applicable for conversion? What is the rate applicable for conversion? Simple. Now I'm having $150. I have received from Donald Trump. Yes or no? $150. I will sell this $150 to foreign exchange dealer. I will sell. Yes or no? I am selling dollar to Forex dealer, means dealer has to buy. Okay, we should think from the perspective of a dealer. Dealer has to buy. What the dealer has to do? Because always the quotes are given from the perspective of a dealer. So that's why first from customer to dealer perspective. So I am selling the dollar, but what about the dealer? Dealer is buying the dollar. That means what is the rate applicable? Bid rate. So dealer will buy $1 at the rate of 91.449. That means what is the amount I am going to receive? I am going to receive $150 into 91.449. Okay, 31,000, 13,717. 13,717 is the amount receivable by me. Clear? Okay, done. Okay. Second scenario. For suppose I am taking class from Donald Trump, how to harass the world. Okay. So I want to take a class from Donald Trump, how to harass the world. So now I agree to pay $150. I agree to pay $150. So now Donald Trump is a customer. Okay. Donald Trump is a customer there in US. I am the customer. So I have to pay $150. I have to pay $150. That means to pay $150, I have to buy dollar. From whom? The dealer. That means dealer has to sell. Now what is the rate applicable? Ask rate. 91.469. So what is the outflow for me? 150 into 91.469. 13720. Clear? 13720. That means for exporter, what is the inflow? 13713. For importer, what is the outflow? 13720. Nothing but the difference amount is the spread. The difference between the ask rate and bid rate is called as a spread. What is the spread? Spread means profit to the profit to the banker, dealer. Profit to the dealer, banker. Are you getting my point? Clear? Bid rate. It is the buying rate of a currency for the dealer, and selling rate of a currency for the customer. Ask rate means it is the selling rate of a currency for the dealer and buying rate of a currency for the customer. So you always start thinking from the customer and then to dealer. First customer, first you should check what the customer is doing. If a customer is buying means dealer has to sell. The applicable rate is ask rate. Customer is selling means dealer has to buy. The applicable rate is bid rate. Okay? Clear? 91.449, 91.469. Bid rate, buying rate of a dealer, selling rate of a dealer. Clear? Always the ask rate is greater than bid rate. Let us take an example. Understand with an example. X Limited imported a machine worth $1 crore. Calculate cash outflow in rupees. Okay. So calculate cash outflow in rupees. Now the point is imported a machinery payable. Imported a machinery means what? We have to pay $1 crore. We have to pay $1 crore means customer has to buy the dollar. Customer buy dollar means bank sell dollar. What is the rate applicable? The relevant rate is ask rate. X Limited has to purchase foreign currency. Bank has to sell foreign currency. The relevant rate is ask rate. What is the rate applicable? 71. So rupee outflow is equal to $1 crore into 71. 71 lakhs. So 71 crores. Clear? Example 2. A Y Limited exported goods worth $1 crore. Exported goods. Exported goods means we receive $1. We receive $1 crore means what? Sell foreign currency. Y Limited sell foreign currency. That means bank has to buy foreign currency. The relevant rate is bid rate. What is the inflow? 1 crore into 70. That is 70 lakhs. Clear? Is it clear? Now, when two-way quote is given, how do we convert? How do we convert? You already know conversion. How do we convert? Indirect quote is equal to 1 divided by direct quote. Indirect quote is equal to 1 divided by direct quote. That means 1 divided by 70, 1 divided by 71. So what is 1 divided by 70? Tell me the number. 0.01428. 1 divided by 71. 0.01408. Nothing but $1 is equal to rupees 71. But here it is indirect quote. 1 rupee is equal to 0.01428 hyphen 0.01408 dollar. But here there is a mistake. What is the mistake? If you observe these numbers, the right side number 0.01408 is less than 0.01428. When two-way quote is given, while converting the direct quote into indirect quote or indirect quote to direct quote, be careful. Why you have to be careful? Because if I do 1 divided by 70, 1 divided by 71, the right side number is becoming lesser than the left side number. So one thumb rule is what? Ask rate is always greater than bid rate. But here if you see the ask rate on the right is less than the bid rate on the left, which is not at all correct. That means nothing but while conversion, be careful. The left side bid rate should be always less than, bid rate should always be less than ask rate. Yes or no? So that means we should take 1 divided by 70 or 1 divided by 71 for bid rate. 1 divided by 71, because in the denominator the number has to be high. If in the denominator the number is high, the value will decrease. Yes or no? So that's why bid rate of a indirect quote is equal to, bid rate of a indirect quote is equal to 1 divided by ask rate of direct quote. That means in this case 1 divided by 71. Clear? Ask rate of indirect quote is equal to 1 divided by bid rate of direct quote. That means 1 divided by 70. So nothing but 0.01408 is bid rate and this is ask rate. So this has to be come on the right. Clear? Okay, let's understand with an example. The given quote 1 rupee is equal to dollar 0.01318, 0.01398. Arjun Limited imported a machine worth dollar 1 crore. Calculate rupee outflow. First understand. The quotes given, direct quote or indirect quote? The quotes given are direct quote or indirect quote? The quote given is indirect quote because it is given, quote given per 1 rupee, Indian rupee. Quote given per 1 Indian rupee. Arjun Limited imported a machine worth $1 crore. Calculate rupee outflow. Okay. So before moving on to this final answer, the quote given is what? The quote given is per rupee, indirect quote. So let us convert this to quote per dollar. Quote per dollar. So to convert this quote per rupee to the quote per dollar, so be careful. Bit rate is equal to 1 divided by bit rate of a dollar is equal to one divided by ask rate of a rupee. Okay, so this direct quote and indirect quote can leave those terminology words. So bit rate of one currency is equal to 1 divided by ask rate of other currency. Okay, and next ask rate of a dollar is equal to 1 divided by bit rate of. Okay, so nothing but what is the quote conversion? 1 divided by 0.01398. It is the bit rate. 1 divided by 0.01318 ask rate. Okay, so what is the answer? 1 divided by 0.01398. 70,531. 75 0.872. So this is how we convert the indirect quote into direct quote. Be careful. Now let us understand this example. So they are not asking you to convert the indirect quote into a direct quote. This example is for finding out the rupee outflow. We imported a machine which is worth $1 crore. So this example is for understanding the rate selection. So tell me, Arjun Limited imported 1 crore worth machinery, yes or no? Okay, that means Arjun Limited should purchase dollar. First, let us understand the answer with dollar. Okay, Arjun Limited should purchase the dollar. That means bank sell dollar. Bank sell dollar. Okay, so that means what is the rate applicable? Ask rate of a dollar. What is the rate applicable? Ask rate of a dollar. Relevant rate is ask rate of a dollar. Understand, relevant rate is ask rate of a dollar. So basics very important. You should understand the rate selection. You should know how to convert the quote given per one currency into a quote given per quote for another currency. Okay, so understand here. Arjun Limited has to purchase the dollar. That means bank has to sell the dollar. That means what is the relevant rate? Relevant rate is ask rate of a dollar. So tell me, in the question, ask rate of a dollar is given or not? Ask rate of a dollar is not given. But how do I get ask rate of a dollar? Ask rate of a dollar is equal to 1 divided by bid rate of a rupee. Yes or no? That means what is my rupee outflow? Rupee outflow is equal to 1 crore into 1 divided by 0.01318. So this will be my outflow. Okay, this is one way of thinking. So here we are thinking from the perspective of a dollar. I have to pay dollar, that means I have to buy, bank has to sell. The relevant rate is ask rate of a dollar. But ask rate of a dollar is not given in the question. But how do I get ask rate of a dollar? 1 divided by bid rate of a rupee. So that is what I have done. Rupee outflow is equal to 1 crore divided by 0.01318. Clear? Done. Now, let us think from the perspective of a rupee. I have to pay dollar, yes or no? That means buy dollar. Buy dollar means sell rupee. How do I buy dollar? By selling rupee. By selling rupee. Okay, to buy dollar I have to sell rupee because I'm in India. Okay. So Arjun Limited sell rupee means bank buy rupee. So that means what is the relevant rate? Relevant rate bid rate of a rupee. Relevant rate bid rate of a rupee. So bid rate of a rupee is already given. Bid rate of a rupee is available, yes or no? What is the bid rate of a rupee? 1 rupee is equal to 0.01318 dollar. Now my question is, for 1 crore dollar, how many rupees will be my outflow? Yes or no? So that means what should be the calculation? 1 crore divided by 0.01318. Then also you will get the same answer. Clear? Nothing but. So when to multiply, when to divide? That is simple. Here my payment is in dollar. The quote is given in rupee. What is the relevant rate bid rate of a rupee? Payment is in dollar. Quote is rupee. Then I should divide. But payment is in dollar. Receipt is in dollar. And my quote is also in dollar. Then I can multiply. Example. Here I have calculated what? Bid rate and ask rate of a dollar. Bid rate and ask rate of a dollar. Yes or no? If you see this, purchase dollar. Arjun Limited has to purchase the dollar. That means bank has to sell the dollar. Relevant rate. Ask rate of a dollar. What is the ask rate of a dollar? 75.872. Okay. Ask rate of a dollar is 75.872. What is the payment? 1 crore dollar. Payment is in dollar. Quote is also in dollar. So then simple 1 crore into 75.872. Multiply. You will get answer 75 crore 87 lakh something. Clear? But payment is in dollar, quote is given per rupee. Then what? Divide. Example, if you come from the rupee perspective, dollar buy, that means rupee sell. You are selling rupee, that means bank buy. Bank has to buy. What is the relevant rate? Bid rate of a rupee. So bid rate of a rupee is already available. What is the bid rate of a rupee? 0.01318. So I cannot multiply 1 crore and 0.01318. Payment is in dollar, quote is given per rupee. So that's why what? Divide. So 1 crore divided by 0.01318. Then also you will get the same answer, that is 75 crore 87 lakh 25,341. Now, example 2. Exported goods worth 1 crore dollar. Exported goods worth 1 crore dollar means, first from dollar perspective, customer exported means receivable, yes or no? So dollar sell, customer dollar sell, bank dollar buy. What is the relevant rate? Bid rate of a dollar. How do I get bid rate of a dollar? 1 divided by ask rate. Nothing but 71.531. 71.531. So the answer is 1 crore into 71.531. So answer is 71 crore 53 lakh. Clear? Okay. So let us understand from the rupee perspective. Dollar sell means rupee buy. That means bank has to sell rupee. What is the relevant rate? Ask rate of a rupee. So ask rate of rupee is already available, 0.01398. So rupee inflow is equal to 1 crore divided by 0.01398. Again you will get same answer. Here receivable is in dollar, quote is also available in dollar. That's why multiply. Both are in same currency. Receivable dollar, quote is also per dollar, so multiply. But in second case, receivable in dollar, quote is per rupee, then in that case divide. So the answer is same. Clear? Next. The given quote 1 rupee is equal to, okay, exposure amount 1 crore, Abhimanyu. So this is from the perspective of a dollar. So these are the examples from the perspective of a dollar. So exposure amount 1 crore dollar, Abhimanyu purchase dollar. Okay, we are talking about what? Importer. Importer has to pay 1 crore dollar. That means Abhimanyu purchase dollar. bank, sell dollar, relevant rate, ask rate of a dollar. How do I get ask rate of dollar? 1 divided by bid rate of a rupee. Clear? Done. Next, Devaki, exposure, receivable, $1 crore receivable. $1 crore receivable means Devaki will sell dollar, bank purchase dollar, relevant rate, bid rate of a dollar. How do I get bid rate of a dollar? 1 divided by ask rate of a rupee. Clear? Done. So, quotations are always given from the viewpoint of a bank. But usually questions in exams are framed from the point of view of a customer. These are given from the point of view of a customer. Okay? Clear? Navina, is it clear? Now, the cross rate. Cross rate means exchange rate between two currencies calculated using a common currency. It is applicable when any rate is missing in the question. Example, $1 is equal to 7.5880, 7.5920 Hong Kong dollar. Okay? And $1 is equal to 42.7. Navina, I am audible? Navina? Okay. So $1 is equal to rupees 42.7, 42.85. Visakha Limited payable is equal to Hong Kong dollar, 1 crore. Calculate rupee outflow. Calculate rupee outflow. What is the payment? 1 crore dollar, Hong Kong dollar. What is the rupee? So they are asking you to find out the rupee outflow. So understand. First of all, this is written as Hong Kong dollar divided by dollar. $1 is equal to how many Hong Kong dollar is the quote given. So for our convenience, we write it as a HKD divided by dollar. If I write HKD divided by dollar means, what does it mean? It means $1 is equal to how many Hong Kong dollars? 7.5880 minus 7.5920. Second one, I will write it as, I will be writing it as rupee by dollar, 42.7 minus 42.85. 42.7 minus 42.85. Clear? Done. Hong Kong dollar divided by dollar, rupee by dollar. So this I am writing for my convenience. But what is my payment? My payment is Hong Kong dollar. How can I purchase Hong Kong dollar? I am living in India. By spending rupee, I have to buy Hong Kong dollar. That means I want a quote between rupee and Hong Kong dollar. I want a quote between what? Rupee and Hong Kong dollar. I have to buy the dollar. I have to buy Hong Kong dollar. HKD. I want HKD. I have to buy HKD means what? Bank has to sell HKD. Bank has to sell HKD. So the relevant rate is ask rate of a HKD against rupee. I want ask rate of HKD against rupee, not against dollar. Against dollar is available. But I want ask rate of HKD against rupee. Nothing but I want rupee by HKD. That too what? Ask rate. So that too I want ask rate. Clear? Okay. So tell me the quotes given. HKD divided by dollar. HKD divided by dollar is equal to 7.5880 hyphen 7.5920. Next. Rupee by dollar is equal to 42.7 hyphen 42.85. Okay. So here payment is 1 crore Hong Kong dollar. Yes or no? Against rupee. Okay, payment 1 crore Hong Kong dollar. That means customer buy Hong Kong dollar. That means dealer sell Hong Kong dollar. Customer buy Hong Kong dollar, dealer sell Hong Kong dollar. That means what is the relevant rate? Ask rate of Hong Kong dollar against rupee. So try to understand this rate selection is very, very important. If you understand the rate selection, then okay, you will be able to understand the advanced questions easily. So that means what do I want? Rupee divided by HKD. Clear? Okay. First of all, let us find out the rupee divided by HKD. Okay. I want rupee by HKD. Rupee by HKD. How do I get rupee by HKD? I have a two quotes available. First one is HKD divided by dollar. Second one is rupee by dollar. If I multiply two quotes directly, if I multiply the two quotes directly as it is, then I will get HKD into rupee divided by dollar square. I will get a meaningless quote. $1 square is equal to how many HKD into rupee? Yes or no? So I cannot multiply as it is. Okay, I want rupee by HKD means rupee by HKD. I want rupee in the numerator, HKD in the denominator, HKD in the denominator. So that means first one, I should change the first quote. Instead of taking HKD by dollar directly, let us change the first one. Instead of writing HKD divided by dollar, write it as dollar by HKD. Second one, I need not change because I want rupee in the numerator. If you write like this, then automatically what dollar will get cancelled. What is left? Rupee by dollar. Okay. So this is how I get quote between rupee and HKD, Hong Kong dollar. So tell me the bit rate of, I want bit rate of a dollar divided by HKD. But bit rate of a dollar by HKD is not given. I want bit rate of a dollar by HKD. But bit rate of a dollar by HKD is not given. HKD by dollar is given. So how do I get bit rate of a dollar by HKD? 1 divided by ask rate of HKD by dollar. That means 1 divided by 7.5920 into, I want bit rate of a rupee by dollar. Bit rate of a rupee by dollar is given. What is the bit rate of a rupee by dollar? 42.7. Clear? Hyphen. Let us find out the ask rate. Now I want ask rate of a dollar by HKD. Ask rate of a dollar by HKD is not given. How do I get ask rate of a dollar by HKD? 1 divided by bit rate of HKD by dollar. So that means 1 divided by 7.5880 into 42.85. The answer is 5.624 hyphen 5.64771. 5.624 hyphen 5.6471. This is the bid rate and ask rate of rupee by HKD. So for me, what is the rate applicable? Ask rate of a HKD. That means 5.6471. What is the payment? 1 crore into 5.624. So 5.6471. Answer is 5,64,71,000. Clear? See the presentation here. Visakha Limited payable 1 crore HKD. Calculate rupee outflow. The required quote is rupee by HKD. Yes or no? How do I get rupee by HKD? I want HKD in the denominator. So that's why First quote I have to change, yes or no? Actually the quote available is HKD by dollar, but I should write it as a dollar by HKD into second one as it is rupee by dollar. Clear? Now the bid rate of HKD is equal to bid rate of a HKD, nothing but dollar by HKD is equal to 1 divided by ask rate of a dollar, 1 divided by 7.5920, 0.1317 into 42.7, 5.624. Nothing but 1 divided by 7.5920 into 42.7. Clear? This is what I have written here. Next, ask rate. Ask rate of HKD is equal to 1 divided by bid rate of dollar, that is 1 divided by 7.5880 into 42.85, 5.647. Clear? So the answer is Visakha Limited buy HKD. That means bank sell HKD. So what is outflow? 5 crore 64 lakh 71,000. Next, Chitra Limited receivable 1 crore HKD. Okay, receivable. Receivable means customer sell, bank buy. So the relevant rate is bid rate. What is the bid rate? 5.624. So rupee inflow is equal to 5 crore 62 lakh 40,000. Clear? The difference between ask rate and bid rate is a spread. It is a profit to the banker. Spread is equal to ask rate minus bid rate. But if they ask you to find out the percentage, then spread percentage is equal to ask rate minus bid rate divided by bid rate. Or in the denominator you can take ask rate. Clear? Done. Exchange margin means what? It is if it is the profit added by a banker or a dealer to the interbank exchange rate when quoting rates to the customer. It is in addition to the spread. It is a margin, exchange margin. You are taking the service from the bank, right? You are taking the service from the banker, so that's why the bank will collect an exchange margin. It is like a service charge. Example, ask rate of a bank, $1 is equal to rupees 50. Bank charges 0.1% margin. So that means bank will collect 50 plus 0.1%, 50.05. So bank will sell at 50.05. But if it is a bid rate, be careful. If it is a bid rate, exchange margin should be reduced from the bid rate. For example, 50 is the bid rate. 50 minus 0.1%. 50 minus 0.1%. 49.95. That means bank will buy $1 at the rate of 49.95. Bank will pay the customer only 49.95 for each dollar. So be careful, exchange margin is added to the ask rate, reduced from the bid rate. Clear? So forward premium or a discount. Forward premium or a discount. So forward premium or discount means if a forward rate is higher than the spot rate, then forward rate is said to be quoted at premium. If a forward rate is less than the spot rate, that means okay, it is said to be quoted at discount. How do we calculate the forward premium or a discount? Simple. Forward rate minus spot rate divided by spot rate into 100 into 12 divided by n. If a 3 months forward rate is given, 12 divided by 3. If a 2 months forward rate is given, 12 divided by 2. Nothing but we are annualizing the forward premium or a discount. So how do we get forward premium or a discount per annum? Forward rate minus spot rate divided by spot rate into 100 into 12 divided by n. Okay. So positive sign indicates premium, negative indicates what? Discount. Let us see the example. What is the spot rate? $1.50. Forward rate 12 months 55. That means forward rate is greater than spot rate. That means it is quoted at premium. Dollar is at premium, but rupee is at discount. Dollar is quoted at premium. How do I calculate the percentage? 55 minus 50 divided by 50 into 100 into 12 divided by 12. So premium is equal to 10%. Okay, clear? So that means rupee. How do I calculate the rupee discount? Rupee is quoted at discount. How do I calculate the rupee value? Forward rate minus spot rate. Okay, divided by. So this is not required. This is actually not. Okay. So premium is equal to 10%. Premium is equal to what? 10%. Done. Forward rate minus spot rate divided by spot rate into 100 into 12 divided by n. Clear? Okay. So if you want to find out the rupee discount, then what? 1 divided by 50. 1 divided by 50 is the spot rate of a rupee. 0.022. 1 divided by 55. 0.0181. Now, how do I calculate? 0.0181 minus 0.02 divided by what? Forward rate minus spot rate divided by spot rate into 100 into 12 divided by 12. 9.5%. 9.5% is the answer. Clear? Done. Next, forward contract. We already told forward contract. Forward contract means what? It is a contract entered today. It is a binding agreement in which one party agrees to buy, another party agrees to sell a specified amount of one currency against another currency at a predetermined exchange rate on a future date. Forward rates may be given in two types. In questions, forward rate given in two types: outright forward rate, spot rate with swap points, spot rate with swap points. Okay, if a swap points are ascending, forward rates are at a premium, so add the swap points to the spot rate. Swap points are descending, then forward rate is at discount, reduce the swap points from spot rate. So nothing but they will give a spot rate and swap points. If a swap points are ascending, add to the spot rate. Ascending means what? Left hand side is less than right hand side. Sir, why sir? So why we should add when they are in ascending? So when they are in ascending order, why we should add? Simple. Ask rate should always be greater than bid rate. Instead of adding, if you are reducing from the spot rate, what happens? Ask rate may become a lesser than bid rate. So that's why always add. Clear? Are you able to understand? So next, exchange rate selection. Exchange rate selection. Exchange rate selection. This I will discuss in the next session. So for the timing, are you able to understand what is the forward rate and spot rate? Forward rate may given outright. Outright they may given forward rate, or else spot rate and swap points. Spot rate and swap points. If swap points are ascending, add. If they are descending, minus. Clear? Done. Navina. Let us start the practical question. Smart one. Following are the details of cash inflows and outflows in the foreign currency denominations of an MNP company, an export firm, which have no subsidiaries, which have no foreign subsidiaries. Required, calculate net exposure. Is any of the exposure offsetting? So this is a basic question, different kind of a question. Calculate the net exposure. Here, so Indian export firm, it has an inflows and outflow. US dollar inflow 4 crores, outflow 2 crores. What is the net amount? Net amount is equal to 2 crores. Net amount 2 crores. Yes or no? What is the spot rate? 48.01. Forward rate is 48.82. That means immediately, if you are going to receive the 2 crores, the rate applicable is 48.01. But whereas if you are going to receive in the future, what is the rate applicable? 48.82. So the exposure is equal to 2 crores into spread. What is the spread? Forward rate minus spot rate. 0.81. So 2 crores into 0.81. 1.62 crores. Nothing but 16.2 millions. Okay. Next. 2 lakhs 80,000. 2 lakhs and what? 80,000. 7.45, 8.12. 2 lakhs minus 80,000. 2 lakhs minus 80,000, 1 lakh 20,000. Sorry, 1 crore 20,000. 1 crore 20,000 into spread. What is the spread? 8.12 minus 7.45. 0.65. So the answer is 8.04. Clear? Next, 3 crores minus 2 crores. 1 crore. 1 crore into spread. 75.98 minus 75.57. 0.41. So 4.1. Next, minus 10, nothing but minus 1 crore. Here the exposure is offsetting. Why the exposure is offsetting? Because forward rate is less than spot rate, negative, and your net amount is not outflow, so not inflow. Net amount is also outflow. Net amount is outflow, and the forward rate is greater than spot rate. It is getting offset. And what is your overall net exposure? 8 million. Okay. So the exposure of Japanese Yen position is being offset by a better forward rate. Clear? So this is a different kind of a question. Next, see the super one. This is a dealer question. Dealer question, okay? You as a foreign exchange dealer of your bank are informed that your bank has sold a TT on Copenhagen for Danish kroner, rupees, 10 lakhs, 10 crores. So 10 lakhs DKK, not rupees, 10 crore DKK at the rate of 1 Danish kroner, rupees 6.515. Okay. You are a foreign exchange dealer and has sold 10 lakh Danish kroner for rupees 6.515. You are required to cover the transaction either in London or New York. The rates on that date are as under. What are the rates on that date? Mumbai to London, Mumbai to New York, London to Copenhagen, New York to Copenhagen. In which market will you cover the transaction, London or a New York? And what will be the exchange profit or a loss on the transaction? Ignore brokerages. Ignore what? Brokerages. Let us see this question. You are the dealer, yes or no? You are the dealer. Super one. So this is a dealer question. Be careful while selecting the rate. Dealer. Dealer originally what? Sold DKK at the rate of rupees 6.515. Okay. So dealer agreed to sell. Dealer agreed to sell 1 DKK at the rate of 6.515 or sold. Yes or no? So to cover, understand what is to cover. He has to cover the transaction. Cover the transaction means what? One side he is selling DKK. That means he has to buy from the other dealer. He has to buy from the other dealer. So to cover, he has to buy from other dealer. That means this dealer has become customer. This dealer has become customer, yes or no? So other dealer has to sell DKK against rupee. So that means what is the relevant rate? The relevant rate is ask rate of DKK against rupee. Nothing but rupee by DKK is required. Clear? Why rupee by DKK is required? Because we sold DKK at the rate of rupees 6.515. What is the question? What will be the exchange profit or a loss? I have to find out the exchange profit or a loss. Okay. In which market will you cover the transaction? One is London. Second one is New York. First, let us start with London market. So tell me the given codes. What is the given code? Mumbai, London, 74.3, 74.32. What is the London currency? Pound. So what is given here? Rupee by pound. Rupee by pound. What is the rupee by pound here? Rupee by pound is equal to 74.3, 74.32. What is the next one? Mumbai, New York. Mumbai, New York means rupee by dollar. That is not required. I'm talking about the London market. London, Copenhagen. London, Copenhagen, DKK 11.42, 11.435. That means what? 1 pound is equal to how many DKKs? So the quote given is DKK by pound is equal to 11.42 hyphen 435. What is the quote I want? Rupee by DKK. So I have to find out the cross rate. Rupee by DKK. So that too I want an ask rate. I want ask rate. So rupee by pound. I want rupee in the numerator. So that means first one I will take as it is. Rupee by pound. What about second one? If I multiply directly, I will get rupee into DKK divided by pound square. Meaningless quote. Yes or no? So I want rupee in the numerator and DKK in the denominator. So that what happens? Pound will get cancelled. Pound will get cancelled. Yes or no? What is left? Rupee divided by DKK. I want ask rate. Yes or no? I want ask rate. Ask rate of a rupee by pound is readily available. 74.32 into. I want ask rate of a pound by DKK. Ask rate of a pound by DKK is not there. So that's why 1 divided by bit rate of DKK by pound. So the answer is 6.5078. So here as a dealer, you are selling 1 DKK at the rate of 6.515 and you are buying 1 DKK at the rate of 6.5078. So profit is equal to what is the profit? 10 lakhs into 6.515 minus 6.5078. So the answer is 7,200. So likewise you can find out for New York. New York market you can do it. Okay. So which is the best one? Okay. In London 7,200. In New York 4,824. So transaction should be covered in London market. Clear? Done? Transaction should be covered in London market. Okay? Now, see this question, Smart 5. The following two-way quotes appear in the foreign exchange market. Spot, rupee by US dollar, 46 rupees, 46.25. 2 months forward, 47 and 47.5. Required, how many US dollars should a firm sell to get rupees 25 lakhs after 2 months? How many rupees is the firm required to pay to obtain US dollar 2 lakhs in the spot market? Assume the firm has US dollar 69,000 in current account, earning no interest. Return on investment on rupee investment is 10% per annum. Should the firm encash the US dollar now or 2 months later? Okay, so this question is simple question, Smart 5. Smart 5. Okay, so first let us write down the quotes. What are the quotes? Rupee by dollar is equal to 46 hyphen 46.25. Next, 2 months, this is spot. Two months forward, rupee by dollar 47.5. So what is the first part? How many US dollars should a firm sell to get rupees 25 lakhs after 2 months? To get rupees 25 lakhs. Get rupees 25 lakhs means customer buy rupee, bank sell rupee, so the relevant rate, ask rate of a rupee. Yes or no? Ask rate of rupee is not given. Yes or no? Okay. So outflow is equal to 25 lakhs into ask rate of rupee is not given. How do I get ask rate? 1 divided by bid rate, 47. So answer is 5. See carefully. 25 lakhs divided by 47. 25 lakhs divided by 53,191.48 dollar. Clear? B part. What is the B part? How many rupees is the firm required to pay to obtain US dollar 2 lakhs in the spot market? Obtain 2 lakhs in spot market. Obtain 2 lakhs in spot market means customer buy dollar, dealer sell dollar. So the relevant rate is ask rate of dollar. Okay, so outflow 2 lakhs, huh? 2 lakh dollars into 47.46 46.25 46.25. The answer is 92,50,000 rupees. Clear? Okay. Next, assume the firm has US dollar 69,000 in current account earning no interest. If you are maintaining money in current account, you will not receive any interest. Return on investment on rupee investment is 10% per annum. Should the firm encash the US dollar now or 2 months later? Okay, encash now. Encash now. C part. In C part, first one, encash now. If you are encashing now, then what? Okay, if you are encashing now, 69,000. So the spot rate is applicable. Encashing now means you withdraw the $69,000 from current account and sell. Dollar sell. You are selling. That means bank buy. Relevant rate, bid rate. 69,000 into 46. 33 lakh. 32 lakh. 32 lakh 43,000. This 32 lakh 43,000 can be invested for how many months? 2 months. This 32 lakh 43,000 can be invested for how many months? 2 months. Is equal to 32 lakh 43,000 into 2 by 12 into 10%. What is the number? 54,050. Clear? If you are encashing now, what is the number? 52? I think the number is wrong. Tell me the correct numbers, Sharan. 32 lakh, 31 lakh, 74,000. 31 lakh 74,000 into 2 by 12 into 10%. 52,900. So this will be the inflow. What is the inflow overall? 32 lakh 26,900. This is outflow if you are encashing now. What is the next one? Encash after 2 months. Encash after 2 months. If you are encashing after 2 months, then what? You will not get any interest. So forward rate is applicable. 69,000 into 47. 32 lakh 43,000. This is encash after 2 months. Done. Okay. So this is the basic question. Okay. So we completed basics. So next concept, purchasing power parity theory. Purchasing power parity theory. And next what? Interest rate parity theory. So purchasing power parity theory, interest rate parity theory, and next arbitrage profit. Arbitrage process. We are going to discuss arbitrage process and then what? Hedging techniques. So we have not yet started hedging techniques. First you should understand the basics. Are you clear? See the next concept, purchasing power parity theory and interest rate parity theory. Purchasing power parity theory, interest rate parity theory, and arbitrage. So after discussing arbitrage concept, I will move on to hedging techniques. Hedging means what? Reducing the risk. So what are the two objectives of Forex chapter? What are the learning objectives? The learning objectives are first one, what is the learning objective? Okay, minimizing the risk, mitigation of a risk, reducing the risk. We are going to learn hedging techniques in this chapter. And next one, what? Making profit out of a market imperfection. That concept is called as arbitrage. Arbitrage. Okay. I hope you completed portfolio management, derivatives, advanced capital budgeting chapters. Okay. So see the next concept, purchasing power parity theory. What is this purchasing power parity theory? Purchasing power parity theory. Purchasing power parity theory is simple. Example, for suppose the calculator cost in India is equal to rupees 90. Calculator cost in India is rupees 90. So, and the calculator price in US is $1. Okay. I don't think in US students will use calculator. So $1, let us assume. What is the calculator cost in US? $1. In India it is rupees 90. Now the next point is, first suppose, okay, if calculator price is 90 rupees in India and $1 in US, that means as per purchasing power parity theory, $1 must be equal to rupees 90. Are you getting my point? $1 is equal to rupees 90. Okay, purchasing power parity. What is the meaning of parity? Parity means equal. Parity means what? Equal. So purchasing power, parity theory, the assumption is throughout the world the purchasing power will be same. Purchasing power will be same. Purchasing power parity theory. Okay. For suppose here the calculator price is 90 rupees, in US it is $1. That means as per purchasing power parity theory, $1 must be equal to rupees 90. Okay. Let us assume the handbag cost in India is rupees 10,000. In India it is rupees 10,000. And in US it is $110. $110. That means as per purchasing power parity theory, $110 must be equal to 10,000 rupees. 10,000 rupees. So that means what? $1 is equal to rupees 90. So this is the exchange rate as per the purchasing power parity theory. So this $1 is equal to rupees 90 is called as a theoretical rate. So we are learning one theory. What is the theory? Purchasing power parity theory. For suppose the inflation India 10%, US 5%. Okay. So that means after one year, the calculator price in US will be equal to $1 into 1.05. And in India, the calculator price will be equal to 90 into 1.1. So as per purchasing power parity theory, after 1 year, $1 into 1.05 must be equal to 90 rupees into 1.1. So that means nothing but $1 is equal to 90 rupees into 1.1 divided by 1.05. What is the rate? Rupees 94.28. So this, what is this 94.28? This 94.28 is as per purchasing power parity theory, $1 must be equal to rupees 94.28 after 1 year. So this is nothing but theoretical forward rate. Theoretical forward rate. So theoretical forward rate, why we call it as a theoretical forward rate? Because this rate is calculated using the theory. What is the theory? Purchasing power parity theory. Okay. So as per purchasing power parity theory, $1 must be equal to rupees 94.28. Now we compare this theoretical forward rate with actual forward rate. For example, actual forward rate $1 is equal to rupees 96. Rupees 96. That means in the actual future market, actual forward market, the dollar is overpriced. As per our theory, $1 must be equal to rupees 94.28, but in market it is 96. That means overpriced in the forward market. That means in forward market we should sell the dollar. In forward market, we should sell the dollar. So that means we should buy the dollar as on today. So that's how we find out the market imperfection. We make a profit out of a market imperfection. Are you getting my point? Okay. So in this concept, see this one. How I am calculating the forward rate? How I am calculating? 1 unit of foreign currency is equal to spot rate into 1.1. What is this 1.1? 1 plus inflation rate of home currency divided by 1 plus inflation rate of foreign currency. We assume the quote given will be the direct quote. In direct quote, left side currency is the foreign currency, right side currency is the home currency. Okay. So what is the formula here as per purchasing power parity theory? As per purchasing power parity theory, 1 unit of foreign currency is equal to spot rate into 1 plus inflation rate of home currency divided by 1 plus inflation rate of foreign currency. If there is Indian rupee in the question, you will assume that Indian rupee is the home currency and other currency is the foreign currency. Sometimes in the quote, you may not find our Indian rupee. In that case, what? In that case, so better you remember this formula as spot rate into 1 plus inflation rate of right side currency divided by 1 plus inflation rate of left side currency. Clear? So this is as per purchasing power parity theory. Okay. And as this is a revision class, I'm not going to explain the interest rate parity theory, but simple interest rate parity theory, instead of inflation rate, we take interest rate. $1 is equal to, nothing but 1 unit of foreign currency is equal to spot rate into 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency. Okay, the same. You apply the same logic. For example, $1 is equal to rupees 94.28 as per interest rate parity theory. So we compare with actual forward rate. If both actual forward rate and theoretical forward rate are same, that means there is no scope for arbitrage. But if they both are not same, that means there is a scope for arbitrage. Clear? Okay. So let me explain this concept with a question. First see the smart 2. So this question you will not find in ICAI book, but this question is taken to explain the purchasing power parity theory. A 8 version laptop is priced at $461.5 at New York. The same version laptop is priced at rupees 30,500 in New Delhi. Calculate the exchange rate in New Delhi. Exchange rate in New Delhi. Simple. As per the purchasing power parity theory. So the laptop bag in New York is, the laptop bag price in New York is, laptop price in New York is $461.5, whereas in New Delhi it is 30,500. So as per purchasing power parity theory, it is smart 2. So tell me. As per purchasing power parity theory, $461.5 is equal to rupees 30,500. That means $1 is equal to 30,500 divided by 461.5. So $1 must be equal to rupees. $1 must be equal to 66.09 rupees. Clear? Next, B part. If over the next year, the price of a laptop is increased by 8% in New Delhi and 5% in New York, determine the price of a laptop at New Delhi and New York. Simple. So A part completed, right? Next B part. Okay. So after 1 year, what is happening? If over the next year, price of the laptop increased by 8% in New Delhi. So after 1 year, laptop price in New Delhi is equal to 30,500 into 1.08. Answer? 32,904. Next, in New York. In New York it is 461.8 into 1.05. 461.5. 461.5 into 1.05. So tell me the answer. 484.58. In this question they have not asked the exchange rate after 1 year, the theoretical forward rate after 1 year. For suppose if they ask you to find out the theoretical forward rate after 1 year as per purchasing power parity theory. Simple. How do I find out? as per purchasing power parity theory, $484.58 must be equal to 32,904 rupees. 32,904 rupees. Clear? That means $1 must be equal to 32,904 divided by 484.58. 67.902 rupees. Clear? So this I can find out the formula. This I can find out by using the formula. $1 is equal to spot rate. What is the spot rate? 66.09. Spot rate into 1 plus inflation rate in home currency. What is the inflation rate of home currency? 0.08 divided by 1 plus 0.05. So then also you will get the same answer, that is 67.902 rupees. Clear? Are you able to understand the concept? Navina, please let me know. Done? Now let us move on to the next question. So there are several small questions relating to interest rate parity theory and purchasing power parity theory in additional questions. If you want clarity, you can go through those questions. Okay? So here the fundamental point, if interest rate increases, the currency value decreases. If interest rate or inflation rate increases, the currency value decreases. Here in this question you can see $1 after 1 year is equal to 67.902. What is the spot rate? $1 is equal to 66.09. That means, so here the rupee value is decreasing. Yes or no? Because present with 66.09 rupees you can buy $1, but after 1 year to buy the same dollar we need 67.902. So that means what is happening? Rupee value is getting decreased. Why? Because inflation rate is increasing. We have seen in the determinants of exchange rate. So one of the determinant is what? Inflation rate. Likewise, instead of inflation, let us assume the interest rate. If interest rates are high, the currency value decreases. If interest rates are high, the currency value decreases. If interest rates are low, the currency value increases. Okay? Clear? Let us move on to the next question. The US dollar is selling at, the US dollar in India is selling at 55.5 rupees. If the interest rate for 6 months borrowing in India is 10% per annum and the corresponding rate in USA is 4%, do you expect that US dollar will be at a premium or at discount in the Indian Forex market? Do you expect that US dollar will be at a premium or at a discount in the Indian Forex market? Simple. Okay, what is the present rate? $1, 55.5. What is the interest rate in India, borrowing rate? 10% per annum. You should understand the interest rates. Here 6 months borrowing in India is 10% per annum. You might get confused. Sir, 6 months and per annum, what is this? That means nothing but the interest rates will depend upon the period for which you are borrowing. If you borrow for 3 months, interest rate will be different. If you borrow for 6 months, interest rate might be different. Here if you are borrowing for 6 months period, what is the interest rate applicable? 10% per annum. So okay, the corresponding rate in USA is 4%. So tell me, so the interest rate in USA is less than the interest rate in India. That means what happens? The dollar value increases. Dollar value increases. That means, do you expect the US dollar will be at a premium or a discount? No doubt, US dollar will be at a premium in the Indian Forex market. Why? Because the interest rate in USA is less compared to India. Okay. Next, what will be the expected 6 months forward rate for US dollar in India? What will be the expected 6 months forward rate for US dollar in India? What will be the, okay, what will be the expected 6 months forward rate for US dollar in India? Simple. How can I find out? Okay, simple. So as per interest rate parity theory, simple, how can I find out? $1 is equal to 55.5 into 1 plus interest rate of home currency. 1 plus, what is the interest rate of home currency? 10%, that is per annum. But they are asking you to find out the 6 months forward rate. Be careful. High chances of doing a clerical mistake. 0.1 into 6 by 12. We should take 6 months interest rate divided by 1 plus 0.04 into 6 by 12. You will get 57.13. What is the present rate? Spot rate 55.5. So that means dollar will be quoted at premium. What is the last part? What will be the rate of a forward premium or a discount? They're asking you to find out the forward premium or a discount. Simple. So forward premium or discount. Dollar will be quoted at a forward premium. So forward premium. Forward premium. $1 is equal to. So forward premium is equal to. What is the calculation? Forward rate. What is the forward rate? 57.13 minus 55.5. The difference is the premium, but we have to find out the difference in percentage. Divided by 55.5 into 100. You will get a premium for 6 months, but I should convert this premium for 6 months too. Okay. So 12 divided by what? 6. I should convert the premium which is calculated for 6 months to 12 months. So the answer is 5.87. So generally this forward premium will be equal to what? The interest rate differential. So what is this interest rate differential? See how the interest rate differential is calculated. 1 plus 0.08 into 6 by 12 divided by 1 plus 0.08 into 1 plus 0.04 into 0.1. Okay, I'm sorry. 1 plus 0.1 into 6 by 12 divided by 1 plus 0.04 into 6 by 12. So this is interest rate differential. Interest rate differential. Okay, into what? 2. So nothing, sorry. Minus 1. Minus 1. You will get forward premium for interest rate differential for 6 months. You will get interest rate for 6 months. Okay? Clear? Okay, Navina, corrected. Into what? 2. Multiply with 2, you will get the same answer, that is 5.87%. That means you should multiply with 100. Okay? Done? Am I clear? Okay. Clear? Now, let us move on to the next one. Smart 4. It is an arbitrage related question. Arbitrage related question, Smart 4. Spot rate $1 is equal to 48.0123. 180 days forward rate for $1 is equal to 48.8190. 180 days forward rate, that is actual forward rate. Annualized interest rate for 6 months, rupee 12%. Annualized interest rate for 6 months, US 8%. Is there any arbitrage possibility? If yes, how an arbitrator can take advantage of the situation if he is willing to borrow rupees 40 lakhs or US dollar 83,312. If yes, how an arbitrator can take advantage of the situation if he is willing to borrow rupees 40 lakhs or US dollar 83,312. Okay. So let me start. Simple. So we should check whether there is an arbitrage possibility or not. So question number Super 4. This is the fourth question to be practiced in Forex chapter, Super 4. Super 4. First, what is the spot rate? $1 is equal to rupees 48.0123. So to check whether there is a chance for probability, arbitrage or not, we should find out the theoretical forward rate. So how can we find out the theoretical forward rate? Interest rates are given. Yes or no? So theoretical forward rate as per interest rate parity theory. Okay. So theoretical forward rate $1 is equal to 48.0123 into 48.0123 into 1 plus 0. Okay, what is the interest rate of a home currency? 12%, yes or no? 0.12 into 6 by 12. Yes or no? Divided by 1 plus 0.08 into 6 by 12. So this is how the theoretical forward rate is calculated, yes or no? So you will get $1 is equal to 48.9356. What is the actual forward rate? $1 is equal to 48.8190. So actual forward rate 48.8190. So tell me, actual forward rate is less than theoretical forward rate or greater than the theoretical forward rate? So actual forward rate is less than theoretical forward rate. That means it indicates dollar is overpriced or underpriced. As per our theory, $1 after 1 year must be equal to 48.9356. But okay, the actual market, in the actual forward market, $1 after 1 year is quoted at 48.8190. That means as per our theory, the dollar in actual forward market is underpriced. Very good. Dollar is underpriced. So understand the course of action. Understand the course of action. What is the course of action? From tomorrow onwards, I will take classes for a long time. So I have set up a separate recording setup. So I will be recording from the morning 9 to 6, but I will be taking breaks, half an hour in between. But I will try to complete the entire revision series in next 5 days. Okay, maximum I will try. So by the 12th, okay, by April 12th, I will try to complete all the chapters. Okay. So what is the course of action? Course of action is, first you should decide the future. So first the future. Future what? Future what? Buy dollar. Future buy means spot sell dollar. This should be the course of action. Okay, understand this. How the arbitrage process is carried on here. Okay, in one country we have to borrow, in one currency we have to borrow, and we have to invest in other currency. Are you getting my point? Okay, I should borrow in one currency and invest in another currency. Clear? Okay, Navina, no problem. So you should say whatever you feel, even if it is mistake. So future buy dollar, spot sell dollar. Okay. So spot you have to sell dollar, right? First of all, understand this covered interest arbitrage. How the arbitrage is carried on. So never, arbitrator will never use his own money. Okay. So what he is going to do is, he is going to borrow money in one currency and invest in another currency. Are you getting my point? Example, forget about this parity theory, interest rate parity or something. So think like a layman. If you think like a layman, simple, in US interest rate is 8%, in India it is 12%. Forget about theory and all. Simple common sense point is what? I will borrow money in US and invest in India. Are you getting my point? Okay. So nothing but I borrow dollar, convert into INR, I will invest in India for next 6 months, and after 6 months I will convert this money to dollar, and again I will repay the loan. I will get a profit. This will be my thinking. But do remember as per interest rate parity theory, what happens is, if the interest rate is high, in India interest rate is high, that means in future the dollar value will increase. Even if you get benefit out of interest, so that will be set off, okay, due to the increase in value of a dollar. Okay, so that's why we applied an interest rate parity theory and we calculated the rate, forward rate. So as per the interest rate parity theory, $1 must be equal to 48.9356, but it is 48.8190. That's why there is a scope for arbitrage. Okay, for suppose if it is 49.9, if it is 49.9, what is the meaning of that? 49.9. 49.9 means actual forward rate is greater than theoretical forward rate. That means it is overpriced. In the forward market, it is overpriced. That means future sell dollar, spot buy. So then in that case your course of action will be different. So I gave an example that you have to borrow in one currency, invest in another currency. First, see this question. Spot I have to sell dollar, yes or no? Spot I have to sell dollar. I have to sell dollar means I should borrow in dollar. If I borrow $83,312 as on today, then my next action is converting this dollar into Indian rupees. Nothing but I sell dollar. Yes or no? I will convert into INR. I invest INR for next 6 months. After 6 months, I will buy dollar and I will repay the loan. My course of action is also the same. Present sell, spot buy. But if actual forward rate is 49.9, in that case my course of action should be future sell, spot buy. In the spot you have to buy dollar. That means the course of action is first you have to borrow Indian rupees, borrow INR, buy dollar, invest in US, and in future sell dollar, convert into INR, repay the loan in INR. Are you getting my point? So okay, you have to practice this question and next question. 2 questions are enough for arbitrage. You can understand, you will understand very easy. So step 1, arbitrage process. Arbitrage process. Step 1. What is step 1? Borrow $83,312 at the rate of 8% per annum for how many months? 6 months. Nothing but 180 days. Borrow $83,312 at the rate of 8% per annum for 6 months. Why I should borrow only dollar? Because in the spot I have to sell the dollar. What is step 2? So these second step is also taken on the same day. Step 2, sell dollar in spot market and receive rupees. How much? 83,312 into 48.0123. Why I am multiplying? I have to convert the dollar, and the quote is also given per dollar. Quote is also given per dollar. So that's why I am going to receive 40 lakhs. Step 3. What is the step 3? This is also taken on the same day. Same day. Deposit or invest. Deposit rupees 40 lakhs in India at the rate. Deposit rupees 40 lakhs in India at the rate 12% per annum for how many months? 6 months. This contract is also entered on a same day. On the same day, you have to enter into another contract. What is another contract? Enter into 6 months forward contract. Enter into 6 months forward contract to sell dollar at the rate of rupees. Buy dollar, not sell. Enter 6 months forward contract. Enter 6 months forward contract to buy dollar, not sell. Buy dollar because it is underpriced. Buy dollar at the rate of 48.8190. Because after 6 months I have to repay the borrowing. I have to repay the borrowing taken in dollars. That means I need dollar. So wait for 6 months. Wait for 6 months. After 6 months, what? Step 5. After 6 months, okay, withdraw deposit. After 6 months, realize the deposit. Realize the deposit and receive. Okay, what is the amount you are going to get? 40 lakhs plus 40 lakhs into 12% into 6 by 12. What is the amount you are going to receive? 42 lakh 40,000 rupees. After 6 months, realize the deposit and receive 42 lakh 40,000 rupees. Next, step 6. Step 6. Okay. Step 6 what? Okay, sell 42 lakh 40,000 rupees and buy dollar. How many dollars I am going to receive? 42 lakh 40,000 divided by. This time I have to divide. Why? I have to convert Indian rupees, but the quote is given per dollar. So what is the quote? 48.8190. How much I am going to receive? 86,851. So $851. Step 7. What is the step 7? Repay the loan. Repay the loan. What is the loan amount I have to pay? 83,312 plus 83,312 into 8% into 6 by 12. 86,644 dollar. Now whatever the amount left is what? Arbitrage gain. What is the arbitrage gain? So at the end I have $86,851 minus what is the amount I paid? $86,644. $207. So this is the arbitrage gain. $207 is the arbitrage gain. For suppose, let us assume the actual forward rate is not equal to 48.8190. If it is 48.9356, if it is 48.9356, so that means there is no scope for arbitrage. Example, instead of 48.890, divide with 48.9356. 42,40,000 divided by 48.9356. You will get 86,644. And the amount to be repaid as a loan, same. And ultimately what? No profit, no loss. So there is no scope for arbitrage. Clear? If actual forward rate and theoretical forward rate are same, that means there is no scope for arbitrage. Done? Now let us move on to the next question. Super 2. Given the following information, exchange rate Canadian dollar 0.665 per DM, Canadian dollar 0.670 per DM, 3 months, interest rate DM 7% per annum. Solution profit in dollar. So if you want to convert this profit into rupees, you can convert 207 into 48.8190. So in old material they have not given profit in Indian rupees. In new metal they might have given. So if you want, you can calculate. So $207. I gave the solution in dollar only, Navina. $207. Okay, I'm sorry. So it is $207. I wrote $207 only. Done? Let us move on to the next question. Given the following information, exchange rate Canadian dollar 0.665 per DM, 0.670 per DM, 3 months. So what operations would be carried out to take the possible arbitrage gain? Simple. First let us find out what theoretical forward rate. I'm straight away calculating the theoretical forward rate. What is the question number? Super 2. Second question to be practiced. The last question is fourth question to be referred. I might have told you it is practice. Refer. Super 2. Super 2. First we should find out what theoretical forward rate. So in examination you should write as per interest rate parity theory. 1 unit of foreign currency is equal to spot rate into 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency. Afterwards, what? So what is given? 1 DM is equal to 0.665 Canadian dollar into, this is a spot rate. Okay. Assume this is a direct quote. It is a direct quote means Canadian dollar is home currency, DM is foreign currency. 1 plus. What is the interest rate of Canada? 9%. So that means 1 plus 0.09 into 3 by 12. Whole divided by 1 plus 0.07 into 3 by 12. Be careful. This is 3 months forward rate. 3 months forward rate is given in the question. So 1 DM is equal to 1 DM is equal to 0.668 Canadian dollar. What is the actual forward rate? Actual forward rate is equal to DM 0.67 Canadian dollar. So that means actual forward rate is greater than theoretical forward rate. Actual forward rate is greater than theoretical forward rate. So that means what? DM is, which currency is overpriced? DM, reduced mark. So DM is overpriced in forward market. So tell me the course of action. Course of action. Course of action. First decide the future. Future it is overpriced, right? So that means future sell. What about spot? Spot buy. Which currency? DM. Future sell DM, spot buy. Sell DM in future, buy now. Very good, Navina. Done. So now let us start the arbitrage process. Arbitrage process. Step 1. What is step 1? Arbitrage process. Step 1. Spot buy DM. Spot buy DM means we should borrow Canadian dollar to buy DM. Yes or no? In the question, how much to borrow is not given. So we can assume any number. We can assume any number. So borrow. Okay, I'm assuming $1,000, 1,000 Canadian dollar. Okay, but if you want to complicate your life, you can borrow 9567.86 Canadian dollar. Okay, borrow. Okay, I think already your life is complicated, so that's why better you borrow 1,000 Canadian dollar at the rate 7%, 9% per annum. For how many months? For 3 months. Step 2. What is step 2? Buy DM. How many DMs are you going to get? We are converting the Canadian dollars, but what is the quote? Quote is given per DM. Quote is given per DM, but converting Canadian dollar, that means multiply or divided by? Multiply or divide by? Divided by. Be careful. You might commit a mistake. Or else you can write like this. 1 DM is 0.665 Canadian dollar. Now the question is, for 1,000 Canadian dollar, how much? So then also you will divide 1,000 with 0.665. Otherwise, simple logic, you are converting Canadian dollar, quote is given per DM. So that's why divide. If you are converting Canadian dollar and quote is also in Canadian dollar, then what? Multiply. Clear? What is the amount you receive? 1503.76 DM. 1503.76 DM. Clear? By DM. Next step 3. What is step 3? Invest. Invest 1503.76 DM at the rate 7% per annum. For how many months? 3 months. Students might feel like, sir, we are borrowing at 9% and investing at 7%. How can we get profit? Okay, exchange rate. We get a benefit in exchange rate. Okay. Next, same day. On the same day, we enter into another contract. Step 4. What is step 4? Okay, enter forward contract. For what? To sell DM at the rate of 0.67 Canadian dollar. Even though you are losing money in interest, you will get a benefit in exchange rate, because as per your theory, 1 DM after 3 months should be 0.668, but it is 0.67. Clear? So after 6 months, after 3 months, after 3 months, withdraw deposit and receive. So after 3 months, what after 3 months? Withdraw deposit, right? After 3 months, withdraw deposit and receive. How much are we going to receive? What is the calculation? 15.76. 1503.76 plus 1503.76 into 7% into 3 by 12. How much are we going to receive? 1530. 1530 DM. Next step 6. Step 6. Sell 1530 DM and receive. So this time I have to multiply. Why? I am converting DM and the quote is also per DM. 1530 into 0.67. 1025 Canadian dollar. So what is the next step? Repay the loan. Step 7. Repay the loan. What is the loan amount I have to pay? 1000 plus 1000 into 9% into 3 by 12. 1022.5 Canadian dollar. So arbitrage profit. Arbitrage profit is equal to, what is the arbitrage profit? 1025 minus 1022.5. 2.5. I think you should get 2.6. 1025.1. You will get 2.6 Canadian dollar. Clear? If you want more arbitrage profit, take $10,000. Borrow 10,000 Canadian dollar. Otherwise 1 crore Canadian dollar, then you will get more profit. Okay? Am I clear? Done? So this is the arbitrage profit. Next question is the currency arbitrage. Next question is what? Currency arbitrage. Following are the spot exchange rates quoted at 3 different Forex market. Quoted at 3 different Forex market. USD / INR. Generally, if they write USD by INR, that means 1 INR is equal to how many US dollar? But if you see the number, it is 48.3. Okay, 1 INR is equal to $48.3. No, there is no chance, yes or no? So generally it should be like, how do we read this USD by INR? 1 INR is equal to how many USD? But in this question it is reverse. So what is actually given? Rupee by dollar. What is the next one? Rupee by pound. And next one is what? Dollar by pound is given. The arbitrator has USD 1 crore. Assuming that there are no transaction costs, explain whether there is any arbitrage gain possible from the quoted spot exchange rates. This is a currency arbitrage question. So to find out whether there is a scope for arbitrage or not, so we have to find out the cross rate. We have to find out the cross rate. See the first 2 quotes. In first 2 quotes, what is the common currency? INR is the common currency. Yes or no? INR is the common currency. Okay. So let us find out the dollar by pound using the first 2 quotes. Using the first 2 quotes. So what do I require? Dollar by pound. Dollar by pound is equal to, okay, dollar by pound. I want dollar in the numerator, right? So that means I should write dollar by rupee into rupee by pound. For me, dollar by rupee is not available. So dollar by rupee is equal to 1 divided by rupee by dollar. Yes or no? So that means 1 divided by 48.3 into 77.52. 1.605. Clear? 1.605. So that means here 1 pound is equal to 1.605 in Mumbai, London markets. Yes or no? But whereas in New York, 1 pound is equal to 1.6231. That means pound is overpriced in New York. Pound is overpriced in New York. Underpriced in what? Okay, in Mumbai and London. So that's why the first step is you are having USD. You are having USD. Arbitrager is having what? USD. Clear? Arbitrager is having USD. Is it 1.605 or not? Tell me the number. 1 point. So dollar by rupee. Dollar by rupee into rupee by pound. So 77.52. 1.605. Okay. Clear? Are you getting my point? So that means with dollar, first with dollar, okay, you are having dollar, right? So wait. So the other way of finding out, so first rupee by dollar is given, first code. What is the first code? Rupee by dollar. Using the next two, let us find out the cross rate. Let us find out the rupee by dollar. What is the common currency? Pound is the common currency, right? So rupee by dollar is equal to, okay, so rupee by pound into, okay, so I should write the equation so that the pound should get cancelled. How do I get rupee by pound is given? What is the rupee by pound? 77.52 divided by 1.6231. What is the answer? 47.76 rupees. $1 is equal to 47.76 in London, New York markets. Yes or no? But whereas in Mumbai it is 48.3. So in Mumbai dollar is overpriced. In Mumbai dollar is overpriced. So that means sell the dollar in Mumbai. So sell the dollar in Mumbai. You will get 1 crore into 48.3. 1 crore into 48.3. 44. 44.76. Thank you, Navina. It is 44.76. Okay. So the cross rate is 44.76, whereas in Mumbai the rate is 48.3. 48.3. Are you getting my point? Now in Mumbai it is overpriced. So that means sell 1 crore dollar in Mumbai. Receive 48.3 crores. 48.3 crores. Clear? And next what? Sell this 48.3 crores in New York, because in New York it is overpriced. In New York it is 40. I think it is printing mistake. 47.76 only, Navina. 47.76 rupees. It is 47.76 rupees. Once again, I am taking here. What is the question number? Super 3. So give me the given codes. What are the given codes? Super 3 question. So the code first given is rupee by dollar, 48.3. Next code, rupee by pound, 77.52. Next, dollar by pound, 1.6231. Okay. So let us find out the cross rate of rupee by dollar using the last two codes. Using the last two codes. I want rupee by dollar, yes or no? Let us find out the rupee by dollar. So the rupee by dollar rate in Mumbai is 48.3. Using the London and New York rates, let us find out the rupee by dollar rate. Okay, the common currency is pound. We should write the equation so that the pound gets cancelled. So rupee by pound, rupee by pound into, second one I have to change, yes or no? Pound by dollar. So that is equal to 77.52 into 1 divided by 1.6231. So the answer is 47.76 rupees. That means in international market, $1 is equal to 47.76 rupees. But in Mumbai it is 48.3. So that means in Mumbai it is overpriced, in international market it is underpriced. So how the arbitrage process is carried on? Step 1, we sell overpriced, yes or no? That is a basic strategy. We sell overpriced. Where it is overpriced? Dollar is overpriced in Mumbai. So that's why sell dollar in Mumbai and receive 48.3 crore dollar, because right now we are having 1 crore dollar. So 1 crore into 48.3, so 48.3 crores. Next step. Step 2. What step 2? Right now we are having rupees, yes or no? With rupees we cannot directly purchase, okay, we cannot purchase dollar, yes or no? So first we should purchase pounds. Next step, buy pounds. Where should we buy pounds? In London. Buy pounds in London and receive. So what is the calculation? 48.3 crores. We are converting INR into pounds. Quote is given per pounds, yes or no? What is the quote? 77.52. What is the number? 48.3 crores divided by 77.52. Yes, very good, Navina. Sell in Mumbai and buy in international. So buy pounds in London and receive. What is the number? 62 lakhs 30,650 pounds. What is the step 3? Step 3 is sell pounds in New York and receive. Sell pounds in New York and receive. How much are we going to receive? 62 crore 30 lakh 650 into 1.6231. 1 pound is equal to $1.631 dollars. What is the amount I am going to receive? 1 crore 1 lakh 12,968 dollars. So arbitrage gain is equal to 1 crore. We started with 1 crore, but right now the amount available is 1 crore 1 lakh 12,968. So this is not the interest rate covered interest arbitrage. This is currency arbitrage. We are just identifying where the currency is overpriced and underpriced, and we are carrying on arbitrage process. So what is the arbitrage gain here? 1 crore 12 lakh 968. Clear? Done. So what is the other way of finding out? You can use the first two rates and find out what the quote. Example, instead of finding out rupee by dollar, you can find out what? You can find out, okay, so dollar by GBP, dollar by pound also. We are getting one, we have got 1.605. 1.605. What is the meaning of this? Pound is underpriced in Mumbai, London, overpriced in New York. In New York we sell pound. That is what we are doing here. In New York we are selling pound, yes or no? Okay. So we buy pound in London, sell pound in New York. If you see the arbitrage process, that is what we are doing. Sell dollar, buy rupee, and then what? Buy pounds in London, and then what? Sell pound in New York. That means you need not find out the quote for rupee by dollar. Okay. You can find out what? You can find out what? Dollar by pound. How do I get dollar by pound? Dollar by rupee into rupee by pound. So nothing but 77.52 divided by 48.30. 1.605. 1 pound is equal to $1.605 dollar. What is the meaning of this? So in New York it is overpriced. Pound is overpriced in New York. Okay, underpriced in what? Mumbai, London. In London it is underpriced. That means we should buy in London. So but we cannot directly buy pound in London using the dollar. Yes or no? First in Mumbai with dollar, sell dollar and receive INR, and next with INR buy pound in London, and then what? Sell pound in New York and receive 1 crore 1,12,968. What is the arbitrage gain? 1,12,968. Am I clear? Done. So this is the currency arbitrage question. So this part 5 question already we completed, right? So now today I am giving you work, smart 6. Smart 7, Smart 8, Super 4, Super 6. Okay. So these questions are leading and lagging. Leading means paying before the maturity. Lagging means what? Delaying. Delaying the receivables or payable. So one of the hedging technique is what? Paying in advance. Okay. Or else what? Delaying the payables or receivables. Okay. So you go through these questions, try to understand. If you are able to understand, okay, fine. If you are not able to understand, I will explain in the next class. Okay. Clear? So Forex I will be taking only 1.5 hours daily, 1 hour or 1.5 hours daily for the next 5 days. Okay. But parallelly what I will be taking mutual funds. So mutual funds I have taken only 1.5 hours class. I will take 1.5 hours daily, 1 hour or 1.5 hours class for mutual funds. Okay. I will start mergers and acquisition and also business valuation. Okay. I will be keeping 3 slots. 3 slots. One slot is for Forex. In next 5 days we are going to complete Forex. Second slot is for what? Mutual funds, security valuation, mergers and acquisition and corporate valuation. Third slot for theory. Startup finance, first chapter, risk management. Okay, these kind of a topic, securitization. Okay, clear? Done. But before coming to the class, please do complete portfolio management, derivatives, advanced capital, budgeting, and also what the work given today. What is the work given today? Smart 6, 7, 8, Super 4, Super 6, Super 4 and Super 6. So try to solve these questions. Okay, clear? If you are not able to do, I will explain tomorrow. No problem. Thank you. So tomorrow our class will start at 7 a.m. 7 a.m. So at 7 a.m. I will teach for 1.5 hours, and next what I will take a break for 1 hour. So likewise the breaks will be there. Okay, clear? So at 7 a.m. So meet you next session. Thank you. So good morning everyone. So welcome to third session of a Forex, Foreign Exchange Exposure and Risk Management. Okay, I have shared my complete AFM workbook and concept book in AFM group. AFM Telegram group. Okay, see the next question, Smart 6 question. So this is a question regarding the leading and lagging concept. Z Limited importing goods worth USD 2 million. Importing goods. Importing goods means it is a payable. Requires 90 days to make the payment. The overseas supplier has offered a 60 days interest-free credit period, and for additional credit for 30 days, an interest of 8% per annum. The bankers of Z Limited offer a 30 days loan at 10% per annum, and their quote for foreign exchange is as follows. Spot 1 USD 56.5, 60 days forward for 1 USD 57.1, 90 days forward for 1 USD 57.5. You are required to evaluate the following option: pay the supplier in 60 days or avail the supplier's offer of 90 days credit. 90 days credit. Okay, simple question. So what is the payable? 2 million US dollar is the payable, and it requires a 90 days to make the payment. 90 days. Overseas supplier offered 60 days interest free credit, but for additional 30 days he is charging an interest of 8% per annum. Okay, so one thing is you pay the supplier in 60 days. Second is pay the supplier at the end of a 90 days. But to pay the supplier at the end of a 60 days, you have to take a loan from the local bank for 30 days. What is the loan interest rate applicable? 10% per annum. Okay, let me solve this question. What is the question number? Smart 6. Smart 6. Okay, what is the option number A? Pay supplier in how many days? 60 days. Pay the supplier in 60 days. Okay, so pay the supplier in 60 days. What is the payable amount? Payable is equal to 2 million USD. 2 million USD means 20 lakh dollar. Okay, what is the 60 days forward rate? 60 days forward rate is equal to 57.1. Outflow at the end of 60 days. Outflow at the end of a 60 days is equal to 20 lakhs into 57.10, that is equal to 11 crore 42 lakh. Okay. So to pay the supplier at the end of a 60 days, we have to take a loan for a period of 30 days, yes or no, from the local bank. So that means what is the calculation? Interest 11 crore 42 lakh into what is the interest rate? 10% into 30 divided by 365. Number of days in a year has not been mentioned in the question, so we take 365. Clear? Is it mentioned or not mentioned? So what is the interest amount? 9 lakh 38630, 9 lakh 38,630. So total outflow will be, what is the total outflow? 11 crore 51 lakh 38,630 rupees. So please make a correction if I am wrong. Okay, done. Because I'm not calculating, I'm not using the calculator. You have to tell the answers. So next B part. What is the B part? Pay the supplier after how many days? 90 days. Pay the supplier after 90 days. Then what is exposure? Exposure is equal to 20 lakh dollar. This time you have to pay interest to the supplier. Yes or no? What is the interest amount? 20 lakhs into what is the interest rate offered by the supplier? Supplier is going to charge 8% into 30 divided by 365. So the answer is 13151. Yes or no? So the total amount is 20 lakhs 13,151 dollars. So that means with interest we have to pay 20 lakh 13,151 dollars at the end of a 90 days. Am I clear? Done. So that means total outflow in the second case will be, total outflow in second case 20 lakh 13,151 into what is the forward rate at the end of 90 days? 57.5. So overall outflow 11 crore 57 lakh 11 crore 57 lakh 56,125. Clear? Is it clear, Navina? Okay. So now tell me, which option is the better one? Pay at the end of 60 days or pay at the end of 90 days? Which is the better one? So pay at the end of 60 days, because outflow is less if you are making a payment at the end of 60 days. Am I clear? Done. Okay. Now come to the next question. Smart 7. An Indian importer has to settle an import bill for 1,30,000 dollars. The exporter has given the Indian exporter two options: pay immediately without any interest charges, make a payment without any interest charges, direct. Okay. So Indian importer. So the exporter has given the Indian importer. The exporter has given Indian importer two options. Here the customer is importer. So pay immediately without any interest charges, pay after 3 months with interest at 5% per annum. So to pay immediately to the exporter, here the importer has to take a loan from the local bank. Okay. So second option is what? Pay the interest to the supplier. First option is pay the interest to the local bank. What is the rate applicable? 15% per annum. The exchange rates in the market are as follows: spot rate 48.35, 48.36, 3 months forward rate 48.81, 48.83. The importer seeks your advice, give your advice. Simple. First one, pay immediately. Pay immediately without any interest charges. Pay immediately without any interest charges. Simple. So to make a payment immediately, so we should buy the dollar. So customer buy dollar means banker has to sell dollar. So the relevant rate is ask rate of a dollar. What is the ask rate of a dollar? 48.36 is the ask rate of a dollar in the spot market. So that means what will be the total outflow as on today? As on today, we should borrow 1,30,000 into 48.36. So that means your outflow is equal to 62 lakh
86,800. So to make a payment immediately to the supplier, we have to borrow 62,86,800 from the local banker. So 3 months interest, 62,86,800 into 15% into 3 by 12. Okay, so overall outflow will be 65,22,555. So this is the first option, pay immediately. What is the second option? Pay after 3 months. This time you have to pay interest to the supplier, that too in dollars. So what is exposure? 1,30,000. So interest 1,30,000. This is not 1 lakh. This is 1,30,000 into 5% into 3 by 12. Check the number. What is the number? 1,30,000 into 5% into 3 by 12. 1625. So the overall amount I have to pay is 1,31,625. So that means after 3 months, I have to buy the dollar. Customer buy dollar means bank sell dollar. That means relevant rate is ask rate of a dollar after 3 months. That is 48.83. So the total outflow by the end of a 3 months is equal to 64,27,248.75. Now tell me which is the best option. It is better to pay after 3 months because the outflow in the second case is less. Am I clear? Done? Okay. Let us move on to the next question. ABC company have taken a 6 months loan from their foreign collaborators for US dollar 2 million. Interest payable on maturity is at LIBOR plus 1%. What is this LIBOR? London Interbank Offer Rate. London Interbank Offer Rate. So as a CA student, you should know the difference between the fixed rate and floating rate, and what is fixed rate and not what is floating rate. Fixed rate means the rate of interest will remain till the maturity of the loan. If you're taking a loan at a fixed rate of interest, that means your rate of interest will be fixed irrespective of changes in interest rates in the market. Okay. What is the floating rate? Floating rate means the rate applicable to you depends upon the base rate. For example, in this question, the LIBOR is the base rate, London Interbank Offer Rate. Whenever the London Interbank Offer Rate changes, your interest payable amount will also change. Okay. So current 6 months LIBOR is 2%. Inquiries regarding the exchange rate, which with their bank elicits the following information: spot USD rupees 48.5275, 6 months forward 48.4575. What would be their total commitment in rupees if they enter into a forward contract? If they enter into a forward contract, what will be their total commitment in rupees? Simple question. What is the exposure here? So exposure is $2 million. So payable $2 million. What is the interest payable on maturity? LIBOR plus 1%. What is the LIBOR? Current 6 months LIBOR is 2%. So 2 plus 1, 3%. So this 3% is per annum, even though they have not mentioned it is per annum. So generally interest rates are quoted per annum. So then what is this 6 months LIBOR? Current 6 months LIBOR. Current 6 months LIBOR means if you are borrowing for 6 months, then the interest rate applicable is 2% per annum. So this is the special point in this question. That's why it is highlighted. Okay. So 2% plus 1%, 3% per annum is the interest rate applicable for you. But you're taking a loan only for what? How many months? 6 months. So that means the total amount payable is 20 lakhs plus 20 lakhs into 3% into 6 by 12. The total commitment after 6 months in dollars is 20 lakh 30,000. 20 lakh 30,000. So total commitment in rupees is equal to 20 lakh 30,000. 20 lakh 30,000 into 48.4575. That is 9 lakh. So 9 crore 83 lakh 68,725. Clear? Navina, is it clear? Navina, is it clear? Okay. Now, will you advise them to do so? Explain giving reasons. Simple. We will be advising them to enter into a forward contract always, because the main objective of them is to do a business. So that's why it is advisable to enter into a forward contract to ascertain the certainty in cash outflows. As a CA, we always recommend tax audit, preparation of financial statements, filing income tax returns, filing GST returns and GST audit, and so do follow what hedging techniques. Otherwise, what we will not find any client. Okay. Next, see the question. Super 4. Super question 4 means this question is for practice. This is the fourth question to be practiced in Forex chapter. Sun Limited is planning to import equipment from Japan at a cost of 3,400 lakh N. The company may avail loans at 8% per annum with quarterly resets with which it can import the equipment. So in this question, the special point is quarterly resets. Quarterly resets. The company also has an offer from Osaka branch of an India-based bank extending credit of 180 days at 2% per annum against opening an irrevocable letter of a credit. The special point in this question is irrevocable letter of a credit. Additional information, present exchange rate rupees 100 is equal to 340 N. So this is an indirect quote to Indians because quote is given per 100 rupees. So quote need not be mentioned per rupee. Here quote can be mentioned for what? Rupees 100. 180 days forward rate rupees 100 is equal to 345 N. Commission charges for letter of a credit 2% per 12 months. So this is the special point in this question. Commission charges for letter of a credit at the rate of 2% per 12 months. Advise the company whether the offer from foreign branch should be accepted. Advise whether the offer from foreign branch should be accepted. So calculation of outflow. So let us see this question. This question is for practice. Okay. Understand the question. What is the here's unlimited is importing the equipment. That means they have a payable. What is the payable amount? 3,400 lakh N. So company can take a loan at the rate of 18% per annum with quarterly resets with which it can import the equipment. That means in India it can take a loan at the rate of 18% per annum with quarterly resets. Okay. Interest rate high means what? So generally it is in India. Okay. The company has also an offer from Osaka branch of an India-based bank extending credit of 180 days at the rate of 2% per annum against opening of an irrevocable letter of a credit. What is the second option? To import the equipment for 3,400 lakh N. The second option is taking a loan from Osaka branch. Osaka branch is not in Assam or Nagaland. It is in Japan. Okay. You have an offer to take a loan from Osaka branch of an India-based bank extending credit of a India-based bank. It is having a branch in Osaka. You could take a loan loan for 180 days in Japan itself at the rate of 2% per annum against opening of an irrevocable letter of a credit. So what are the commission charges for letter of a credit? 2% per 12 months. Okay. So two options. First option, take a loan in India and buy Japanese yen and import the equipment. Second option is take loan in Japan and pay the amount for machinery and import the equipment. But in this question, the special point is irrevocable letter of a credit. Sir, what is this irrevocable letter of a credit? It is similar to bank guarantee, BG, bank guarantee. Sir, what is this letter of a credit? Let me give an example. For suppose, Sai Charan, okay, he has taken a loan from King Kong from China. Okay, he has taken a loan from King Kong from China. Okay, so Charan, he agreed to repay the loan after 6 months. Okay, but after 6 months, Charan failed to repay the loan. So what is the option with King Kong? Okay, King Kong is staying in China. So for suppose King Kong, he came to India from China. Okay, he came to our place, our own place, India, Varangal, and he is demanding the repayment of a loan from Charan. Okay, so tell me, so the person he's coming from China and he's threatening Charan to repay the loan. Okay, are we going to allow Charan to repay the loan? He is our person, right? Okay, he cannot come to our ilaka and collect the amount, right? Yes or no? Likewise, for suppose Navina has given a loan to Chingchang in China. Okay, if he makes a default, she cannot collect money from the person. She cannot go to China and she cannot collect that money, right? So the point is here, a person who is in India importing an equipment from Japan, he's taking a loan from a bank which is located in Japan. Okay. If Indian customer makes a default, the bank which is located in Japan cannot come to India and cannot collect loan from the customer who is staying in India. Okay. If lender and borrower are both are in same country, then also it is difficult to collect money from the borrower. Yes or no? That means collecting money, okay, from the borrower who is located in another country is very difficult. So that's why what happens is here the Indian customer will approach the Indian bank, okay, and Indian bank will give a guarantee to the bank branch which is located in Osaka. Okay, so this Indian bank will give a guarantee to the branch which is located in Osaka. For that, this customer has to pay letter of a credit, commission charges for letter of a credit. This Indian bank will give a letter of a credit. This Indian bank will give a letter of a credit. You can give a credit to the customer. This customer is credible and he will make a payment. If he is not making a payment, then I will pay. Okay, so the commission charges, what are the commission charges? 2% commission charges for 12 months. So these commission charges are levied on a loan amount. Loan amount. So this commission charges, these commission charges are paid to the bank, which is giving a letter of a credit. Letter of a credit. Are you getting my point? So are you able to understand the concept, Navina? Now, so let me tell you, Super 4, right? Super 4. What is the option number 1? Super 4. Option 1. Avail loan in India. What is the first option? Avail loan in India. Naveen, is it clear? Are you able to understand the letter of a credit concept? Avail loan in India. Okay. So tell me, what is the exposure? Exposure is equal to 3,400 lakhs and exposure 3,400 lakh N. Am I clear? Okay. So loan to be taken in India. So to make a payment of 3,400 lakh N, so we have to buy. So to buy 3,400 lakh N, we need to borrow Indian rupees in India. Yes or no? So loan to be taken. Loan to be taken is equal to, see the calculation. What is the present exchange rate? Navina, I'm audible. Why you are not responding? 100 rupees is equal to 340 N. Yes or no? Now for 3,400 lakh N, what is the outflow? Are you able to understand the letter of a credit concept? If not, I will explain again. Okay. Clear? So that means, what is the loan to be taken? The loan to be taken is equal to 3,400 lakhs divided by 340 into 100. What is the amount I am getting? 1,000 lakhs loan to be taken in India. So 1,000 lakh rupees. Clear? So for next 6 months, we have to pay interest on this loan, yes or no? So what is the loan to be taken? I mean, loan to be taken 1,000 lakhs. What is the interest rate applicable? 18%. So here the point is quarterly resets. That means interest is compounded for every quarter. So what is the interest for first quarter? 1,000 lakhs into 18% into 3 by 12. So the answer is 45 lakhs. Okay. Quarter 1. So 1045 lakhs. Next, add interest for quarter 2. What is interest for quarter 2? 1045 lakhs into 18% into 3 by 12. Quarterly resets. 47.003, 47.025 lakhs. Overall, 1092.025 lakhs. Total outflow. So this is option number 1. Option number 1 we can do comfortably because there is no concept of a letter of a credit. Clear? Second option. What is second option? Loan from Osaka branch. If you're taking loan from Osaka branch, that is in Japan, you take a loan in Japanese yen. You take a loan in Japanese yen. Yes or no? So that's why, what is the number? What is the calculation? Exposure. What is the loan I'm going to take? Loan from Osaka branch. What is the loan I'm going to take from Osaka branch? 3,400 lakh N. Add interest for how many months? Osaka branch, it is not charging interest per quarter. Osaka branch, we can calculate interest directly for how many months? 6 months. 3,400 lakhs 3,400 lakhs into 2% into 6 by 12. 34 lakh N. So 3434 lakh N. 3434 lakh N. Clear? So this is the 3434 lakh. With interest, we have to pay 3434 lakhs N after 6 months. You know the exchange rate after 6 months, yes or no? Okay. So total outflow in rupees is equal to, what is the exchange rate after 6 months? 100 rupees is equal to 345. Now my question is, for 3434 lakhs, how much? What is the calculation? 3434 lakhs divided by 345 into 100. The rupee is appreciating in next 6 months, because as of now for 100 rupees we are just getting 340 N. But after 6 months we are going to get 345 N. That means rupee is appreciating. So what is the answer? 995.36 lakh rupees. Okay. Add, this is the special point. Add commission charges on LC. This is a special point in this question. Add commission charges on LC. This question was asked in the past. It is in CA final study material, and it was also asked in examination. Okay. So commission charges on LC, letter of a credit. So let me start working note. So what is the concept of this letter of a credit, Navina? Who will issue the letter of a credit? The bank in India will issue a letter of a credit to the bank which is located in Osaka. Okay, so this bank in India will give a LC only on payment of commission charges by the customer. So when the customer has to pay LC charges, now or after 6 months? Customer has to pay LC charges now or after 6 months? Now. If customer pays now, then only the bank will give a LC and the bank in Osaka will give a loan. Yes or no? So LC charges to be paid as on today is equal to simple 3,400 lakhs into 3,400 lakhs into what? 2% into 6 by 12. LC charges 2% per annum. But we are taking loan only for 6 months. Yes or no? So that means, what are the LC charges to be paid? LC charges to be paid is equal to, LC charges to be paid is equal to what? LC charges to be paid. So 3,400 into 3,400 into 2, 3,400 into what? 3,400 lakhs into 2% into 6 by 12. That means 34 lakh N. Okay. To make a payment of this 34 lakh N, so we have to take a loan in India as on today. How can I pay LC charges as on today? I have to take loan in India. So that is the point. That's why it is okay, special. So loan to be taken. Loan to be taken for LC charges. What is the loan I have to take in? This loan is being taken for payment of LC charges. Okay, what is the loan amount I have to take? 34 lakhs divided by 340 into 100. 10 lakh rupees is the loan I have to take in India as on today. So again, what next? Add on this 10 lakhs I have to pay interest for next 6 months. Quarterly resets. Interest. Quarter 1. So in study material, interest is taken separately for quarter 1 and quarter 2. But whereas in suggested answer given by ACA, so interest is calculated for 6 months directly, which is not correct. Okay. Interest quarter 1. What is the quarter 1 interest? 10 lakhs into 18% into 3 by 12. 0.45 lakhs. Yes or no? Total 10.45 lakhs. Next, add interest quarter 2. 10.45 lakhs into 18% into 3 by 12. So 0.47025 lakhs. Total 10.92025 lakhs. Clear? So this is the outflow in rupees on payment of a LC charges. Clear? Am I okay? Am I clear? So 10 point, we should add this 10.92 lakhs LC charges. So the overall outflow, what is the overall outflow? Overall outflow is equal to 995.36 lakhs plus 10.92. Overall outflow. So what is the answer? 1006.28 lakhs. So tell me which is the best option? If you're taking loan in India, your total outflow is 1092. But whereas if you're taking loan in Osaka, the total outflow is 1006. Which is the better one? Better you take loan in Osaka. Done? Is it clear? Now, let us move on to the next question. Super 5. Super 5, this question is also for practice. Super 5, this question is also for practice. NP and Co has imported goods for US dollar 7 lakhs. Imported goods. The amount is payable after 3 months. The company has also exported goods for US dollar 4 lakh 50. So we have a concept of netting. Netting. Netting means in this case we are importing the goods worth 7 lakh US dollar. We are exporting the goods 4 lakh 50,000. Okay. If the maturity is same, then we do a netting. Then we do a netting means what? Nothing but the balance amount is 2,50,000. We do a hedging only for 2,50,000. What is the meaning of hedging? Hedging means reducing the risk. This amount is receivable in 2 months. But here we cannot do netting because payable is in 3 months, receivable is in 2 months. Okay, if you want to do a netting, then you have to postpone you have to lag your receivable by 1 more month. For receivable amount, a forward contract is already taken at rupees 48.9. Already we have taken a forward contract. For receivable amount, we already have taken a forward contract at the rate of 48.9. The market rates for rupee and dollar are as under: spot rate 48.5, 48.7. 2 months swap points are given 25, 30. Swap points are in ascending order. That means we have to add. We cannot directly add 25 to 48.5. If you add 25 to 48.5, you will get 73.5, which is not at all correct. Swap point should be added at the end after the point. So 48.5 plus 0.25. That means you will get 48.75. And next 48.70 plus 0.30. You will get 49. 3 months swap points 40 and 45. Swap points are ascending. If swap points are in ascending order, we should add. If they are in descending means what? For suppose instead of 20, 30, 25, 15 are given. Okay, 25, 10 are given. If 25, 10 are given, then what? We should minus. Because the logic is ask rate should always be greater than bid rate. The company wants to cover the risk and it has two options as under. First option, to cover payables in the forward market, to cover the payable in forward contract. What is the concept of forward contract? Contract entered today to buy or sell foreign currency in the future at a pre-agreed rate. We agree the rate as on today. So that means there is no uncertainty. Irrespective of a foreign currency in the future, foreign currency value in the future, we are going to pay or receive the fixed rate. So one of the popular hedging technique is forward contract. Forward contract. Okay. So clear. So now the point is, okay. So to cover payable in forward contract, first one. Exposure, what is exposure? 7 lakhs payable in how many months? 7 lakhs payable in 3 months. Receivable, 4,50,000 in 2 months. Receivable 4,50,000 in 2 months. Spot rate $1 48.5, 48.7. So this is a 2 months forward rate and this is a 3 months forward rate. Okay. Now, first option to cover payables in forward market. 7 lakhs payable after 3 months means customer has to buy dollar. That means bank has to sell dollar. Relevant rate, ask rate. What is the ask rate after 3 months? 49.15. Clear? So what is the outflow on payable? 7 lakhs into 49.15. Clear? So 3 crore 44 lakh 5,000. Done. So this is outflow after 3 months. We have a receivable also. What is the receivable amount? 4,50,000 after 2 months. The rate is already agreed. Okay. Already, okay, rate is agreed. 4,50,000 into 48.9. The amount I am going to receive is 2 crore 20 lakh 5,000. Okay. So to find out the net outflow, I cannot reduce 2 crore 20 lakh 5,000 directly from 3 crore 44 lakh 5,000. Why? Because this 2 crore 20 lakh 5,000 is the inflow after 2 months. Yes or no? That means I can invest this 2 crore 20 lakh 5,000 for next 1 month. So what is the interest I am going to get? 2 crore 20 lakh 5,000 into 12 percentage into 1 by 12. Okay, so what is the interest? 2 lakh 20,050. My total inflow at the end of a 3 months will be 2 crore 22 lakh 25,050. Now you can find out what the net outflow. What is the net outflow? What is the net outflow? 3 crore 44 lakh 5,000 minus 2 crore. I have to find out the net outflow. 3 crore 44 lakh 5,000 minus 2 crore 22 lakh 25,050. So my net outflow is equal to, check the number whether it is correct or not, 1 crore 21 lakh 79,950. Navina, it is 1006 or 1006.28. Done. Is it clear? So in this question, the special point is you might forget the interest for 1 month. You may directly what take outflow minus inflow. Be careful. So here the outflow 3 crore 44 lakh 5,000 is at the end of a 3 months. But we are receiving $4,50,000 at the end of our 2 months. That means we can invest that inflow 2 crore 20 lakh 5,000 for 1 month. Clear? Done. So this is the first part. This is the first part. See the second part of the question. What is the second part of the question? To lag the receivable by 1 month. This question is, this part is special part. That's why highlighted. To lag the receivables by 1 month and cover the risk only for the net amount, no interest for delaying the receivables is earned. If you are delaying the receivables, you are not going to receive any interest. Evaluate both the options. If the cost of a rupee fund is 12%, which option is preferable? What is the second option? Lag the receivable by 1 month. Lag the receivable by 1 month means what is the balance? If you are lagging the receivable by 1 month, that means payable 7 lakhs, receivable 4 lakh 50. Lag means delay. You are receiving after 2 months, delayed 1 month, and net off. After what is the net amount? 2 lakh 50,000. So cover the risk only for net amount. Cover the risk only for net amount. What is the net amount? 2 lakh 50,000 is the net amount. Clear? $2,50,000. Okay. For $2,50,000, cover the risk. Nothing but we enter into a forward contract only for $2,50,000. So I have to purchase the $2,50,000. That means bank has to sell. What is the relevant rate? Ask rate of a dollar. What is ask rate of a dollar? Ask rate of a dollar after 3 months, 49.15. My outflow is equal to 2,50,000 into 49.15. Are you able to understand? Okay. So 1 crore 22 lakh 87,500 is the outflow. Okay. But here there is one more special point to be highlighted. This is the special point. Sir, what is this point? In the question, they have already mentioned for receivable, already we entered into forward contract. What is the rate agreed? 48.9. Yes or no? To lag the receivable by 1 month, I have to cancel the existing forward contract. Yes or no? I have already agreed to buy $1 at the rate of 48.9 after 2 months. Now I have to cancel this contract to lag the receivable by 1 month. How do I cancel the contract? Simple. Originally, I have agreed to buy. That means to cancel the contract, I have to sell. Originally, I have agreed to buy, yes or no? That means here to cancel the contract to buy, I have to sell. Okay. So nothing but, so this is a deep concept I will be discussing during the fate of a contract, but now I'm explaining the concept. Simple. I agree to buy, yes or no? But now I'm not ready to buy. I want to lag my receivable by 1 month. That means bank has to sell this dollar to someone else. Yes or no? Bank has to sell this dollar someone else. Okay. So what is the rate? 25, 30, 25. Sorry. What is the forward rate after 2 months? 48.75, 49. So now I will give you a simple explanation. So already you have entered into contract to buy. So to cancel this contract, you have to sell. You have to sell means bank again has to buy. So what is the bid rate? What is the rate applicable? Bid rate is the applicable rate for cancellation. To cancel the already existing contract, to cancel the already existing buy contract, you have to sell. That means bank has to buy. The relevant rate for cancellation is bid rate. Okay. I will give again a clear explanation while discussing the fate of a forward concept right now. So that means bank is sir 49. Okay. Bank is buying at 48 point, sorry, but not bank. Customer is selling at, sorry, receivable. I'm sorry. Customer originally what agreed to sell. Customer originally what agreed to sell at the rate of, I'm sorry, it is receivable. Customer originally agreed to sell at the rate of 48.90. To cancel the contract, customer has to buy. Customer buy means bank sell. So that's why the relevant rate is ask rate. Ask rate. Okay. So what is ask rate? 49. So bank is selling at 48. So customer is selling at 48.9, buying at 49. That means he is losing 0.1 on each dollar. How many dollars? He agreed to sell $450,000. So that means he's losing 450,000 into 0.1, 45,000. So this is the special point. So clear, simple. I thought it is payable. I gave an explanation for payable initially, but it is receivable. Receivable means originally we agreed to sell dollar. So to cancel the contract, we have to buy dollar. So we are going to buy dollar means bank has to sell dollar. The relevant rate is ask rate for cancellation. Is it clear, Navina? Is it clear? Done. So in this question, the special point is charges for cancellation of a forward contract. Okay. See the smart 9 question. It is also a hedging question, forward contract. A company operating in Japan has today affected sales to Indian company. A company operating in Japan has today affected sales to an Indian company. The payment being due 3 months from the date of invoice. The invoice amount is 108 lakh N. At today's spot rate, it is equivalent to rupees 30 lakhs. A company operating in Japan has today affected sales to an Indian company. Sale to an Indian company. That means Indian company is importer. It has a payable. The payment being due 3 months from the date of invoice. The invoice amount is 108 lakh N. At today's spot rate, it is equivalent to rupees 30 lakhs. Okay. That means what is the present exchange rate? The present exchange rate is 108 lakh n divided by 30 rupees. 3.6 n. That means 1 rupee is equal to 3.6 n. Okay. Or you can take 30 lakhs divided by 108. Okay. But which calculation we should take depends upon the next part of the question. It is anticipated that exchange rate will decline by 10% over the 3 months period. And in order to protect the N payments, be careful. So from this, you have to understand how the exchange rate should be. In order to protect the N payments, the importer proposes to take appropriate action in the foreign exchange market. The 3 months forward rate is presently quoted as 3.3 N per rupee. That means the quote we have to take is per rupee. We have to take the quote per rupee. You are required to calculate the expected loss and to show how it can be hedged by the forward contract. How it can be hedged by a forward contract. Simple question. Okay. So understand the concept. There can be an exporter or importer, right? Exporter will have a receivable, importer will have a payable. Let us talk about the importer. Importer will have a payable. So that's why importer will expect the home currency to appreciate and foreign currency to depreciate. Yes or no? Importer will have a payable. So generally what importer expects is, for suppose I'm the importer. Okay, so the dollar is a popular currency. Let me take an example of a dollar. Okay. So right now the dollar value is 93 rupees. Yes or no? I'm the importer. If I have to import the product, I wanted to buy a product after 3 months. I want to buy. Now, what do I expect? I expect the dollar price to decrease. I expect the dollar price to decrease. I expect the dollar price to decrease means nothing but what? I expect the rupee to appreciate. Are you getting my point? After 3 months, I'm planning to import something from US. Now my expectation would be what? $1, but should become 1 rupee. Okay, $1 should become 1 rupee. Are you getting my point? So if I am the importer, my expectation will be the foreign currency should depreciate, home currency should appreciate. If I am the exporter, if I'm exporting something to US, then I will expect the dollar value to appreciate and rupee to depreciate. Okay, so if a payable or receivable is in the future, if a receivable is in the future, are you getting my point? That is a basic expectation. But fear. What is the fear? Fear will be if I am the importer, my fear will be the home currency may depreciate, may decline. Okay, foreign currency may appreciate. So this will be my fear. So in derivatives I have discussed. So hedging is a combination of expectation and fear. When there is a fear, then we go for a hedging. So what is the fear here? It is anticipated that exchange rate will decline by 10% over the 3 months. So that means here exchange rate might be given per rupee. If N is going to decline by 10%, why do I worry? I have a N payments. I have a N payments, foreign currency payments, and if a foreign currency is going to decline by 10% over the next 3 months, I will sit comfortably, right? Okay. But here my worry is what? Rupee is going to decline by 10%. And if you see the 3 months forward rate also, it is given per rupee. Okay. Clear? Are you getting my point? So what is the present exchange rate? 108 lakhs divided by 30 lakhs, 3.6 N. So what is expected exchange rate after 3 months? After 3 months, this exchange rate may decline by 10%. That means 1 rupee value may fall down to 3.24 N. As of now, I'm getting 3.6 N per rupee. But after 3 months, I may receive only 3.24 N per rupee. Okay. Expected loss if no hedging is done. If no hedging is done, what is the present worth of a goods? Present worth of a goods is 30 lakhs. What is the expected outflow after 3 months? Expected outflow after 3 months is equal to 108 lakh N divided by 3.24. Why should I divide? Simple. I'm converting N, but the quote is given per rupee. Okay, what is the expected quote after 3 months? 3.24. So 108 lakh divided by 3.24. Your expected outflow after 3 months will be 33.33 lakhs. That means for 30 lakhs worth of goods, you are going to pay 33.33 means what is expected loss? 3.33 lakhs. For suppose if you enter into a forward contract, if you enter into a forward contract, then what will be your outflow after 3 months? So forward rate is 3.3. So what will be your outflow? 108 lakh divided by 3.3, that is 32.73. So expected loss will be 2.73 lakh rupees. That means by entering into a forward contract, the loss can be reduced by zero 0.6 lakhs. Am I clear? Are you able to understand this? Done? Okay. Now let us move on to the next question. Next question is also a forward contract question. Okay. So after this question, okay, let us have a break. After break again, I will start. Okay. So following information relates to AKC Limited, which manufactures some parts of an electronics device which are exported to USA, Japan and Europe on 90 days credit terms. Here, manufacture some parts of an electronic device which are exported. Which are exported. Exported means what? Receivables. We are not exporting to a single country. USA, Japan and Europe on 90 days credit terms. Cost and sales information is given. Variable cost per unit rupees. Why it is given in rupees? Because we are manufacturing in India. Export sale price per unit 650 yen, $10.23, 11.99 euro. That means we are doing a billing in foreign currency. Receipt from sale due in 90 days. What are the receipts? Overall receipts is given. So that means overall receipt is given, sale price per unit is given. So that means we can find out the number of units. How do I get number of units? Total receipts divided by sale price per unit. Foreign exchange rate information is given. So here the special point is N slash rupees, US dollar slash rupees, euro slash rupees. All the quotes are given per rupee. Indirect quote is given. 1 rupee is equal to how many yens, 1 rupee is equal to how many dollars, 1 rupee is equal to how many euros. This is the special point. So that's why I have highlighted. Spot market rate is given. Spot rate. 3 months forward is given. 3 months expected spot rate. Expected rate after 3 months is also given. Advise AKC Limited by calculating average contribution to sales ratio whether it should hedge its foreign currency risk or not. Whether we should hedge foreign currency risk or not. We should advise by calculating the contribution to sales ratio. How do I get contribution? Simple. Sales minus variable cost is equal to contribution. How do we get contribution to sales ratio? Contribution divided by sales. Simple. Okay. If you go for hedging, what is the rate? What are the rates applicable? These are the rates applicable. 3 months forward rate. These are the rates applicable if you are going for hedging. For suppose if you are not going for hedging, then these expected rates after 3 months. Expected rates after 3 months would be applicable. Are you getting my point? Simple. First I should take. Okay, first I should take with hedging. Okay, second without hedging or whatever. Okay. If I'm taking with hedging, then these rates are applicable. Otherwise, what? These rates. Clear? So first, before proceeding, first let us find out the number of a units. Number of a units. So why we should find out the number of a units? Okay. Because we should find out the total variable cost. To find out the total variable cost, we need number of a units. So how do I get number of units? Sales divided by selling price. So 12,000, 10,000 and 8,000. These are the number of a units. And the special point in this question is, okay, special point in this question is identifying the quote, selecting the quote. You have a receivable, right? So that means you're going to sell foreign currency. You're going to sell foreign currency. That means banker buy foreign currency. The relevant rate is bid rate of a foreign currency, but bid rate of foreign currency is not given. So that's why 1 divided by ask rate of a rupee. Are you able to understand this? Okay. Now, if hedging is not done, for suppose hedging is not done, particulars Japan, USA, Europe total. First, let us take sales. Sales in foreign currency denomination. I cannot add 78 lakhs, 1 lakh 2,300, 95,920 because they are in different currencies. Yes or no? I should convert this into Indian rupees. Okay. To convert these into Indian rupees, what are the rates applicable? Simple. I should take ask rate of a rupee. Why, sir? Simple. I should sell foreign currency. That means bank should buy foreign currency. Relevant rate is bit rate of foreign currency, but quote is given per home currency. So that's why 1 divided by ask rate of home currency. What is the rate applicable? 2 point. First case, what is the rate applicable? 2.459. Okay, I think here the heading is not correct. It's okay, 2.459. Second one is if hedging is not done. First one is if hedging is done. First one is if hedging is done. If hedging is done, what is the rate applicable? Ask rate of a 3 months forward rate, 2.427. Second case, 1 lakh 2,300 divided by 0.0216. Sir, why we should divide? Again, there might be a confusion. Simple, I'm converting foreign currency, but quote is given per home currency. So that's why divide. What is the last case? 95,920 divided by 0.078. Clear? These numbers I can add. This is my total sale amount. Okay. Clear? Are you getting my point? Okay. Next, variable cost. Number of units into variable cost per unit. Okay. Clear? So my contribution, if hedging is done, what is my contribution? 26 lakh 8,719. I have to find out the contribution ratio. Average contribution to sales ratio means overall. So 26 lakh 8,719 divided by 1 crore 33 lakh 38,719. So what is the answer? 19.56 if hedging is done. What about the second one? Same manner. Instead of taking 3 months forward rate, we should take 3 months spot. Clear? If hedging is not done, then the rates applicable are 3 months spot. Clear? 2.459, 0.02156, 0.0179. Am I clear? So what is the contribution to sales ratio? 19.17% if hedging is not done. So tell me whether we should go for hedging or not. Higher the contribution to sales ratio, better it is. In first case, I'm getting a contribution to sales ratio 19.56. Second case, I'm getting 19.17%. Clear? Okay. So that means which is the better one? The company should go for hedging. Clear? Navina, I'm audible. Done. So with this, we have completed forward contract related questions. In the next session, I'm going to start money market hedging. After discussing money market hedging, I will be starting currency future and then currency option. And after discussing currency option, so one more concept, fate of a forward contract. After discussing fate of forward contract, we have a miscellaneous questions like currency swap question, which was recently tested in examination, and also Nostro count. It was also tested in the examination. Okay, clear? Navina. So next hedging technique, money market hedging. But before moving on to money market hedging, I want to confirm whether you have understood the rate selection or not. So we discussed about the spot rate and the forward rate, right? The spot rate is the rate applicable for now. Forward rate is the rate applicable for the future. Forward rate may be given outright or it may be given with spot rate with swap points. The swap points may be ascending, swap points may be descending. So swap points ascending means forward rate is quoted at premium. Hence, we should add the swap points to the spot rate. If you reduce the swap points, if you reduce the swap points from the spot rate, then there is a chance ask rate may become less than the bid rate, which is not at all correct. It is fundamentally wrong because ask rate can never be less than bid rate. Okay, so that's why. And next, forward rate. If swap points are descending, forward rate is at discount. Hence, reduce the swap points from spot rate. See the exchange rate selection. Foreign currency receivable. Exporter will have a foreign currency receivable. Okay. So rate selection can be done from the foreign currency perspective or from home currency perspective. For suppose if it is from foreign currency perspective, so customer is receiving the foreign currency, right? So that means customer sell foreign currency. Dealer buy foreign currency. The relevant rate is bit rate of a foreign currency. Yes or no? Sometimes quote may not be available for foreign currency. If a quote is not available for foreign currency, then what? 1 divided by ask rate of a home currency. You should understand these basics. From home currency perspective, customer selling foreign currency and buying home currency, yes or no? Buying home currency. That means dealer has to sell home currency. The relevant rate is ask rate of a home currency. If ask rate of a home currency is not available in the question, then what we do is 1 divided by bit rate of a home. So 1 divided by bit rate of a foreign currency. Here we take 1 divided by bit rate of what? Foreign currency. Am I clear? Are you able to understand? Okay. Now, the exchange rate selection. Exchange rate selection. If it is a foreign currency payable. If it is a foreign currency payable. Clear? So, foreign currency perspective. Customer buy foreign currency. That means dealer has to sell foreign currency. Relevant rate is ask rate of a foreign currency. So, ask rate of foreign currency. If it is not available, then what? 1 divided by bit rate of home currency. Okay. From home currency perspective, customer sell home currency, dealer buy home currency. Relevant rate, bit rate of home currency. If bit rate of home currency is not available, then what? 1 divided by ask rate of foreign currency. Okay, clear? And how to convert the amount? If the quote is available for currency which has to be converted, then multiply. Otherwise, what? Divide. Okay. In dealer problems, how the rate has to be selected in dealer problems. For suppose originally sold foreign currency. So to cover the transaction, dealer has to buy foreign currency. That means other dealer has to sell foreign currency. So the relevant rate to cover the transaction is ask rate of a foreign currency. If it is not available, 1 divided by bit rate of a home currency. Okay. Next, originally purchased foreign currency. To cover the transaction, dealer has to sell foreign currency. Okay. Other dealer has to buy foreign currency. The relevant rate is bit rate of foreign currency. So nothing but 1 divided by ask rate of home currency. Clear? So you have seen the purchasing power parity. Purchasing power parity theory, it is a theory of exchange rate determination which states that exchange rate adjusts so that identical goods cost the same in different countries. That is what I have told. The calculator price in India and US, same. Identical goods, that is calculator cost the same in different countries. It is based on the concept of law of one price. So 1 unit of foreign currency is equal to forward rate of 1 unit of foreign currency is equal to spot rate into 1 plus inflation rate of home currency divided by 1 plus inflation rate of foreign currency. Clear? So how do we get inflation rate differential? Inflation rate differential is equal to 1 plus inflation rate of home currency divided by 1 plus inflation rate of foreign currency minus 1. Minus 1. Okay. Clear? Interest rate parity theory. Interest rate parity theory. As per interest rate parity theory, the size of the forward premium or a discount should be equal to the interest rate differential between the two countries. Interest rate differential between the two countries. It is based on the assumption that the investment opportunity in two different countries will always be same. So 1 unit of foreign currency forward rate is equal to spot rate into 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency. How do I get interest rate differential? Interest rate differential is equal to 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency minus 1. This should be equal to forward premium or a discount. If it is not equal to forward premium or a discount, then there is a scope for arbitrage. Next, covered interest arbitrage. We have discussed this covered interest arbitrage yesterday's class. So if actual forward rate is equal to theoretical forward rate, that means it is correctly valued. It is correctly valued and there is no scope for arbitrage. If actual forward rate is greater than theoretical forward rate, the currency is overvalued. Sell forward, buy spot. Actual forward rate is less than theoretical forward rate. Currency undervalued. Buy forward, sell spot. Clear? Are you getting my point? So we have seen the forward contract in yesterday's class. Forward contract means it is one of the method of a hedging. A forward rate is agreed with the bank on a future date for buying or selling of a foreign currency. Forward rate is agreed with the bank today to sell or buy foreign currency on a future date. Thus, with predetermined rate of exchange, the risk of a fluctuation of outflow or the inflow is minimized. Yes or no? So there will not be any uncertainty because the rate is fixed as on today. So leading and lagging referring to adjustment refers to adjustment at the time of payment in foreign currency. Leading means it is a payment before the due date. Lagging means it is delayed payment post the due date. For suppose if the payment has to be made in 2 months, if I make a payment within a month, that is leading. If I delay the payment, if I lag, it is called as lagging. What is the next concept? Money market hedging. Shall we move on to this concept, money market hedging? Okay. With this question, I will explain you the money market hedging concept. So the money market hedging concept is simple. Okay. If you have a foreign currency receivable, okay. So what we are going to do is we are going to borrow the present value of our exposure. For suppose I am having the dollar receivable. Donald Trump has purchased my AFM cash. He agreed to pay after the end of Iran and Israel war. Okay. Now I have a receivable, foreign currency receivable, dollar receivable. Yes or no? Dollar receivable. Okay. Now this fellow Donald Trump will pay the amount for AFM class in the future. Yes or no? That means there is an uncertainty. So there are two uncertainties. First uncertainty, he may or may not pay. He may or may not pay. That is a default risk that we are not going to discuss in this chapter. We are discussing only the foreign currency risk in this chapter. What is the foreign currency risk? Foreign currency risk is, so we assume that there is no default risk. Donald Trump will pay on time, which is actually not a fact. Okay. So for suppose Donald Trump, he is paying on time, but still I have an uncertainty in my cash inflow. Why? The dollar rate may not be same in the future. Yes or no? The dollar value may increase or decrease. So to reduce this uncertainty, I have a concept of forward contract. So what is this forward contract? I will enter into a contract as on today to sell $1 because I'm going to receive dollar at a pre-agreed rate in the future. What is the second concept? Invoicing in the home currency. We do not have any practical questions on this concept. Invoicing in the home currency. Invoicing in the home currency means what? That is what we actually do. If you purchase the class in BCCA app, okay, you have to pay in INR. So no, billing is done in home currency. So that's why we do not have any foreign currency risk. But on the request of a Donald Trump, we made a billing in foreign currency. Okay. So in that case, we have a foreign currency risk. But if you want to reduce that foreign currency risk, we have to do a billing in home currency. Okay. So that is one more hedging technique, billing in home currency for forward contract. Okay. And next one, leading. Leading means what? So Donald Trump, he agreed to pay the amount for AFM class after 3 months. Okay. But that fellow is a worst fellow, so that's why I wanted to take the amount as on today. What I will do is Donald Trump, the cost of a AFM class is $150. But if you pay immediately, okay, I will give a cash discount to pay $120 as on today. Okay. Pay as on today $120. So this is leading. This is leading. Before the due date, I'm collecting the amount. I'm collecting the amount before the due date. Are you getting my point? Okay. So lagging means what? Delaying the receivables. Delaying the receivables. Okay. Apart from that, money market hedging. What is this money market hedging? Money market hedging is, for example, after 3 months, I have a $150 receivable. So what I will do is, I will borrow the present value of a $150 in US bank. Okay, in US Citibank, I will borrow present value of $150. Present value of $150. Let us assume the present value for $150 is equal to $120. Okay. So do not expect me to write these numbers because these are simple numbers. Donald Trump purchased AFM class. What is the price? $150. He agreed to pay after 3 months. So what I am doing is, in money market hedging, what I will do is, I will borrow the present value of $150. Let us assume the present value for $150 is equal to $120. Okay, I will borrow in the Citibank. Clear? So $120. So what I will do with this $120, I will convert this $120 into Indian rupees as on today. So as on today, the spot rate is around 93 rupees. Yes or no? That means what is the amount I'm going to get? 120 into 93. 11,160. So now this 11,160 rupees, I will deposit in Union Bank. Okay, Union Bank or a State Bank of India or ICICI Bank in India. Okay, so after 3 months, I will get 11,160 plus interest. Yes or no? Clear? Now, today itself I will have a clarity how much amount I am going to receive in next 3 months. Yes or no? In next 3 months, how much INR I am going to get. So this will be known as on today. Sir, you are forgetting one thing. You have taken a loan in US. Who will repay that loan? I have taken a loan of present value of exposure. Yes or no? Present value of $150. In 3 months, the loan which was taken in US with interest will be equal to $150. How do I pay that $150? Simple. Okay, Donald Trump will pay $150 and with that I will pay the loan. I need not worry about the loan which is taken in US. Yes or no? Okay. So this is a money market hedging. So simple money market hedging. If it is receivable, I borrow the foreign currency. If I have a foreign currency receivable, I borrow the foreign currency. For suppose if it is payable, if it is payable, okay. So for suppose, so Sai Charan has purchased a class from Donald Trump. Okay, how to torture public. Okay, so here Sai Charan has to pay $150 to Donald Trump. To reduce the risk, what Sai Charan will do is he has to pay $150 after 3 months. But after 3 months, dollar value may increase or decrease. There is uncertainty. So what he will do is he will deposit the present value of exposure. He will deposit the present value of exposure. Example, $120 will be deposited in US bank. So that the $120 with interest will become $150 after 3 months. Okay, so after 3 months, $150 is withdrawn from the bank and will be paid to that Donald Trump. Okay, clear. But to deposit $120 as on today, he need 11,160 rupees. Yes or no? That means in India he will borrow 11,160 rupees. Okay, in India he will be borrowing 11,160 rupees. So this borrowing he will be paying after 3 months. But now itself, what will be known? What is the outflow after 3 months? Because the loan taken is 11,160. If you add interest, you will get the outflow after 3 months. Are you getting my point? See the concept. Money market hedging, it is a technique of covering the foreign exchange exposure by creating offsetting positions in domestic and foreign money markets. Offsetting positions. Example, if there is a receivable, borrow foreign currency, deposit home currency. Offsetting position. Okay. If it is a foreign currency payable, deposit present value of a foreign currency and borrow home currency. Purpose to hedge future payments or receipts. Result exchange rate is eliminated. Exchange risk is eliminated. Exchange risk is eliminated. Money market hedging for foreign currency exposure. Exposure type currency borrowed, currency deposited. For suppose if it is payable, then what? If it is payable, foreign currency, present value of exposure, foreign currency, deposit because you have a payment, yes or no? Okay, clear? Okay, deposit. This is simple. Okay, so after getting married, if you have a kids, what you will do is you start depositing, you start saving the money, yes or no? And when you have a future commitment, you start saving the money as from today. So likewise here, so when you have a payables, what you are going to do is deposit the present value of a exposure. But to deposit this present value of exposure foreign currency today, you should borrow the home currency. Clear? If it is receivable, if it is receivable, so currency borrowed is foreign currency. You borrow the foreign currency, present value of exposure, and the deposit home currency. Clear? Done. So let me explain with the question. An Indian exporting firm means receivable, yes or no? Rohit and Bros would be covering itself against a likely depreciation of a pound sterling. If it is an exporting firm, they expect the foreign currency to, they expect the foreign currency to, no, so an Indian exporting firm, receivable. Generally, what customer will expect the foreign currency to appreciate. Foreign currency to appreciate because he is having a receivable. Yes or no? But he is worried about the likely depreciation of a pound sterling. That's why he would be covering. That is the important sentence is question. Would be covering itself against a likely depreciation of a pound sterling. Nothing but he is thinking about the hedging. Hedging question. This is a hedging question. Would be covering itself against a likely depreciation of a pound sterling. So that why that point is highlighted because at the end, what should the exporter do? That's it. Question. Nowhere they have mentioned what it is arbitrage question or a money market hedging question or a currency option or a currency future. Nowhere they have mentioned. Okay, so that's why you have to identify this question is for money market hedging. How can we identify? Would be covering itself against likely depreciation of a pound sterling. So the following data is given: receivable 5 lakh pounds, spot rate 56 rupees per pound, payment date 3 months, 3 months interest rate India 12% per annum, UK 5% per annum. What should the exporter do? What should the exporter do? Simple question. But the common mistake the students will do is here the spot rate is given. Payment date 3 months is given. 3 months interest rate India and UK. Interest rates in India and UK are given. So the mistake student will do is immediately what they will do is they will calculate the forward rate using the IRPT, interest rate parity theory. So that means spot rate into 1 plus interest rate of home currency divided by interest rate of a foreign currency. So they will find out the theoretical forward rate. Okay, theoretical forward rate calculated. Next to what? Next to what? So they might be thinking like this question is an arbitrage question. To know whether there is a scope for arbitrage or not, the actual forward rate is also required. But in the question, actual forward rate is not given. If it is given, then we compare theoretical forward rate and actual forward rate and we decide whether there is a scope for arbitrage or not. Here it is not given. So that means this is not an arbitrage question. This is a hedging question. What should the exporter do? Simple. Note down the answer. Smart 10. Smart 10 means it is not for practice. Smart 10. Smart 10. Okay, what is the first point? Smart 10. First point. Exposure. What is exposure? Exposure 5 lakh pounds. Clear? 5 lakh pounds receivable. Now, so money market hedging. Money market hedging. Step 1. Money market hedging. Step 1. So we have a receivable, right? So receivable means first step borrow present value of a exposure. How do I get the present value of exposure? We already discussed the time value of a money. We do discounting, yes or no? 5 lakhs divided by. So where are we going to borrow? In UK. What is the interest rate in UK? 5% per annum. But we need money only for 3 months. Okay, because receivable is after 3 months. 5 lakhs divided by 1 plus 0.05 into 3/12. So the amount is 827 pounds. Step 2. Step 2. Okay. What is the step 2? Sell pounds and receive. Sell pounds and receive 493,827 into what is the spot rate? 56. What is the spot rate? 56. So 493,827 into what? 56. So what are the numbers? Sell pounds and receive. Sell pounds and receive. 2 crore 76 lakh 54,321 rupees. 2 crore 76 lakh 54,321 rupees. Step 3. Step 3. Are you getting my point? So Are we going to keep this money idle? No. Deposit 2 crore 76 lakh 54,321 rupees for how many months? For 3 months at the rate of 12% per annum. For how many months? So for 3 months. Deposit 2 crore 76 lakh 54,312. 312 or 321 at the end? 2 crore 76 lakh 54 321 or 312? 493 827 into 56. 312. Charan, day by day you are becoming like a father of clerical mistakes, like father of economics. 2 crore 76 lakh 54,312. Okay, for 3 months at the rate of 12% per annum. Clear? Next step 4. Wait for 3 months. And then what? Receive after 3 months. First, after 3 months, receive 5 lakh pounds. Receive 5 lakh pounds from customer and pay the loan taken in UK. Yes or no? After 3 months, receive 5 lakh pounds from customer and pay the loan taken in UK. Step 5. After 3 months, receive 5 lakh pounds from customer and pay the loan taken in UK. What is step 5? Okay, step 5. We deposited 2 crore, right? Withdraw deposit and receive. How much are we going to receive? 2 crore 76 lakh 54,312 plus 2 crore 76 54,312 into 12% into 3 by 12. Okay? Yes or no? So what is the inflow? What is the inflow? 2 crore 76 lakh 54,312. 2 crore 84 lakh 83,941 rupees. This is the final answer. That means today itself, okay, I will be knowing what is my inflow after 3 months. Yes or no? So after 3 months, I'm going to have an inflow of 2 crore 84 lakh 83,941. Clear? Okay. Done. Ignore the answer given in the material question bank. Note down the answer. 2 crore 84 lakh 83,941 will be my inflow. Simple concept. Are you able to understand this? This is a money market hedging. Okay, how the borrowing in foreign currency paid? Simple. I received 5 lakh pounds from my customer and paid the loan taken in UK. That's it. Okay. Why this question is smart? Because in Super 7, that is a question for practice. So receivable and payable both are given, and it is a money market hedging. In previous question, one-way quote is given, but in next question, two-way quotes are given. And in previous question, only one interest rate is given, but in the next question, the deposit rate and borrowing rate both are given. So that's why this question is for practice. So this one question is enough for money market hedging concept. Only one question. Columbus Surgical Inc. is based in US. Has recently imported surgical raw materials from the UK. Company is in US. It has imported raw materials from UK. Why this question is for practice? Because there is no Indian currency in this question. Okay. Company is in US and it has imported surgical raw material from UK. has been invoiced for 4,80,000 pounds payable in 3 months. Company is in US, but has been invoiced for 4,80,000 pounds payable in 3 months. You know that US currency is dollar. What about UK currency? Pound. Okay. So the billing is done in pounds, but company is in US. That means they have a foreign currency risk. Three conditions. Billing is done in foreign currency, cross-border transaction, payable or receivable is in the future. It has also exported surgical goods to India and France. It has also exported surgical goods to India and France. The Indian customer has been invoiced for 1,38,000 pounds payable in 3 months. So totally unfair. So they have exported goods to India, but the billing is done in pounds, not in INR. Okay. So the Indian customer has been invoiced for 1,38,000 pounds payable in 3 months, and the French customer has been invoiced for 5,90,000 euro payable in 4 months. So they have mentioned payable in 3 months, payable in 4 months. You might be thinking like these are payables. No, exported goods to India. Exported goods to India means what? Receivable. Receivable to the US company. 1,38,000 in 3 months, 5,90,000 euros in 4 months. Current spot and forward rates are as follows. Spot rate and forward rates are given. For pound divided by US dollar, 1 US dollar is about how many pounds? You know that dollar value is less than the pound value. Okay, so the quote is mentioned correctly. So what is given? Pound divided by US dollar. That means 1 US dollar is equal to how many pounds? 3 months forward, US dollar by euro. 1 euro is equal to how many US dollar? Spot rate is given, 4 months forward rate is given. Current money market rates are as follows. Current money market rates are as follows. Nothing but interest rates. UK 10, 12. 10 and 12 means what? 10 means, okay, always remember one point. Deposit rate is less than the borrowing rate. So 10 is the deposit rate, 12 is the borrowing rate. France 14 and 16. What is this 14? Deposit rate and 16 borrowing rate. USA 11.5, 13. Okay, clear? So borrowing rate is always greater than deposit rate. So they will not mention. Yes or no? Simple logic. If you want to borrow money from the bank, the rate applicable, interest rate applicable will be 10, 12, 18, 20, 24. Yes or no? But whereas if you want to deposit the money, okay, if you are keeping your money in savings account, you will get 4% interest. Even if you make fixed deposit, you will get 7% per annum around. So that means deposit rate is always less than what? Borrowing rate. You as a treasury manager are required to show how the company can hedge its foreign exchange exposure using forward market and money market hedge and suggest which the best hedging technique is. Which the best hedging technique is. So let me start. So question number Super 7. Super 7. Okay. First of all, let me write down the exposure. What is my exposure? First payable. I have imported the surgical raw material from UK. What is the payable? 4,80,000 pounds. Okay. How many months? 3 months. What about the next one? Receivable. 1,38,000 pounds. Okay. 3 months. See this unfair. Okay. Even on books also, we are what displaying this unfairness. Okay. So the billing is done in pounds for Indian customer. Clear? Next, receivable again. What is the receivable? 5,90,000 euros. How many months? 4 months. Clear? Now my point is receivable. Okay. 5,90,000 euros. 4 months. For suppose payable 4,80,000 pounds and receivable from Indian customer is also 4,80,000 pounds in 3 months. Then what? We need not do any hedging. Why? Simple concept. Payment 4,80,000 pounds in 3 months. Receivable is also 4,80,000 pounds in 3 months. So no hedging is required. But here We are going to receive only 1,38,000 pounds. Yes or no? That means what is the net amount? We do netting. What is the netting? 3,42,000 pounds is the net payable. Net payable amount is 3,42,000 pounds. That means we should do a hedging for 3,42,000 pounds payable and 5,90,000 euros receivable. Okay. So first let us do for payable. Net payable. What is the net payable? Net payable 3,42,000 pounds. Net payable 3,42,000 pounds. Net payable 3,42,000 pounds. Okay. So first option is what? Forward contract. First option is what? Forward contract. Okay. What is the 3 months forward rate? 3 months forward rate is given, right? 3 months forward rate. So selection of a rate. Be careful. So 3,42,000 pounds payable or a receivable? Payable. I have to pay 3,42,000 pounds. Okay. That means customer buy pound, bank sell pound. What is the relevant rate? Ask rate of a pound. Ask rate of a pound is available in the question or not? No. So then how do I get ask rate of a ask rate? How do I get ask rate of a pound? Simple. 1 divided by bit rate of dollar. That means the rate applicable is 0.9520. Okay. So 1 divided by 0.9520. Clear? So forward contract. Under forward contract, outflow is equal to 3,42,000 into 1 divided by 0.9520. Yes or no? What is the answer? 359 $244. This is the outflow if I enter into a forward contract. Are you able to understand the rate selection? Now the B part. What is the B part? Money market hedging. Money market hedging. So next concept, money market hedging. Okay. So money market hedging, first step. Step 1. Deposit. This time I have a payable, right? Deposit present value of a exposure. Deposit present value of a exposure. What is the exposure? 3,42,000 divided by 1 plus. What is the interest rate? What is the interest rate? 10%. Point 1. Deposit present value of exposure. Where should I deposit? In UK. In UK, what is the deposit rate? In UK, the deposit rate is 10%. So 1 plus 0.1 into 3 by 12. So the amount to be deposited is 3,33,658.54 pounds. Why should I deposit this 3,33,658.54 pounds? If I deposit this amount in next 3 months, that amount will be equal to 3,42,000. So what I will do is I will withdraw this deposit 3,42,000 pounds and pay the supplier. I add 1,38,000 to be received from Indian customer and I will pay the entire 4,80,000 pounds to the supplier. Okay. Step 2. Step 2. So to deposit present value of exposure, we need to buy pounds, yes or no? Okay. So dollars required to buy 3,33,658. 0.54 pounds. Dollars required to buy 3,33,058.54 pounds equal to. So in the spot, I have to buy pound. Customer buy pound means bank. Sell pound. The relevant rate is ask rate of a pound, but ask rate of a pound is not there. So that's why 1 divided by bit rate of a dollar. So what is that? 0.9830. So the calculation is 3 lakh 30 658.54 divided by 0.983. 3,39,428.83 dollars. Okay, so that means these are the dollars required to, dollars to be borrowed, actually dollars to be borrowed. Step 3, actually what borrow. In the second step itself, we can write dollars to be borrowed to buy 3,33,658.54 pounds. Yes or no? So after how many months? 3 months. After 3 months, withdraw deposit and receive. After 3 months, withdraw the deposit and receive 3,42,000 pounds and add 1,38,000 pounds received from Indian customer and pay the supplier how much? And pay the supplier 4,80,000 pounds. After 3 months, withdraw the deposit and receive 3,42,000 pounds. Add 1,38,000 pounds received from Indian customer and pay the supplier 4,80,000 pounds. What about the next step? Okay, so we have our taken loan in US, right? Okay, outflow on payment of the loan outflow on repayment of a loan. Outflow on repayment of a loan is equal to, what is the outflow on repayment of a loan? 3,39,428.83 plus 3,39,428.83 into 13%. What is the borrowing rate in US? Borrowing rate in US is 13% into how many months? 3 by 12. So the answer is 3,50,460 dollars. So this is the final answer. So tell me, which is the best forward contract or a money market hedging? In forward contract, the outflow is 3,59,244. But whereas under money market hedging, the outflow is 3,50,460, which is less than what? Okay, forward contract. Clear? So the decision is, so money market hedging is the better option for payables. In the same manner, you have to do for what? Receivable. In the same manner. So pause the video and solve this. You do it for receivables. Okay. See the next concept, currency future. Currency future. So only one question. If you learn this one question conceptually, so you will get 6 to 8 marks. Currency future. So it is considered as one of the toughest topic, but it is simple. Currency future. You already know the futures concept, right? Futures concept. So what is the currency future? A future contract is an agreement between two parties that commits one party to buy and one party to sell an underlying asset at a specified price at a future date. An underlying asset at a specific price at a future date. So commits one party to buy and commits one party to sell. The agreement is completed at a specified date by how the contract is closed by physical delivery. For example, in futures contract, I took a long position. Long position means a buy position. I have agreed to buy. So what I will do is I will take a delivery of a currency or a stock or a commodity in the future. Okay. You know that there can be a stock future, index future, currency future, or a commodity future. Okay. Physical delivery. And next what? Cash settlement or offset prior to the expiration date. Offset prior to the expiration date means, for suppose, you know the concept of initial margin, maintenance margin, variation margin. Initial margin is a security deposit and maintenance margin is the minimum balance to be maintained in the account. So whenever the balance falls below the maintenance margin, okay, you should bring back the balance to the initial margin. If you're not bringing back the balance to the initial margin, the futures contract will get automatically closed. Okay. Next, cash settlement means what? In derivatives chapter, we have already seen. For suppose I'm taking a long position as on today on the maturity to close the contract, I will take a short position. I will find out the profit or a loss. So only that profit or a loss is settled between the persons who have taken a long position and short position. So that is a cash settlement. Generally, in books, in classroom, we do a cash settlement. We do a cash settlement in the classroom. Okay, that means in futures, if the customer has taken a long position, if a trader has taken a long position in futures contract, on the maturity to close the contract, short position will be taken. Okay, clear? So now the exposure foreign currency receivable. If what position has to be taken? Generally, students might commit a mistake while choosing the position. While choosing the position, student might commit a mistake because in stock it is easy. In stock, either we buy or sell. If you want to buy, you take long position. If you want to sell, you take a short position. But whereas in Forex, you will get confused because of one single reason. The quote may be given per unit of home currency or quote may be given per unit of a foreign currency. Okay. Quote may be given per unit of foreign currency or quote may be given per unit of a home currency. So there can be two. So there can be two scenarios. But whereas in case of a stock, what? In case of a stock, either long or a short. Either you buy or sell. If you want to buy long position, if you want to sell short position, that's it. But whereas here, okay, the quote can be per rupee, I mean per home currency or per unit of foreign currency. So that's why you have to think from the perspective of the quote, which position has to be taken. So either in options or a futures. Remember this point. This point is important for futures and options. In futures and option, you know the options that there are two: call option, put option. Call option means right to buy, put option means right to sell. Okay. So when do we choose a call option or a put option? So first of all, you should see the quote. First of all, the quote is given per dollar. Then what? You should think from the perspective of a dollar. What I have to do with the dollar? Have to buy the dollar or sell the dollar? If I have to buy the dollar, long position. If I have to sell the dollar, short position. Okay. So likewise, if a quote is given per rupee, then you have to think from the perspective of rupee. What you are going to do with rupee? Are you going to buy long position? If you're going to sell, short position. Clear? So quote given per unit of foreign currency. Likewise, call option and put option also same. If a strike price is given per foreign currency, per unit of foreign currency, and if you want to buy, call option. If you want to sell, put option. Clear? You should think from the perspective of a quote given. So that is the important point. Once again, I'm reminding. So see the quote. So quote is given per which currency? From that perspective, you have to think. So for suppose quote is given per unit of foreign currency. Let us say foreign currency. Exporter will have a foreign currency receivable, yes or no? So what the exporter is going to do? He is going to sell foreign currency. And the quote is also given per unit of foreign currency. That means the current position is short position. And on maturity, he will be taking a long position. Clear? Quote given per unit of home currency. Quote given per unit of home currency. The current position is long position. Why, sir? Simple. Foreign currency receivable. That means foreign currency I have to sell. But here the quote is given per unit of home currency. You should think from the perspective of a home currency. Foreign currency sale means home currency buy. That means current position, long position per home currency, and on maturity you take a short position. Am I clear? If the exposure is foreign currency payable, then importer has to buy the foreign currency. Yes or no? So that's why if a quote is given per unit of foreign currency, current position is long position and on maturity, short position. If a quote is given per unit of home currency, then what? Foreign currency buy means home currency sell. So that's why current position, short position, and on maturity you take long position to close the contract. So I hope you understood these positions. Even if there is a little confusion, let us see this question. With this question, you will get a clarity. Okay. So generally students ignore these kind of a concepts, but these are the questions being asked in examination, advanced questions. EFD Limited is an export business house. Export business house means receivable, foreign currency receivable. The company prepares an invoice in customer's currency. So that's why we are discussing this question. The company prepares invoice in customer currency means foreign currency. It debtors of US dollar 1 crore is due on April 1, 2015. Market information as on January 1, 2015. We are in January and the receivable 1 crore due on April 1, 2015. Clear? Are you able to understand this point? Now, so let me clear. You know the foreign currency risk, uncertainty in cash inflow or cash outflow arising due to the foreign exchange rate fluctuation. Okay. So when do we have a foreign currency risk? Cross-border transaction. You can see here export, cross-border transaction. Billing is done in foreign currency. Billing is done in foreign currency, and the receivable or payable is in the future. Receivable or payable is in the future. Clear? Market information as at January 1, 2015 is market information as at January 1, 2015 is exchange rates are given spot 1 month forward, 3 months forward. Currency future contract size is given, contract size 1 month, 3 month. Initial margin 1 month margin, 3 months margin. Interest rate in India 6.57%. Which of the following methods would be most advantageous to EFD Limited? Using forward contract, using currency future. Okay, and next, not hedging the for currency risk, not hedging the currency risk. Clear? Done. So let us start this question. First one, using the forward contract. First one, using the forward contract. What is the question number? Super 8. Super 8 means this is the 8th question to be practiced. The most important point to clear CA final is practicing all questions. Each and every question is not practical. It is impossible. Okay. And at the same time, referring all the questions is not advisable. Just going through the question and answer is not advisable. So the correct strategy is few questions are meant for referring and few questions are meant for practice. You have to make that segregation. So in CA final AFM question bank, I have made it. Okay. So this is the 8th question to be practiced. Nothing but by the time you practice the 8th question, you came to the currency futures concept. Currency futures concept. If you practice each and every question, you might end up with money market hedging. Okay. So that's why 8th question. First part. What is the first part? Forward contract. So we have a receivable, right? We have a receivable. Inflow is equal to. So what is the receivable amount? 1 crore dollar. 1 crore US dollar. Okay. So when it is receivable on April 1st, we are in January. That means 3 months. So what is the rate applicable? 3 months forward rate is applicable. Clear? So quote is given per dollar or per INR? Per INR. It is not per dollar. Okay. So now $1 is equal to 93 rupees. Approximately. Yes or no? Still we are doing too much. Okay. If in case $1 is equal to 0.016129, then what? Okay. So then we are going to show the real attitude, right? So inflow 1 crore, 1 crore divided by or multiply. Navina, divided by or multiply. So we are converting the dollar. Quote is given per rupee. So that's why divide 1 crore divided by 0. 0.016 129. 0.016129. Very good, Amma. So what is the amount? 62 crore. 62 crore. 62 crores 1,240. Why this is 62 crores 1,240 is the inflow. Next B. So before moving on to B, let me solve the C part. What is C part? No hedging. No hedging. No hedging means what? No hedging means what is the rate applicable? The rate. So we have to apply is the expected spot rate on the maturity. What is the expected spot rate on the maturity? 0.016136. So that means inflow is equal to 1 crore divided by 0.016136. What is the answer? 61 crore 97 lakh 32,276 if no hedging is done. Clear? Next, currency future. What is the B part? Currency future. This is the special point in this question. You have to understand this concept. Do not by heart. Currency future. Simple concept. You know, in futures we have a contract size. The contracts are standardized. Currency futures. Okay. So currency futures. See the information. What is the 3 months future rate? 3 months future rate is 0.016118. So tell me which is the relevant position. First, tell me which is the relevant position, long position or a short position. So please let me know. What is the 3 months future rate? 3 months future rate is equal to 3 months future rate. What is the 3 months future rate? 1 rupee is equal to, sorry, 1? No. 1 rupee is equal to 0.016 $118. What happened? 0.016 $118. Okay. Clear? What is exposure? Receivable. Exposure, receivable. I told you that if a quote is given per rupee, you should think from the perspective of a rupee. You should think from the perspective of a rupee. Clear? Okay. So what I am going to do with rupee? I have a dollar receivable, yes or no? Okay, very good, Navina. I have to buy, so I have to sell dollar. Sell dollar means what? Rupee buy. Okay, so what is the position? Relevant position. The relevant position is long position. Okay, actually I wanted to write, but the pen is troubling me, so that's why I'm just no problem. So this is because of overheat. So what is the position? Long position. Position, long position. Why the long position? So dollar receivable. That means I'm going to sell dollar. Sell dollar means what? Buy rupee. I should think from the perspective of a rupee because quote is given per rupee. So that's why take a long position of a rupee. Okay, one more thing, sir. Why long position of a rupee? You can think from the perspective of, I mean, you can think from the other side also. Other side in the sense, here the person is an exporter. Exporter expect the dollar to appreciate, rupee to depreciate, rupee to depreciate. This is expectation. But what is the fear? Fear is dollar may depreciate and rupee may appreciate. Rupee may appreciate. So this is the fear. So hedging is a combination of expectation and fear. Yes or no? When fear starts, the investor thinks about hedging. Yes or no? So that means his fear is rupee may appreciate. Rupee may appreciate means he has to take a long position for rupee. Clear? So that is what he is taking here. Next, you have to find out the number of contracts required. Be careful here while finding out the number of contracts. Number of contracts. What is the receivable amount? 1 crore. How many contracts we should take a long position? For how many contracts we should take a long position? Simple. 1 crore divided by 0.016. 1 is missing. 0.0161 8. Here 1 is missing. So 1 crore divided by 0.016118. First, you should convert this exposure dollar into rupees because the contract size is given in rupee. Because quote is given in rupee, so obviously contract size will also be in rupee. Yes or no? So that's why be careful while calculating a number of contracts. We cannot straight away divide 1 crore with 2 crore 48 lakh 16,975. Okay, clear. So we should take what? We should consider what? Rupees. We should convert this 1 crore into rupees. 1 crore divided by 0.016018. 1 crore divided by 0.016118. So how many contracts? 25 contracts. So what is the initial margin? Initial margin we should consider, which is given for how many months? 3 months. Because the maturity is after 3 months, right? So that means 25 into 22,500. So 5,62,500 is the initial margin, and this initial margin is an expense. It is an interest, sorry, it is a security deposit. So that's why I have to consider only the interest on a margin. What is interest on a margin? Interest on a margin is equal to 5,62,500 into 7% into 3 by 12. Clear? Okay, done. 9844. Interest on a margin. Done. Okay. Now see, let us find out the profit or a loss on a future. So we have taken a long position at the rate of 0.016118. So we have taken a long position at the rate what? 0.016118. By the time we take a short position, what is happening in the future? The currency future rate on maturity is currency future rate on maturity. This is the rate relevant for closing the contract. If this rate is not given, then we consider this 0.016136 for closing the contract. Okay. So here I should consider what? 0.016136 for closing the contract. Clear? So taking a long position at the rate of 0.016118, short at the rate of 0.016134. So this is the profit per 1 rupee. What is the profit per 1 rupee? Profit per 1 rupee is equal to 0.000016 dollar. Okay. So total for how many contracts I took a long position? Total I took a long position for 25 contracts, and the each contract size is 2 crore 48 lakh 16,975 into what is the profit per 1 rupee? 0.000016 dollar. So overall my profit here one thing is missing. Okay, if you multiply this, you will get, if you take this total 0.000016 into 2 crore 48 lakh 16,975 into 25. What is the number you are getting? 98. 9844. What is this 9844? 9. I'm asking about this calculation, Charan. 0.000016 into 2 crore 48 lakh 16,975 into 25. 99 $7. This is in dollar actually. Understand the point. Once again, I'm coming from the beginning. In the right time, this pen is troubling me. So first of all, understand the position. Exposure receivable. What is the receivable amount? $1 crore, but the quote is given per rupee. So we should think from the perspective of a rupee. So dollar sell means rupee buy. So that means I have to take a long position per rupee. So relevant position is long position per rupee. So I have to find out the number of a contracts. How do I get number of a contracts? Exposure divided by contract size. But here I cannot divide directly the exposure with contract size because exposure is in dollars, contract size is in rupees. So that's why, how do I find out the number of a contracts? 1 crore divided by 0.016118 divided by 2 crore 48 lakh 16,975. You will get the number of a contracts. So that means for 25 contracts, I should take a long position. What is the initial margin payable? 22,500 into 25 contracts, 5,62,500. But this 5,62,500 is not an expense, it is a security deposit. So we have to consider only the interest on this margin. What is interest rate applicable? 7%. So 5,62,500 into 7% into 3 by 12. So this is an expense we are incurring due to the future contract. Now comes the crucial part. What is the crucial part? Finding out the profit or a loss on closing the future contract. Finding out the profit or a loss on closing the futures contract. Simple. I'm taking a long position at the rate of 0.016118. So to close this contract, I should take a short position at the rate of 0.016134. What is the benefit I'm getting per each rupee? The profit I am getting per 1 rupee is $0.000016. Okay. So I have to find out the total profit on futures contract. How many contracts I have entered? I have entered into 25 contracts and each contract size is 2 crore 48 lakh 16,975 into what? $0.000016. So I will get $9927. Okay, so this 9927 is in dollars. So be careful, this has to be converted into INR. This has to be converted into INR. To convert this into INR, divided by what is the rate on maturity? 0.016136. This is missing, be careful. So overall my profit on settling the futures contract is 6,15,195. Am I clear? Done? Okay. So inflow at the end. I will sell my $1 crore in the market. So what is the amount I'm going to receive? 1 crore divided by 0.016136. This is the inflow at the end of the contract on selling $1 crore. Apart from this, I'm getting a profit on futures minus interest on margin. So this is my total inflow under futures contract. Okay. So there are two clerical mistakes. 1 crore divided by 0.016118. Okay. And the total profit on futures contract is 0.000016 into 2 crore 48 lakh 16,975 into 25 divided by 0.016136. Am I clear? Done. So which is the best option? Futures option would be most advantageous as the inflow is the highest. Clear? Done. So this is the currency futures question. See the next concept, currency future. Currency future. In the last class, I have explained currency future, but because of some technical issues, I was not satisfied with the class. So that's why I'm recording again the currency futures concept. So currency futures we can use for hedging. What is the meaning of hedging? Hedging means reducing the risk. Okay. So already we discussed the futures concept in derivatives. In derivatives, futures we take two positions: long position, short position. Long position means buy position, short position means sell position. Short position means sell position. Okay. A future contract is an agreement between two parties that commit one party to buy and one party to sell an underlying asset at a specified price at a future date. The agreement is completed at a specific date by physical delivery, cash settlement, offset prior to the expiration date. Generally, in classroom questions, the futures contract are settled by the cash settlement. Nothing but we take, for suppose, if we take a long position as on today on the maturity to close the contract, we take a short position. If we take a short position as on today to close the contract, we take a long position on the maturity. Okay. So in Forex, okay, you will be little confused. Why, sir? Because in derivatives, we can have a two expectations. There can be two expectations. One is the price may increase, second the price may decrease. If the investor is expecting the price to increase, he will take a long position. If the investor is expecting the price to decrease, he will take a short position. Simple. So that is simple. What a position has to be taken in the market, there it is simple. But whereas in Forex chapter, okay. So while selecting a position, you have to be careful. Why? Because the quote may be given per unit of foreign currency or quote may be given per unit of a home currency. If a quote is given per unit of home currency, then you should think from the perspective of a foreign currency. So what are you going to do with foreign currency? For suppose if you are an exporter means you will have a foreign currency receivable. That means in the future you have to sell the foreign currency. So that's why the current position is short position. But if the quote is given per unit of home currency, then in your exporter, you have a foreign currency receivable, but you should think from the perspective of home currency. Foreign currency receivable means you have to sell foreign currency. That means buy home currency. So current position is long position and on maturity short position. And if it is foreign currency payable and you are the importer, you have to buy the foreign currency and sell home currency. If a quote is given per unit of foreign currency, take a long position. If a quote is given per unit of home currency, take a short position as on today. So of course on maturity you take what? An opposite position. An opposite position. Okay. Clear? Now let me explain this concept with a question. Currency futures question. So this one question is enough to understand the concept. This one question is enough to understand the currency futures concept. So after currency futures question, without wasting time, let us move on to the currency options question. See the Super 8 question. Super 8. EFT Limited is an export business house. Exporter. The question is given from the perspective of an exporter. The company prepares invoice in customer's currency. Its debtors of US dollar 1 crore is due on April 1, 2015. So here there is a foreign currency risk because all the preconditions are satisfied. Cross-border transaction export billing is done in foreign currency and the receivable is in the future because we are in January and the amount is receivable on 1st April. Okay. Next exchange rates. Spot rate is given. Spot rate 0.0. Spot rate. What happened? So here the quote is given 1 rupee is equal to 0.016667. Okay. So be careful, the quote is given per rupee. Yes or no? And next 1 month forward, 3 months forward, currency future, contract size 1 month, 3 months. Initial margin, interest rates in India, 1 month margin, 3 months margin, 6.5% and 7%. On April 1st, 2015, the spot US dollar slash INR is 0.016136 and the currency future rate is 0.016134. Which of the following methods would be most advantageous of EFT Limited? Using forward contract, using currency future, not hedging the foreign currency risk. Not hedging the foreign currency risk. So simple question. I will make it simple. Currency future question. Currency future. Currency future. Okay. So what is the question here? How many parts are given? How many parts? 3 parts. What is the first part? First part of the question is using the forward contract. Using the forward contract. Okay. So using the forward contract. Once again. Using the forward contract. Simple. First of all, receivable. What is the exposure? Exposure is equal to receivable 1 crore US dollar. Okay. So we are in January and the amount is due on 1st April. So 3 months forward rate is relevant, yes or no? 3 months forward rate. What is the 3 months forward rate? 1 rupee is equal to 0.016129 dollar. Yes or no? So the inflow is equal to, we should multiply or divide. We should multiply the quote or divide. Divide, because we are converting the dollar and the quote is given per rupee. So that's why inflow is equal to 1 crore divided by 0.016129. The answer you're getting is 62 crores 1240 rupees. Am I clear? So this is the first part. Next, the B part. So what is the B part? B part is, okay, so B part using what? Okay, B part. What is the B part? Currency futures. Currency futures. Okay. So B part. This is the crucial part. Currency futures. So clear currency futures. First, in currency futures, two positions, long position and short position. So tell me the 3 months future rate. First, you write the 3 months future rate. This is crucial. What is the 3 months future rate? 1 rupee is equal to 0.016118 dollars. This is the 3 months future rate. That means the future rate is given per rupee. That means we should think from the perspective of a rupee. We should think from the perspective of a rupee what we are going to do with a rupee. Simple. So customer receive dollar. That means what? Sell dollar, buy rupee. So that means the relevant position. What is the relevant position? The relevant position is long position. The relevant position is long position. Clear? Done. What about the next one? Relevant position, long position. So that means as on today we take a long position for rupee, and on the maturity to close the contract we take a short position. This is one kind of a thinking. So what is the another kind of a thinking? I am the exporter. I expect the dollar value to increase and rupee value to decrease. So that is my expectation. But what will be my fear? Because I do hedging if I have a fear. What is my fear? The rupee value may increase in the future. If the rupee value increase in the future, then what, my inflow will get reduced. So that's why I should take a long position for rupee, because my fear is rupee value may increase in the future. Okay. So that's why relevant position is long position for rupee. Now we should find out the number of contracts. Number of contracts is equal to 1 crore 1 crore divided by, I cannot take the contract size directly because exposure is in dollar, contract size is in rupees. So first I should convert this dollars into rupees using the future rate, agreed rate. Then divide with the contract size. What is the contract size? 2 crore 48 lakh 16,975. The answer is how many contracts? 25 contracts. Sir, why are we finding 20 contracts? Number of a contract. Simple. In futures, you know the concept of initial margin. If you want to trade in futures, you have to deposit initial margin. And you know the marking to market account. Profit or loss is calculated on daily basis to avoid the risk of a default, right? So that's why what is the interest on initial margin? We should not take initial margin. We should consider interest on initial margin, because initial margin is a security deposit. It is refundable. But that amount will get locked for how many months? 3 months. So interest on initial margin is equal to 25 contracts into, what is the amount? 22,500 into, what is the rate of interest? 7% into what? 3 by 12. So the amount is 9844 rupees. This is interest on initial margin. You are entering into a contract, futures contract. You have to deposit initial margin. So that means you have to pay interest for next 3 months. Okay. And next what? Next interest on an initial margin 9844. Clear? Next. So I have taken a long position on rupee. I will close the futures contract on maturity. Yes or no? On maturity to close the futures contract, I take a short position. So this part is important. So whether I am going to get a profit or a loss. Simple, I agreed to buy at the rate of 0.016118. What is the future rate on maturity on 1st April? The currency future rate is 0.016134. Special points are highlighted. So that means I am agreeing to buy at 0.016118. So to close the contract, I sell at 0.016134. So rupee value has got appreciated and I will get a profit in futures contract. But I might lose money while selling the dollars. But that will be recovered on closing the futures contract. So profit on closing futures contract. Profit on closing the futures contract. What is the profit on closing the futures contract? How many contracts? 25. Into, see the calculation, try to understand. So to close the contract, I agree to sell it 0.016134 minus originally I agreed to buy at 0.016118. Difference in price is settled. So that difference between 0.016134 minus 0.016118 is the profit per 1 rupee. But I am entering into 25 contracts and each contract size is 2 crore 48 lakh 16,975. So I will get the profit in dollars. That has to be converted into INR. So what is the spot rate on the maturity is 0.016136. So this is the special point in this currency futures question, this calculation. So what is the proper profit, overall profit? 6,15,195. Be careful. So this 9844 is outflow. What is this 9844? Outflow, interest on initial margin. So I got a profit on closing futures contract, that is inflow. And next, so apart from this two, I have a 1 crore dollar. I will sell 1 crore dollar in the market, right? 1 crore into inflow on sale of 1 crore dollar is equal to, what is the calculation? Simple, 1 crore divided by what is the spot rate? 0.016136. Very good, Nana. What is the number? 61 crore 97 lakh 32,976. My overall inflow. The rupee has appreciated. As the rupee has appreciated, this inflow on sale of a 1 crore decreased. So, but I got profit on closing the futures contract. So hedging reduced the uncertainty, reduced the possibility of occurrence of a loss. Clear? For suppose if a rupee has got depreciated, then what? So my inflow might have increased, but I will get loss on futures contract. But ultimately, what the possibility of occurrence of loss is reduced. Clear? So what is the ultimate net? Net 62 crore 3 lakh 37,627. Navina, please tell me the numbers. Allochan, you also please tell me the number. Prabhas, Junior Inter, Pawan Kalyan. Chandrababu Naidu garu, please tell me the answer. Okay, so this is the net inflow. Hi, Rahul Gandhi ji, please tell me the answer. Net inflow 62 crore 3 lakh 37,627. Done. C part. What is the C part? No hedging. C part, no hedging. No hedging means what? Simple. I will get 1 crore divided by Navina ji. 1 crore divided by 0.016136. That is 62 crore. Sorry, 61 crore. 97 lakh 32,276. 976. 270. The above case I wrote 976. 276. Here also it is 61 crore 97 lakh 32,276, right? Navina. Ranbir Kapoor, tell me the final answer. Alia Bhatt, 62 crore 3,37,627. In the denominator, you should divide with 0.016136. Okay. What is the amount you are getting? Are you using 0.016134 or what? 136. You have to use 136. You will get the same amount. 61 crore 97 lakh 32,276. What about this number? This number is correct or not? Correct only, right? 62 crore 3 lakhs 37,627. Done. Okay. Shall we move on to the next concept? Shall we move on to the next concept? Yeah. Next, currency options. Currency options. You know the concept currency option. Currency option is what? Currency option. So call option means what? Call option means right to buy. Put option means what? Right to sell. Put option means what? Right to sell. Call option means, okay, call option means what? Call option means right to buy. Put option means right to sell. See the super 10 question. With this question, I will explain the concept of hedging. How can we do hedging using the currency options? Okay. So XYZ Limited, XYZ Limited, ready కూర్చోండి. XYZ Limited US firm sell. US firm will need 3 lakh pounds in 180 days. In this connection, the following information is given. Spot rate 1 pound is equal to spot rate 1 pound is equal to $2. 180 days forward rate for pound as today is $1.96. Interest rates are as follows: UK US 180 days deposit rate, 180 days borrowing rate 5%, 5.5%. A call option on a pound that expires in 180 days has an exercise price of $1.97 and a premium of $0.04. XYZ Limited has forecasted the spot rates 180 days hence as below. Future rate probability. Which of the following strategies would be most preferable to XYZ Limited? A forward contract, a money market hedge, an option contract, no hedging. Show calculation in each case. Show the calculation in each case. Are you getting my point? Okay. Show the calculation in each case. So let me explain this question. Okay. Currency options. XYZ Limited, a US firm, will need 3 lakh pounds. Yes or no? What is the question? First forward contract, using the forward contract. So question number. Tell me the question number. Super 10. Very good, Nana. Super 10. Madhumita, what is the first part? Forward contract. So receivable or payable? Very good, Amma. Harsha Kumar. Payable. US firm will need 3 lakh pounds in 180 days. 3 lakh pounds in 180 days. So please check the ICA answer also, because sometimes in new edition they will change the answers. Okay, they will rectify the mistakes. Because in this question, this 180 days forward deposit rate and 180 days borrowing rates are taken as per 180 days. That 4.5% rate is generally has to applicable per annum. Okay, but that 4.5 and 5% are taken as 180 days of rate. Okay, in the CA final study material. So forward contract, see the forward contract. This is payable, right? That means outflow. Outflow is equal to 5 lakh into or divided by, tell me. So 180 days forward rate of a pound as on today, $1.96. So I have to convert the pound. I have to convert the pound, and the quote is also given per pound. So that's why simple multiply. Malika, just multiply 5 lakhs into 1.96. Yes or no? So the answer is 5 lakh. No, no, no. Sorry, 3 lakhs. It is 3 lakhs. I'm sorry. Navina, please tell me if I'm writing the wrong number because I cannot see the question. 3 lakhs into 1.96. 5 lakh $88,000. Forward contract. What is the second one? Second, money market hedge. Money market hedge. You know the concept of money market hedge, right? Money market hedge. Step 1. We have a foreign currency payable. Foreign currency payable means deposit present value of a exposure. What is the calculation? 3 lakhs. Where should we deposit this 3 lakhs? In UK. In UK we have to deposit. In UK we have to deposit. What is the deposit rate in UK? 4.5%. So 3 lakhs divided by 1 plus 0.045 into 180 divided by 365. That should be the actual answer in my perception. But what is happening here? Simple. So this 180 days forward rate, 180 days forward rate, that should be 4.5% per annum. What is the meaning of this? If you are borrowing the money for 180 days, the rate applicable per annum is 4.5. That should be the understanding actually. But whereas the answer given in the study material is, okay, simple, they have considered that 4.5% for 180 days only. That means per annum interest rate is 9%. Okay, so that's why these kind of a question you have to refer. Even though you know the concept, you should follow the ICI answer, right? So that's why be careful. So that's why I will check twice the answer which is given in ICI book, because even though you know the concepts, sometimes you have to take an assumption. So what is the present value of exposure? 3 lakhs divided by 1 plus 0.045. 2 lakh 87,000. 81.34 pounds. Is this number correct? Step 2. So to deposit 2,87,081.24 pounds, we need to what? Borrow. Okay. So dollars to be borrowed. How many dollars to be borrowed? 2,87,081.34 into spot rate. What is spot rate? 2. So dollars to be borrowed. 5,74,163 dollar. Yes or no? Step 3. Step 3. Withdraw, deposit, and pay the supplier. Withdraw, deposit, and pay the supplier. How much are we going to pay the supplier? So deposit, I withdraw the deposit. What is the deposit amount? 3 lakh pounds. I withdraw the, sorry, not 3 lakh pounds. The deposit is 2,87,081.34. That will be equal to 3 lakh pounds in next 180 days with interest. I withdraw the deposit and pay the supplier. But I have taken a loan in US, right? So step 4. Outflow on repayment of a loan. I'm sorry for changing the schedule. I'm not following the fixed timetable because the reason is because of admissions for CA Foundation, CMA Foundation, MEC. I have to manage the whole college, BCCA college. So that's why I'm not able to follow the fixed timetable. Outflow on repayment of a loan. What is the outflow on repayment of a loan? What is the loan? 5 lakh 74 163 plus 574 163. What is the interest rate in US borrowing rate? 5.5% into, sorry, 5.5%. That's it. So this point you have to remember, okay? So what is the number? 6 lakh 5,742 dollar. This will be my outflow under money market hedging. So which is better, forward contract or money market hedging? forward is a better option because outflow is less. But we have another two options. What are the another two options? No hedging and option contract. In this question, the special point is option contract. Okay. Now let us come to the option contract. So be careful in futures and option. We should think from the perspective of the quote. First, you have to see the strike price quote, and based on the quote, you have to decide which option is relevant. First, here customer has to buy pound. Customer has to buy pound. So first of all, tell me the strike price actually. First, you write the strike price. In every currency option question, better you write the strike price first. And see the contract size. So you should think from the perspective of a currency, of a contract size. What is the strike price? Strike price. Call option of a pound that expires in 180 days has an exercise price of $1.97. Strike price, exercise price, $1.97. That is nothing but 1 pound is equal to $1.97. Be careful, this is the starting crucial point in currency options. So that means we should think from the perspective of a pound. I'm going to discuss 4 questions relating to currency options. 2 questions, okay, strike price will be of a same currency which we need. And 2 other questions, I need one currency but strike price will be for another currency. Okay. So here I should think from the perspective of a pound. So I have to buy pound. Buy pound means relevant option. Relevant option is equal to, what is the relevant option? Call option. The relevant option is call option. Am I clear? Done. Relevant option is call option. Clear? Are you able to understand now? So call option, exercise price is given $1.97 and premium is also given. What is the premium? $0.04. And the most important point, you should compare this part of the answer with the derivatives question. In derivatives, one question, probability is given, future rates are given, and they asked you to find out the expected value of a call option on a maturity. Okay. So likewise here we should find out the outflow under options contract. So future rates, the expected forecast of the spot rates 180 days hence as below. So there are 3 possibilities. The future rate on the maturity can be $1.91, $1.95 or a $2.05, and the weights are also given. Here, let me take the columns. Future rate. So these concepts I will enjoy while explaining. Complicated but easy to understand. Future rate. Next, probability. Future rate, probability. Next, exercise price. Exercise price. Exercise price. And next what? Action. The relevant rate. Relevant rate. Next, probability into relevant rate. Probability into relevant rate. Tell me what is the future rate? 1.91, 1.95, 2.05. What is the probability? 0.25, 0.6. What is the expected price? I mean exercise price? 1.97. So what is the call option? I have a right to buy 1 pound at the rate of $1.97. I am the importer, I have a payment. My worry is the pound value may increase. So that's why I have purchased the call option. Okay. Tell me the action in first case. What is action in first case? I have a right to buy at the rate of 1.97. But whereas in the market the rate is 1.91. So that means I will allow the option to lapse. What about the second case? Second case also I will allow the option to lapse. But Third case, I will exercise the option to buy 1 pound at $1.97. That means in first case, I will buy 1 pound for $1.91. I will buy the pound in market. I will allow the call option to lapse because in the market the pound rate is cheap. So call option means right to buy, not an obligation. So that's why what I will do is I will buy the pound in the market for $1.191. Second case also, I will buy the pound in market because it is cheap in the market, right? It is cheap in the market. Third case, I will exercise the option and buy the pound for 1.97. So that means 25% chance that I will buy pound for $1.91. 60% chance that I will buy pound for $1.95. 15% chance that I will buy 1 pound for $1.97. Clear? So 0.25 into 1.91. 0.4775. 0.6 into 1.95. 1.17. 0.15 into 1.97. 0.2955. In AFM, mainly students will do a clerical mistake. Be careful. They know the concept. This 1.943 is the expected rate to be applicable for me. Yes or no? For this, I should add call option premium. What is the call option premium? 0.04. For each pound, I am paying a premium of $0.04. So, the rate per pound. What is the rate per pound? 1.983. So that means my outflow will be equal to 3 lakhs into 1.983. 3 lakhs into 1.983. Premium I have to pay as on today, irrespective of okay, the action I take on the maturity. So answer is 5 lakh 94,900 dollars. So here one more point we should consider is add interest on a premium because premium is paid as on today. Premium is paid as on today. We should consider interest on a premium. What is interest on a premium? Because we are finding out the outflow on maturity. Till maturity, I have to pay interest on a premium also. Premium is an expense, it is not refundable. In this question, we have to consider premium also. In currency future, initial margin is a security deposit. That's why we consider only interest on a initial margin. Understand the basic difference. 594,900 into. So premium is paid in dollars. That means what is the rate applicable? The borrowing rate of a dollar. What is the borrowing rate of a dollar? 5.5%. So 6. Sorry, I should consider only on a premium. I'm sorry. 3 lakhs into. I'm sorry, 3 lakhs into 0.04 into 5.5%. I'm sorry. What is the number? $660. So final value 5,95,560. This will be my outflow. Clear? So this interest on a premium is also a special point. 595, 560. Which is the better one? Forward, money market hedging, option contract. For timing, which is the best one? Which is the best one? Forward is the best one. Done. Can anybody please check the answer? Next, D part. Check whether my answer is matching with ICA answer or not. If you have any doubt, you can ask me. No hedging. No hedging means what? The expected spot rate on the maturity will be applicable. Expected spot rate is equal to. See the final number. What is the final number? 5? 595, 560. Expected spot rate. What is the expected spot rate? 1.91 into 0.25. 25% chance that 1 pound value will be equal to 1.91. Next. 1.95 into 0.6. 60% chance that 1 pound value will be 1.95 plus only 15% chance that value of 1 pound will be 2.05. So that means what is the expected spot rate? 1.95? 1.955 dollar. Okay, here no hedging, no option, nothing. In that case, This is the expected spot rate. So that means my outflow will be equal to 3 lakhs into 1.955. 5,86,500. So outflow is less in case of no hedging option. So that's why if this is the scenario, it is better the company should not go for hedging. Am I clear? Are you able to understand this question? Everybody, please let me know. Stalin, are you able to understand this? London. Now come to the previous question. Super 9. So this question is little what clumsy. Lot of information is given you to take the relevant information out of it. Okay. An American firm is under an obligation to pay interest of Canadian dollar 10 lakh 10,000. Is it clear? Please let me know. Online students, I cannot see your face. The only thing I expect from online students is response. Yes, sir. Clear, sir. Thank you, sir. If there is emoji option, please send me the emoji. Thank you. An American firm is under obligation to pay interest of Canadian dollar 10 lakh 10,000. Okay. Now, we see this one. Strike price 1 pound is equal to $1.97. Customer buy pound. Relevant option call option. So where do you want interest on premium or what? Is it clear now? If you want me to explain, I will explain again. The relevant rate, you may get out in the relevant rate. Simple. I have two options. Either I can buy in market or under options, yes or no. First case, in the market I can get pound for 1.91. Under options contract I can buy it for 1.97. I will buy in the market because it is cheap. Second case, it is cheap in market, I will buy in the market for 1.95. But in third case, okay, in market the rate is 2.05. Okay, clear? But whereas I have a right, I paid premium and I have a right to buy at the rate of 1.97. So I can get 1 pound for 1.97. Clear? So the probability of using the option, exercising the option is 0.15. Done. Okay. Let us move on to the next question. Super 9. An American firm is under obligation to pay interest of Canadian dollar 10 lakh 10,000 and Canadian dollar 7 lakh 5,000 on 31st July and 30th September respectively. The firm is risk averse and its policy is to hedge the risk involved in all foreign currency transactions. The finance manager of the firm is thinking of hedging the risk considering two methods, fixed forward or option contracts. It is considering two methods, fixed forward and option contracts. It is now June 30. Following quotations regarding rates of exchange, US dollar per Canadian dollar from the firm's bank were obtained. Spot rate is given, 1 month forward rate is given, 3 months forward rate is given. So here it is little clumsy. Price for a Canadian dollar, price for a Canadian dollar slash US dollar option on a US stock exchange. Cents per Canadian dollar, payable on purchase of option, contract size Canadian dollar 50,000 are as follows. Unless you practice this question at least once, you will not be able to do this question in examination because the sentence itself it is clumsy. Strike price US dollar slash Canadian dollar 0.93, 0.94, 0.95 calls and puts July September. Okay, so what are these values? These values are price of option. They have told price per Canadian dollar on a US stock exchange are as follows. Nothing but these are the call option premiums and put option premiums. These are cents. That means it is actually not 1.56. This is that is 0.0156. According to the suggestion of a finance manager, if options are to be used, 1 month option should be bought at a strike price of 94 cents and 3 months option is 3 months option at a strike price of 95 cents. Nothing but for 1 month, the strike price we are going to consider is 0.94. And for 3 months, the strike price we are going to use is 0.95. These are the premiums for each strike price. If the strike price of a call option is 0.93, then the premium is 1.56. If the strike price is 0.94, the premium is 1.02. If the strike price is 0.95, then the premium is 0.65. So generally in case of a call option, if the strike price increases, premium decreases because nobody wants to buy at a higher rate. Okay. But whereas a put option, if the strike price increases, put option premium increases. Why? Because everybody wants to sell at a higher price. Yes or no? And for the remainder uncovered by the options, the firm would bear the risk itself. For this, it would use the forward rate as the best estimate of a spot. Uncovered means you are not doing hedging. If you are not doing hedging, further we should use the estimated spot rate on a maturity. But estimated spot rate is not given in the question. So that's why they have mentioned use the forward rate as the best estimate of a spot. Nothing but we use the forward rate for uncovered portion. Transaction costs are ignored. Recommend which of the above two methods would be appropriate for the American firm to hedge its foreign exchange risk on the two interest payments. If you are watching a recorded session, better you pause the video and read the question again. Okay? Done. Let me start the question. So there are two payments. One is 10 lakh 10,000 Canadian dollar, which is payable on 31st July. That I am going to solve here. But today my work for you is I am giving a homework. So second payment is Canadian dollar 7 lakh 5,000. That is on 30th September. That you have to do. But first listen. Okay, first you have to listen the 10 lakh 10,000 Canadian dollar answer. Okay. So there are two methods. What are the two methods? Fixed forward or option contract. So right now we are in June 30. Understand? June 30 and the payment is on 31st July. That means 1 month. So if you are using the forward contract, then 1 month forward rate is relevant. And what are the quotes? Quote is given US dollar per Canadian dollar. US dollar per Canadian dollar. That means quote is given per Canadian dollar. And the payment is also in Canadian dollar. So tell me the question number. Super 9. This is the ninth question to be practiced in Forex chapter. You should not practice each and every question. Do apply the same rule for other subjects as well. Okay. So first part. What is the first part? Payable. What is the payable? 10 lakh 10,000 Canadian dollar. So in this, what is the first option? Forward contract. Clear? So under forward contract, outflow or inflow? Outflow because I have a payment. So 10 lakh 10,000 into what is the forward rate? 0.9301. So 9 lakh 30,100 dollar. 1 Canadian dollar is equal to 0.9301 dollar US dollar. So my outflow is equal to 9,30,100 dollar. Okay. Clear? This is a forward contract. What is the second one? Option contract. This is the little complicated. Option contract. See the option contract. Option information starts from here. Tell me. 9? Okay, 10 lakh 10,000. I'm sorry. So this is 10 lakh 10,000, right? I thought it 10 lakhs. I'm sorry. Okay, so the answer is 939,401 dollar. Clear? 1 minute. So next options contract. So option information started from here. Okay, this paragraph is clumsy. Try to understand this. Price for a Canadian dollar / US dollar option. So nothing but price of option is given. Price of option. What are the price of option? Call option price are given for July, September, and put option price is given for July, September. First of all, what is the relevant option? Strike price is given. Strike price is given per Canadian dollar. Strike price is given per Canadian dollar. So that means we should think from the perspective of a Canadian dollar. So tell me, am I going to buy Canadian dollar or sell Canadian dollar? I have a payment or a receivable. Please tell me. I'm waiting for a reply. Okay. So here we are going to make a payment of a Canadian dollar. That means we have to buy Canadian dollar. Strike price is also given per Canadian dollar. That means the relevant option is call option. And the information which is relevant is this information, and this information is not at all required. Clear? Okay. And one more thing, for first part of the question, 1 month option should be bought at a strike price of a 94 cents. 94 cents. So for first part, the September information is also not relevant. Why? Because I'm making a payment on July. But for second part, July information is not relevant. Yes or no? Okay. And 1 month option should be bought for a strike price of 94 cents. 94 cents. That means what is the relevant information? This is the relevant information. Strike price is 0.94 and the call option premium is 0.0102 cents. Nothing but dollars. 0.0102 dollars. Cents per Canadian dollar. Per Canadian dollar. We have to pay premium in dollars. Premium in dollars. So on US stock exchange, that means you have to pay premium in dollars. So next, option contract. First of all, what is the strike price? Strike price 1 pound is equal to 0.94 dollar. Sorry, 1 Canadian dollar. 1 Canadian dollar. I wrote 1 pound. 1 Canadian dollar is equal to 0.94 dollar. What is the call option premium? So before writing call option premium, here customer has to buy Canadian dollar. That means the relevant option is call option. We should not go for sell because the strike price is given per Canadian dollar. Okay, what is the call option premium? Call option premium, we should take it for July. What is the call option premium? 0.0102 dollar per Canadian dollar. Now, let me take number of contracts. My exposure is 10 lakh 10,000 Canadian dollar divided by contract size is also given per Canadian dollar because strike price is per Canadian dollar. 50,000. So I will get 20.2 contracts. I cannot enter into 20.2 contracts, right? I can enter into only 20 contracts. That means uncovered exposure. What is my uncovered exposure? Uncovered exposure is equal to 0.2 into 50,000. Nothing but that extra 10,000 Canadian dollar. That extra 10,000 Canadian dollar. Clear? Done. Okay. So now let us find out the outflow, overall outflow under options contract. So like in previous question, here the expected spot rate on maturity is not given. Okay, but here I do not know exact outflow. Here I cannot find out the exact outflow, but I can find out the maximum outflow. Because maximum I'm going to pay $0.94 per each Canadian dollar. Clear? But if 1 Canadian dollar is 0.9 in the future on the maturity, then I'm going to pay only 0.9. I will not exercise the call option, right? So here in this question, I cannot find out the exact outflow, but I can find out the maximum outflow. Okay, outflow on 20 contracts is equal to, what is outflow on 20 contracts? Outflow on 20 contracts is equal to 20 into 50,000 Canadian dollar into what is the strike price? 0.94. That means $9,40,000 is my outflow. This is the exposure. This is the outflow on only 10 lakh Canadian dollar. Okay, I have a uncovered exposure. 10,000 Canadian dollars. For 10,000 Canadian dollars, I cannot enter into an option contract. So that uncovered exposure, for that uncovered exposure, generally I have to use the expected spot rate on maturity, but it is not available in the question. So that's why I use the forward rate. So outflow on uncovered exposure. Outflow on uncovered exposure. What is the outflow on uncovered exposure? 10,000 Canadian dollar into 0.9301. So that is equal to $9,301. Apart from this, I have a call option premium. This is an expense, non-refundable. What is the call option premium? Total call option premium is equal to 20 contracts into contract size 50,000. Total 10 lakh Canadian dollars. What is the premium for each Canadian dollar? Premium for each Canadian dollar is equal to $0.0102. Nothing but I will get $10,200. Here the interest rate is not given in the question. If interest rate is given in the question, then I have to take interest on premium also, but not given. So that's why I'm finding out the total outflow. What is my total outflow? Total outflow. What is my total outflow? 9,59,501. Clear? Done. Are you able to understand? Please note down the answer. Call option premium. Total outflow 9,59,501. So I hope you understood the solution, and please do for September afterwards. Pause the video and do for September. Okay? Or else afterwards. Simple. So instead of 20 contracts, how many contracts are you going to get? What is exposure? 7 lakh 5,000 divided by 50,000. You will get 14 contracts. So 14 into 50,000 into 0.95. What about the uncovered exposure? Uncovered exposure 5,000. 5,000 into forward rate 0.9356. What about the call option premium? 14 contracts into 50,000 into 0.0164. That's it. Okay. Shall we move on to the next question? Please let me know. So see the next question, Super 11 and Super 12. Let us discuss Super 12 first. Super 12. All these questions are CF and study material question. Super 12. XYZ, an Indian firm, will need to pay Japanese yen 5 lakhs on 30th June. In order to hedge the risk involved in foreign currency transaction, the firm is considering two alternative methods: forward market cover and currency option contract. Again, two: forward market and currency option. On 1st April, following quotations, Japanese yen slash INR are made available. So do understand here the quote is given per INR. What is the payment? Payment is in Japanese yen, but quote is given per INR. That means we should think from the perspective of a INR. So payment is in Japanese yen. That means you should buy Japanese yen. Buy Japanese yen means sell rupee. That means the relevant option is put option. Be careful. The next two questions are different from the previous two questions, exactly opposite. Spot rate is given, 3 months forward rate is given. The prices for currency option on purchase are as follows. Strike price is given. What is the strike price? JPY 2.125. Nothing but 1 rupee is equal to 2.125 JPY. Japanese yen. That means strike price is given per rupee. We should think from the perspective of a rupee. But in this previous question, I have a payment of Canadian dollar. Strike price is given per Canadian dollar. And so in that previous another question, I have a payment of a pound and the strike price is given per pound. Yes or no? So clear. For excess or a balance of JPY uncovered. So for excess or balance of JPY covered, the firm would use forward rate as a future spot rate. But here there will not be any excess or balance. Why? Because contract size is not given in this question. You are required to recommend cheaper hedging alternative for X, Y, Z. Simple question. Super 12. If you understand this question, whether this question will come in examination or not is a different issue. First of all, you will get a confidence. Okay, yes, I understood currency option, a complex concept. I understood it very easily. So it will give a confidence. So that's why you have to learn these concepts. Question number Super 12. That means 12th question to be practiced. Super 12. So what is the exposure? 5 lakhs JP by 5 lakhs JP by Japanese yen. Done. Okay. So payment is on 30th June. We are on 1st April. 1st April. April, May, June. 3 months. So first option forward contract. Here two-way quotes are given. Be careful. Forward contract. Outflow is equal to 5 lakhs. I am converting JPY. But quote is given per rupee. Yes or no? First of all, which quote is relevant? Which quote is relevant? Do not get confused while selecting the quote. JPY. Customer buy JPY. But means bank sell. Okay, bank sell JPY. The relevant rate is ask rate of a JPY. But in the question, ask rate of a JPY is not there. So that's why 1 divided by bid rate of a INR. The rate applicable is 1.9726. That means 5 lakhs into 1 divided by S Navina. For currency future and currency option, we should think from the point of given quotes. From the point of view of a given quotes. So 1 divided by 1.9726. Answer is 253,471.29 rupees. Now the options. Currency option. Now the forward rate, spot rate, this information not relevant. So in options question, first write the strike price. What is strike price? Strike price. 1 rupee is equal to 2.125 JPY. That means strike price is given per rupee. Strike price is given per rupee. That means you should think from the perspective of a rupee. Customer has to pay JPY. That means customer buy rupee. Customer buy rupee. Okay. Customer buy rupee. That means buy JPY. Customer buy JPY. That means sell rupee. So the relevant option is put option. Relevant option is what? Put option. Clear? Are you able to understand this? Relevant option is put option. Clear? Done? Are you able to understand this selection of a option? Done? Now, contract size is given, not given. So that's why outflow under options is equal to, see the calculation. I have to convert JPY. Quote is given per INR. What is the strike price? 2.125. So 5 lakhs divided by 2.125. So the answer is 5 lakhs divided by 2.125. 2,35,294 rupees. Apart from this, we should consider another one. Put option premium. What is the put option premium? Put option premium is equal to 0.098. Put option premium is equal to 0.098 JPY. What is this? Understand carefully. Per 1 rupee, we have to pay premium of 0.098 JPY. How many rupees we are taking the contract? 2,35,294. Be careful. This is different. 235,294 rupees. We are entering into a put option contract for 235,294 rupees. We are entering into a contract to sell rupee for 2.125 JPY into for each rupee we have to pay put option premium of 0.098 JPY. That means the entire amount you will get in JPY. Now I should convert this JPY into INR. I have to pay premium in the spot. I have to pay premium in the spot. So what is the amount I'm getting? 235, 294 into 0.098. 23,059 JPY has to be paid as on today. That means as on today to make a payment, to make a premium payment. I have to buy JPY. Bank has to sell. The relevant rate is ask rate of a JPY, but it is not available. So that's why 1 divided by bid rate of INR. So that's why 1.9516. Are you able to understand this? 1.9516. Answer 11,815 rupees. Clear? For each rupee, I have to pay put option premium of 0.098. So 235, 294 into 0.098. That is the overall premium I have to pay. That is in JPY. That JPY has to be converted into INR. So that's why divided by what? 1.9516. Clear? So overall outflow is equal to 247,109 rupees. In this question, this calculation is a complicated calculation. Too much of concepts involved. Selection of a rate. Selection of a rate for making a premium payment. Finding out the premium. Clear? Even though it is a small question. So answer is simple. It will be asked for 6 marks or 7 marks. Clear? Able to understand this? So there is one more question to be discussed in options. Shall I move on to the next question? Currency option, once again I'm explaining the previous one. Strike price 1 rupee is equal to 2.125 JPY. Quote is given per rupee. So I should think from the perspective of a rupee. Customer has to make a payment of JPY. That means buy JPY, sell rupee. So relevant option is put option. So what is the outflow under options? I have to convert JPY, but the quote is given per rupee, strike price. So that's why 5 lakhs divided by 2.125. So my outflow is 235, 295. Nothing but I enter into a contract to sell. I enter into a contract to sell 235, 294 rupees. Okay, if I sell 235, 294 rupees in the future, I will get 5 lakh JPY. I will make a payment. And this is not an exact outflow, this is a maximum outflow. So put option premium. What is the put option premium per JPY? Per rupee. Per rupee, what is the put option premium? 0.098. For how many rupees I am entering into a contract? 235, 294. So 235, 294 rupees into 0.098 JPY. That means overall numerator will be in a JPY. So I have to make a payment of a premium in JPY, foreign currency. I have to buy foreign currency. That means bank has to sell foreign currency as on today. The relevant rate is ask rate of a foreign currency which is not available. So that's why divided by bid rate of home currency. Clear? Navina, is it clear? Shall I move on to the next question? A Limited of UK has imported some chemical worth of USD 364,897 from one of the US supplier. The amount is payable in 6 months time. The relevant spot and forward rates are, spot rate is given, 6 months forward rate is given. Our payment is in dollar. Our payment is in dollar. Company is in UK. Company is in UK. The quotes are given per dollar, so per pound. I'm sorry, quote is given per pound, but payment is in dollar. Be careful. Payment is in dollar, but whereas quote is given per pound because they have mentioned USD 1.5616. That means 1 pound is equal to how many USD? The borrowing rate in UK and US are 7% and 6% respectively. The deposit rates are 5.5% and 4.5% respectively. Here we should consider these borrowing rates per annum. Even though they have not mentioned it per annum, we have to consider it as per annum. The currency options are available under which one option contract is for GBP 12,500. GBP means Great Britain Pound. Contract size is given in pounds. Payment is in dollar. The option premium for GBP. What is the option premium? 1.7 at a strike price of USD 1.7 per pound is USD 0.037 call option, USD 0.096 put option for 6 months period. Here the strike price is given per pound. Strike price is given per pound. Are you getting my point? Strike price is given per pound, but your payment is in dollar. Navina, tell me which option is relevant in this case. This time payment or receivable? Imported some chemical. Super 11. Exposure. 364. 897. Again, pin is troubling. 364. 897 dollar. Exposure. Payable or? Navina, please think once again. 364. 897 dollar payable. Okay. So do not change your answer. I told you to think again. That's it. You might be correct. Exposure 364 $897 payable. Okay. What is the first one? Forward contract. So shall I write from the beginning what customer has to do? Not required, right? So outflow. So customer has to buy, bank has to sell. That means I want ask rate of a dollar, but ask rate of a dollar is not there. So that's why what is the rate applicable? 1 divided by bid rate of a pound. So that means my outflow is equal to 364 897 divided by 1.5455. Answer is 236103 dollar. Sorry, pounds. हो गया. What is the next one? Money market cover. Money market hedge. It is payable, right? Payable means what? Payable means step 1, deposit present value of a exposure. Deposit present value of a exposure. Where should we deposit? In US. Very good, Navina. So, okay, in US we have to deposit, right? So what is the amount to be deposited? 364 897 divided by, what is the deposit rate in US? 4.5%. So 1 plus 0.045 into 6.12. Be careful. So what is the calculation? What is the number? Deposit rate. Deposit rate in US is 4.5%. Very good. Answer? 356. 8. Very good, Navina. Borrow home currency. 356,867.5. Clear. Step 2. Okay. Pounds to be borrowed. So pounds to be borrowed. To make a deposit. To make a deposit of a dollar, I have to buy the dollar. Bank has to sell the dollar. Bank has to sell dollar. The relevant rate is ask rate of a dollar, which is not available. So that's why divided by bid rate of a pound. Spot 356 860 7.5 divided by 1.5617. Very good. 1.5617. So what is the dollars pounds to be borrowed? Pounds to be borrowed 2 lakh 28 512. Clear? I'm not writing the step 3. You can write step 3. What is the step 3? Withdraw the deposit and pay the supplier. Clear? I'm writing the last step. Outflow on repayment of loan. Outflow on repayment of a loan. So what is the interest rate? What is the borrowing rate in UK? I'm borrowing pounds, right? UK 7%. So calculation 2 lakh 28 512 plus 228 512 into 7% into 6 by 12. Answer is 236,510 pounds. This is the answer. Final answer. Under money market hedging, my outflow is 236,510 pounds. Check the answer whether it is correct or not. Which is the better one, forward contract or a money market hedge? Forward is the better one. So 236,510 pounds. Clear? I'm just writing the answers you are telling. So check with ICA also. I'm here to explain the concept. Okay. Next, what is the last option? Currency options. Yes or no? Currency option. Currency option. See this one, currency option. First, write down the strike price. This is important. Strike price. What is the strike price? 1 pound is equal to $1.7. That means strike price is given per pound. So we should think from the perspective of a pound. We should think from the perspective of a pound. So customer has to pay dollar. Customer has to pay dollar means buy dollar. That means sell pound. The relevant option is put option of a pound. Very good, Navina, because you told in the beginning itself the relevant option is put option. This question may or may not come in examination, but you will gain confidence if you understand these kind of a concepts. Okay, let us find out the number of a contracts. Number of a contracts is equal to 364,897. Be careful, this is in dollars. 364,897 dollar. Contract size is given in pound. Contract size is given in pound. This is a complicated calculation. So 364,897 divided by 1.7. What is this 1.7? Strike price. Why should I divide? Because I'm converting dollar. Quote is given in pounds. So I have to divide 364,897 dollar divided by 1.7. Then I will get exposure in pounds. All divided by 12,500 contract size. 17.7 contracts. Nothing but I can enter into only 17 contracts. That 0.7 will be uncovered. Uncovered exposure is equal to 0.7 into 364,897. Yes or no? Okay. 0.17 or 0.7? 17.7 or 17.17? Okay. 17.17. 17.17. Then you take 0.17. Otherwise, if you want the accurate number, better you can write 364,897 minus how many contracts I can enter? 17 into 12,500 pounds into 1.7. You can take 0.17 into 12,500 into 1.7, or else 364,897 is the total exposure minus what is the exposure covered under options? 17 contracts into 12,500 pounds into 1.7 dollar. Here, what is the uncovered exposure? 3647 dollar. This part is crucial. These calculations are complicated. Be careful. Especially these two lines which are visible on the screen. These two are complicated in this question. Okay. Now let us find out what. Okay, premium. Put option premium, right? What is the put option premium? How many contracts I'm entering? 17 contracts into how many pounds? 12,500 pounds. Per each pound. Per each pound, what is the premium? Put option premium 0.096 dollar. So 17 contracts into 12,500 pounds into 0.096 dollar. The entire amount is coming in dollars. I have to pay premium as on today. I have to buy dollar. Bank has to sell dollar. The relevant rate is ask rate of a dollar, which is not available. So that's why divided by bit rate of a pound. What is the bit rate of a pound as on today? 1.5617. If you understand this question, you will love these concepts. Simple. interest in Forex? Yes or no? So what is the number? Put option premium. 13,063 pounds. Put option premium 13,063. So what about interest? I have to find out interest on premium. In ICA it might be missing, but you have to write interest. What is the answer? 13,063 into. What is the borrowing rate in UK? 7% into 6 by 12. 476 pounds. Clear? What is outflow on options? Outflow under options. Outflow under option contracts. Be careful. Outflow under option contracts. Outflow under option contracts is equal to how many contracts? 17 contracts. For each contract, what is my outflow? 12,500. That's it. This is a simple calculation. 17 contracts into 12,500. I will get in pounds. I have to find out the outflow in pounds, right? 17 into 12,500. That's it. And this is not the exact outflow. This is maximum outflow. 2 lakh 12,500 pounds. There is one more thing here. Outflow on uncovered exposure. What is outflow on uncovered exposure? Outflow on uncovered exposure. I have uncovered exposure also. So I have a $3,647 uncovered exposure. On that, for that I will enter into a forward contract. So 3,647. I have to sell. Sorry, I have to buy dollar. Bank has to sell dollar. So ask rate of a dollar is not there. So that's why bid rate 1.5455. 2359 pounds. Overall, my outflow is equal to. I have a 4 components. I have to pay put option premium. That is a complicated calculation. Interest on a premium, complicated. Outflow under option contract is also complicated. Be careful. So overall, 228, 379 pounds. So what is the interest? I think interest it is 476 or 457. What is the interest amount? 13063 into 457. Shared by interest on a premium is 457. 13063 into 7% into 6 by 12. 457. So 228, 379 is the final answer. So with this we have completed what options concept. Clear? Done? So in Forex, we have completed basics, currency futures, currency options, hedging concepts, and also interest rate parity theory, purchasing power parity theory, and also arbitrage. Yes or no? Now, let us discuss the next concept, fate of a forward contract and the cost of a strike. Fate of a forward contract. So, what is this fate of a forward contract concept? Before moving on to the fate of forward contract, let us discuss one question relating to the cost of a strike. See the Super 13 question. Super 13. On January 28, 2013, an importer customer requested a bank to remit Singapore dollar 25 lakhs under an irrevocable letter of a credit. However, due to unavoidable factors, the bank could effect the remittances only on February 4, 2013. The interbank market rates were as follows. January 28 to 2013, February 4, 2013, US dollar equal to how many rupees? 1 pound is about how many dollars? 1 pound is about how many Singapore dollar? The bank wishes to retain an exchange margin of 0.125%. Required, how much does the company customer stand to gain or a loss due to the delay? Calculate the rates in multiples of 0.0001. Okay. So simple question. So let us start this question. On January 28, 2013, an importer customer requested a bank to remit Singapore dollar 25 lakhs under an irrevocable letter of a credit. Okay. An importer customer requested a bank to remit. That means importer customer has to buy Singapore dollar. Yes or no? That means he agreed to buy. He agreed to buy Singapore dollar. Bank agreed to sell on January 28, 2013. But however, due to unavoidable factor, the bank could effect the remittances only on February 4, 2013. Actually, he asked to deliver Singapore dollar on 28th January, but the bank could remit only on February 4th. Due to that, whether customer stands to gain or a loss due to the delay. Okay. So simple. Importer wanted to buy the Singapore dollar against rupee. Yes or no? Clear? So customer wanted to buy 25 lakh Singapore dollar. That means bank has to sell Singapore dollar. So the applicable rate is ask rate of a Singapore dollar against rupee. Yes or no? That means rupee by Singapore dollar is the applicable rate. Let us find out the rupee by Singapore dollar rate on 28th January. We want an ask rate. We want ask rate. But what are the codes available? The codes given are rupee divided by codes given are rupee divided by dollar, rupee divided by dollar, and next what? Dollar by pound. Next quote is Singapore dollar by pound. So that means what do I want? Rupee by Singapore dollar. So how should I write? First quote I will take as it is. First quote I will take as it is. Why? I want rupee in the numerator. Yes or no? What about the second one? Second one, okay. So I want Singapore dollar in the denominator. Yes or no? And the dollar should get cancelled. Pound should also get cancelled. So first quote I will take as it is because I want rupee in the numerator. So rupee by dollar. But second one I have to change because the dollar should get cancelled. No, no. First, second one also I will take as it is. Second one also I will take as it is because if I take as it is, dollar will get cancelled. What about the last one? The last one I have to change. I'm taking a different color. So the last one I have to change. Why the last one has to be changed? Because I want Singapore dollar in the denominator. Okay. So that means first two as it is, but the last one I have to change. Yes or no? I want the ask rate of a rupee. Ask rate of a dollar. Ask rate of a dollar is right. Available in the question 45.9. Next, the ask rate of a pound 1.7850 into 1 divided by bid rate of the pound. Why? I want ask rate of a pound divided by Singapore dollar, which is not available. So what should I take? 1 divided by bid rate of 1 divided by what? Bid rate of Singapore dollar divided by pound. Okay. So this is the quote. 25.9482 is the rate applicable. So we have a concept of exchange margin. What is this exchange margin? Exchange margin are the charges levied by the bank. Okay. Charges levied by the bank. These exchange margin charges are added to the ask rate, reduced from the bid rate because bank will collect the charges. If it is an ask rate, exchange margin has to be added. So what is exchange margin? 0.125%. So finally the answer is 25.9806. Clear? So this is if you are taking a delivery on 28th January. Okay. Done. 4th February. Can you please check IC answer also? So 4th February. I mean, if there is any change, I will get to know. So that's right. 4th February. So 4th February, again, same. So the rate I'm getting is 26.0394, 0.0325. Overall final rate is 26.0719. That means actually the rate that should be applicable for me, the rate that should be applicable for me is 25.9806 because I asked the bank to give a delivery on I have asked the bank to give a delivery on 28th January, but the bank could remit only on 4th January. So that means instead of 25.9806, customer is paying 26.0719 on 25 lakh Singapore dollar. The amount he is losing is 2,28,250 rupees. Okay. So 228,250 is the amount of a loss to the importer. Clear? Are you able to understand this question? Because if I take delivery on 28th January, the rate applicable is 25.9806. but the bank could remit only on 4th February. Because of that, the rate applicable to me is 26.0719. I'm losing the money. Yes or no? Clear? Done? Next. Let us move on to the next question. Let's see the Super 15 question. Super 15. So what is this Super 15? Fate of a forward contract. From Super 14 up to Super 20. All these are fate of a forward contract questions. Okay. So what is this fate of a forward contract? Generally, what is a forward contract? Forward contract means contract entered today to buy or sell foreign currency at a future date at a pre-agreed rate. At a pre-agreed rate, yes or no? Okay. So for suppose as per the contract, for suppose I have agreed to sell. So as per the contract, if I agree to sell and on the maturity I sold the foreign currency, that means there is no issue. Okay. If I have agreed to buy and as per the agreement I bought the foreign currency, then also what? No issue. But so there can be three scenarios. First, there can be what? Three scenarios. Okay. So what the event may happen before the due date. The event may happen before the due date. Fate of a forward contract. Actually, these can be nine. Fate of a forward contract. First one before due date. Next on due date. After due date. Okay. So before the due date. Before the due date. So before the due date, I may honor the contract. I may honor the contract before the due date. See this. So fate of a forward contract. One is early. Early means before the due date. Second is on the due date. Third one is what? Late. Late means after the due date. Okay. So before the due date, customer may make a delivery. Customer may ask for a delivery or customer may give a delivery before the due date. So then what happens to the original contract? Are you getting my point? For example, contract maturity is 3 months, 3 months forward contract. The actual contract is 3 months forward contract, but before 2 months, customer comes to bank and may ask for delivery. That means this is early delivery. Early delivery means what? Delivery before the due date. Then what happens to the original contract? Original contract will get automatically cancelled. Original contract has to be cancelled, and in that case, what we have to find out the cancellation charges and also what the spot rate applicable for early delivery. Next, customer may come prior to the due date and may ask for cancellation of the contract. Ask for what? Cancellation of a contract. In that case, what we have to find out the cancellation charges. And next, before the due date, customer may come to the bank and may ask for extension of the contract. Extension of the contract means what? After 2 months, customer may come to bank and may ask to extend the contract to another 2 months. But the original due date is 3 months. But after 2 months, he comes to the bank and he may ask for extension of the contract. Instead of taking a delivery at the end of 3 months, he may take delivery at the end of 4 months. So this is early extension. Simple. So early extension, early cancellation, early delivery. Early cancellation means what? Before the due date, customer comes to the bank and cancel the contract. Early cancellation means early delivery means what? Early delivery means what? Before the due date, customer comes and take the delivery or give the delivery. Early cancellation means what? Before the due date, customer comes to the bank and cancel the contract. Early extension means before the due date, customer comes to the bank and asks for extension of the contract. Clear? So If it is cancellation, we have to find out only cancellation charges. But if it is extension, we have to find out the cancellation charges plus new rate. And if it is early delivery, then also we have to find out the cancellation charges plus new rate, not the spot rate, new rate. Clear? Next, on due date. On due date, customer may come to the bank on due date and may ask for delivery. If he comes on maturity and he asks for delivery, then no problem at all. Because as per the contract, he should come on due date and may ask for delivery or give a delivery. So if it is delivery on the due date, no problem. But cancellation, if it is cancellation on the due date, then we have to find out the cancellation charges. Next, that can be an extension of the contract. He may come on the due date and may ask for extension of the contract. Then also we have to put the cancellation charges and new rate. Next, late. Late means what? After due date. After due date, customer may come and ask for delivery. After the due date, customer may come and ask for delivery. But generally, within the 3 days of the maturity date, the contract will get automatically cancelled. For suppose due date, okay, 31st January, but customer came on February 2nd, then what? Bank will collect cancellation charges and what? The new rate will be applicable for the delivery. Okay. The next, okay, after due date, he may ask for cancellation. Even if he is not coming to the bank within 3 days, the contract will get automatically cancelled. Next, what? Extension. After due date, for example, January 31st is the due date, but on February 2nd, he may come and ask for extension of the contract. Then what? We should find out the cancellation charges and the new rate. Okay. Even if you are getting confused here, let me explain with questions. So, three scenarios. Customer may come before the due date, on the due date, or after due date. He may ask three things. He may ask delivery or cancellation or extension. That's it. So total 9 scenarios. If he is coming on the due date and asking for delivery, no problem. Yes or no? Because as per the contract, he should come on the due date and should ask for delivery. If delivery is on the due date, then what? No problem at all. Okay, no issue. Okay. Let us start the question. A customer with whom the bank had entered into 3 months forward purchase contract for Swiss franc 10,000 at the rate of 27.25 comes to the bank after 2 months and requests cancellation of a contract. What is this? This is an early cancellation question. What is this question? This question is an early cancellation question. Early cancellation. How can we identify this is early cancellation? Enters into 3 months forward purchase contract, comes to the bank after 2 months. That means he comes to the bank before the due date and asking for cancellation of contract. On this date, that means on the date of a cancellation, the rates prevailing are spot CHF. CHF means Swiss franc 27.3, 27.35. 1 month forward 27.45, 27.52. What is the loss or a gain to the customer on cancellation? Okay. So simple question. Originally bank had entered into what? So 3 months forward purchase contract for Swiss francs 10,000 at the rate of rupees 27.25. Yes or no? Originally bank agreed to buy. Originally bank agreed to buy means to cancel this contract, bank has to sell. To cancel this contract, bank has to sell. That means applicable rate for cancellation is ask rate of Swiss franc. Are you getting my point? Simple. Originally, first you should identify originally what the bank is going to do. For suppose here in this case, originally the bank wanted to buy. That means to cancel the contract, bank has to sell. Okay. So that means the contract would be cancelled at the for the contract. Bank originally buy. So read the sentence again. Be careful. The bank had entered into 3 months forward purchase contract. Bank entered into forward purchase contract. That means originally bank wanted to buy. Bank wanted to buy. So to cancel the contract, bank has to sell. Okay. What? Here the customer Customer is what? Selling. Bank agreed to buy. Bank agreed to buy originally. So now customer is asking to cancel the contract. That means what? This bank has to sell to cancel the contract. I will come to that point. Okay. Simple logic. Here originally what? Bank wanted to buy. Okay. So now this contract has to be cancelled. So to cancel the contract, the bank has to sell. The relevant rate for cancellation is ask rate. This should be this is the simple thinking. So here there is no confusion. Originally bank wanted to buy, and to cancel the contract, bank has to sell. The relevant rate is ask rate. So ask rate on what? Due date. What is the ask rate on due date? Ask rate on due date is 27.52. Ask rate is 27.52. That means bank sell at 27.52. Okay, bank is buying at 27.25. The difference is the profit to the bank. That means loss to the customer. What is the loss to the customer? 2,700. Are you getting my point? Originally, bank wanted to buy at the rate of 27.25. To cancel this contract, the bank has to sell. The relevant rate is ask rate. So, what is the ask rate? 27.52. Why we should take 27.52 1 month forward? Because we have to cancel the 3 months forward purchase contract. Customer came to bank after 2 months. One more month is still there, right? So that means we cannot take the spot rate after 2 months. We should take 1 month forward. Why 1 month forward? After 2 months means from there 1 month rate is applicable for cancellation. So that's why we should take the ask rate on the due date. What is the ask rate on the due date? 27.52. Clear? Done. So this is a simple thinking. Originally, if a bank agreed to buy, to cancel the contract, bank has to sell. Originally, if the bank has agreed to sell, to cancel the contract, the bank has to buy. Okay. Now let us come to another way of a thinking. What is the other way of thinking? Original. Let us come to the original. What is the original thing? Originally, the bank agreed to buy. That means customer agreed to sell. Yes or no? Customer agreed to sell. Now, to cancel, bank has to sell. So the relevant rate is what? Ask rate. Okay. So now, so we have seen the cover concept. What is this cover concept? Originally, bank agreed to buy. Originally, bank agreed to buy means bank agreed to buy Swiss franc from the customer after 3 months. So obviously, what the bank will do? Bank will cover this transaction. Cover means what? So nothing but here bank is agreeing to buy. That means the bank will agree to sell on the other side with some person. So with other bank, with some other bank, with some other bank, originally the bank will agree to what? Sell. Are you getting my point? To cover the transaction, the bank will agree to sell because it is buying from the customer. So to cover the transaction, it will sell the CHF. Yes or no? Now on the due date, what happens? That other bank will ask me to sell. The other bank will ask me to sell, yes or no? But I do not have a CHF because my customer gave me a hand, yes or no? But I have to deliver the CHF to other bank. So what? So I have to buy to honor the contract, to honor the cover transaction. I have to buy. I have to buy means other bank has to sell. So that means if a customer is giving hand, I have to buy CHF from other bank. That means other bank has to sell, and the relevant rate is ask rate. Nothing but if a customer is giving hand, I have to buy the CHF at the rate of 27.52. Clear? So instead of paying 27.25, I have to pay 27.5 to the other bank. So that's why I will collect this loss from the customer. Okay, clear? So this is a complicated thinking. So instead of going for this complicated thinking, the basic fundamental thinking is originally the bank wanted to buy. So to cancel the contract, the bank agrees to sell. Okay, so bank sell at 27.52, buy at 27.25. So the overall loss is 2,700. Done. Is it clear? Okay, clear. Navina, is it clear? So what is the other way of thinking? Bank agreed to buy. So to cover the transaction, what the bank will do? Bank agrees to sell, but customer gave me a hand. So what should I do? I should buy from some other bank. Okay. So that other bank will quote me an ask rate. Quote me an ask rate. What is the ask rate on due date? 27.52. So that's why what? Okay, I will collect that loss from the customer. Done. Navina. Navina, I will explain again. So let us assume, why to get confused? See again. But suppose you are the customer, you have agreed to sell CHF and I have agreed to buy CHF at the rate of 27.25. This is the original contract. Okay, you agreed to sell after 3 months, I have agreed to buy after 3 months. But suppose if after 3 months, if you come to the bank and if you sell CHF and if I buy CHF, then no issue. But you came after 2 months and asking for cancellation of a contract. That means you're not willing to give a delivery of a CHF on the due date. Okay. But so when we entered into a contract, what I will do is I'm the dealer, right? I'm the dealer. After 3 months, I have agreed to buy CHF. With CHF, what I'm going to do? I cannot keep CHF with me, yes or no? So I will cover the transaction again immediately. We have seen the dealer problems, right? So to cover the transaction, on the date of entering into a forward contract, on the same day, what I will do is to cover the transaction, I will agree to sell CHF. I will agree to sell CHF, yes or no? Okay. But what happened? After 2 months, you came to the bank. You came to the bank. To cover the transaction, I have agreed to sell CHF with Charan. Okay. I have agreed to sell CHF, okay, to Charan after 3 months. But after 2 months, you came to the bank and you wanted to cancel the contract. That means I will not get deliveries of CHF from you, right? But I have already committed to sell CHF to Charan. Now, what should I do? Okay, to honor this contract, I should buy. Okay, you clearly told after 2 months I will not give delivery. That means what is the option I have? I'm the dealer, Ravi. So what I will do is, so I have to buy CHF from other dealer, Okay. So let us assume the other dealer is Kavi. So other dealer Kavi has to what? Sell CHF. That means the relevant rate is, so the rate which is going to applicable for me is ask rate. In this question, what is ask rate? That means, for suppose if you are going to give a delivery for me, the amount I'm going to spend is 27.25. But now you gave hand, so that's why I should buy CHF from Kavi and that is from other dealer. What is the ask rate? 27.52. So because of you, instead of spending 27.25, I'm spending 27.52. So that means so the loss is equal to 10,000 into 27.52 minus 27.25. So 2,700 rupees charges will be collected from customer Navina. Clear? Are you getting my point? Are you able to understand this? Done. So instead of complicating the things, the simple way of deciding the cancellation rate is, originally bank wanted to buy. So to cancel the contract, bank has to sell. The relevant rate is ask rate. So bank is selling at 27.52, buying at 27.27, and the loss is, I mean, profit to the bank is 2,700. The loss is 2,700 to the customer. Okay. This is just for thinking, but actual reality is different. The actual reality is complex. But to solve the question in examination, simple. Originally, bank wanted to buy. Customer, I mean, to cancel the contract, bank has to sell. The relevant rate for cancellation is ask rate. Clear? So bank is selling at 27.52, buying at 27.25. So that is lost to the customer, 2,700. Clear? Let us see the next question. A bank enters into a forward purchase, TT covering an export bill. Export bill. Export bill means customer sell foreign currency, bank buy. Okay, originally bank wanted to buy. That means if a bank has to cancel, it has to sell. The relevant rate is ask rate. So TT covering an export bill for Swiss franc 1 lakh at rupees 32.4 due 25th April. When it is due 25th April and covered itself for same delivery in the local interbank market at 32.42. That is what I told. Originally bank wanted to buy, immediately it covered at the rate of 32.42. So that means immediately bank booked the profit. Sure, no. It agreed to buy 32 point, it agreed to buy at the rate 32.4, agreed to sell at 32.42. However, on 25th March, exporter sought for cancellation of the contract as the tenor of the bill is changed. So the tenor of the bill is changed. So that's why he is asking you to cancel the contract. This is early cancellation. In Singapore market, Swiss francs were quoted against dollars are as under. Spot 1 USD is equal to Swiss franc rate is given, and 1 month forward, 2 months forward, 3 months forward rate is given. And in the interbank market, US dollars were quoted as under. US dollar is quoted as under. USD 1 rupee is equal to USD 1 is equal to rupees. April, May, and June. Calculate the cancellation charges payable by the customer if a exchange margin required by the bank is 0.1% on buying and selling. Okay. First of all, first the prawn, first the contract will be cancelled at selling rate. Why the selling rate? Originally bank wanted to buy. To cancel the contract, bank has to sell. The relevant rate is selling rate. Yes or no? Okay. So here the answer is little complicated. I will tell you the answer. First, originally what? Super. Original contract bank buy. To cancel, bank sell. The relevant rate for cancellation. What is the relevant rate for cancellation? Ask rate of rupee by CHF, Swiss franc. Because originally bank agreed to buy 1 CHF at the rate of 32.4 rupees. That means we need a quote of ask rate of a rupee by CHF. So customer came to bank on 25th March. I saw on 25th March, due on 25th April. That means the ask rate of a we need ask rate of a rupee by CHF on due date. Yes or no? So due date is 25th April, but he is asking you to cancel the contract on 25th March. That means the relevant rates are 1 month forward. Clear? Relevant rates are 1 month forward. Okay. So here swap points are given. Swap points are given. So what are the quotes given? Rupee by dollar. The quote is not directly given. Rupee by dollar is given. What is the rupee by dollar? First of all, I want rupee by CHF. Rupee by CHF is equal to the quotes given are rupee by dollar into what is another quote? CHF by dollar is given, but I cannot write CHF by dollar. I should write what? Dollar by CHF. Clear? That is equal to. I want ask rate. I want ask rate. What is the ask rate of a rupee by dollar? Ask rate of a rupee by dollar 49.4455 plus swap points are given. Swap points are in ascending order. Swap points are in ascending order. So that's why I want ask rate of rupee by dollar. Ask rate of rupee by dollar is equal to 49.4455 plus 0.4200. That is equal to 49.865 rupees. Clear? I want a ask rate of dollar by CHF, but not available readily. So that's a 1 divided by bid rate of CHF by dollar. Yes or no? So 1 divided by bit rate of a CHF by dollar. What is the 1 divided by 1 divided by 1.515? Clear? 1 divided by 1.515. Okay. Clear? Done. Now we have a exchange margin also. Exchange margin in ICAA book. Exchange margin. Exchange margin is added to the ask rate. What is exchange margin? Exchange margin is equal to 0.1%. So here the exchange margin is added to the ask rate. Only the ask rate of a rupee by dollar. Exchange margin is added only to the ask rate of a rupee by dollar in ICAA book. I'm telling you the ICAA book answer. Okay. So add 0.1% exchange margin. Then what is the quote? 40, 49 point, 49 point, 49.865 plus 865. What is the number? 49.8655. 49.8655 plus 0.1%. 41.915. This is the special point in this question. Okay. Exchange margin is added only to the ask rate of a rupee by dollar. But actually, we would have to find, we are going to add the exchange margin after the getting rupee by CHF. Okay. But here the exchange margin is added only for what? Ask rate of rupee by dollar. So what is the answer? 49.9154 into 1 by 1.515. This is the relevant rate for cancellation. 49 point, not 49 point, 49.9154 divided by 1.515. 40, 32.9474 or 75. Clear? So that means the loss is equal to loss to customer or cancellation charges is equal to how many Swiss francs? 1 lakh into bank is selling at 49 point, sorry, 32 point. 32 point. Bank is selling at 32 point, 32.9475. To cancel the contract, bank has to sell. To cancel the contract, bank has to sell. Bank is selling at 32.9475 minus. Originally, bank agreed to buy at the rate of. The loss is 54,700 or 750. 54,750 rupees. Clear? So this is similar to the previous question, but the special point is exchange margin and the cross rate. We have to find out the cross rate. Clear? Done, Navina. See the next question. Super 17th question. On 15th January 2015, you as a banker booked a forward contract for US dollar 2,50,000 for your import customer. Deliverable on 15th March 2015 at rupees 65.345. So here on 15th January, you as a banker booked a forward contract US dollar 2,50,000 for your import customer. Import customer means customer will buy dollar, bank sell. So originally bank is selling the dollar. at the rate 65.345. On the due date, request you to cancel the contract. So previous two questions are early cancellation. So this question is cancellation on the due date. So, okay, this is cancellation on the due date. On this date, quotations from US dollar in the interbank market is as follows. Spot rate is given, April and May rate are given. So April and May rate are irrelevant. Why? Because the contract is due on 15th March 2015 and customer is requesting the bank to cancel the contract on the due date. So that's why relevant rate for cancellation is the spot rate on the due date. Assuming that the flat charges for the cancellation is rupees 100 and exchange margin is 0.1%, then determine the cancellation charges payable by the bank, by the customer. So simple question. Okay, originally bank what? Originally bank is selling dollar. So that means to cancel bank buy dollar. The relevant rate is bit rate. The relevant rate is what? Bit rate. Clear? Okay. What is the bit rate? 65.29. So exchange margin should be reduced from the bit rate. What is the exchange margin percentage? 0.11%. Zero 0.1%. So that means 0.0653. The cancellation rate is 65.2247, rounded off to 65.225. So dollar sold to customer at 65.345. So dollar bought from the customer at the rate of 65.225. So net amount payable by the customer per US dollar is 0.1200. Clear? Done. So flat charges 100 plus cancellation charges 2,50,000 into 0.12, 30,000, overall 30,100. Clear? Simple question. Okay. Now let us move on to the next question. So we discussed early cancellation and cancellation on a due date. Next, suppose you as a customer, you as a banker entered into a forward purchase contract. Forward purchase contract, that means the bank is purchasing originally for US dollar 50,000 on 5th March with an export customer for 3 months at the rate of 59.6. Export customer means customer will sell and bank has to buy. So that's why they have entered into a bank has entered into a forward purchase contract. On the same day, you also covered yourself in the market at rupees 60.6025. However, on 5th May, so the contract is entered on 5th March for 3 months. 5th March for 3 months means 5th April, 5th May, 5th June. But however, on 5th May, that means before the due date, your customers come to you and request extension of the contract to 5th July. This is early extension. Early extension. He is asking for extension of a contract before the due date. On this date, 5th May, quotation for US dollar in the market is as follows. Spot rate 5th June, 5th July. Assume a margin of 0.1% on buying and selling. Determine the extension charges payable by the customer and the new rate quoted to the customer. New rate quoted to the customer. Rates to be rounded off to 4 decimals in multiples of 0.0025. Navina, I'm audible. Now, simple question. First of all, let us find out the new rate. So he's coming on 5th May and asking you to extend the contract up to 5th July. Yes or no? That means for new contract, actually he wanted to sell the dollar on 5th July. So forget about the cancellation. First, let us see the new contract. So new contract is on 5th July. New contract is on 5th July. Yes or no? So on 5th July, what are the rates? 59.63, 59.6425. Yes or no? So exporter, that means customer is going to sell dollar. Bank is going to buy the dollar. The relevant rate is bid rate. Bid rate. So exchange margin is added to the bid rate or reduced from the bid rate? Reduced from the bid rate. So that means what is the new contract rate? New contract rate is equal to 59.63 minus 0.1%. 59.63 minus 0.1%. Okay. So 0.0596. Nothing but you will get 59.5704 rounded off to multiple of 0.0025. So this is the new contract rate. Cancellation charges. Let us find out the cancellation charges. Simple cancellation charges. So originally bank agreed to buy. Originally, what bank agreed to buy? Originally, bank agreed to buy. What is the rate? 59.60. Originally, bank agreed to buy at the rate of 59.60. Okay. That means to cancel the contract, bank has to sell. So the relevant rate is ask rate on due date. We should cancel the contract which is due on a due date. Yes or no? So what is the ask rate on the due date? 5th June is the due date, right? So 59.2425. So 59.2425 is the cancelling rate. Yes or no? Ask rate. So ask rate means exchange margin should be added. What is exchange margin? 0.0592. Net amount payable by the customer per US dollar 59.3075 rounded off to the multiple of 0.0025. So 3017 means the closest multiple of 0.0025 is 3025. Clear? So bank selling at 59.3025, bank buying at 59.60. Clear? So if you see this difference, bank is buying at 59.60, bank is selling at 59.3025. So what is the difference rate? What is the difference? 0.2975. So 0.2975 into how many dollars? 50,000. So that means 14,875. Actually, this time these are the amount payable to the customer. This is the amount payable to the customer. Why? Bank is selling at a lower rate and buying at a higher rate. Be careful. So bank is selling at 59.3025, buying at 59.60. So that means these are the charges payable to the customer actually, but in reality, bank will not pay the charges to customer. Cancellation charges. Okay, clear? So what is this question? This question is early extension. Done. Next, Super 19. An importer requests his bank to extend the forward contract for US dollar 20,000, which is due for maturity on 30th October 2010 for a further period of 3 months. He agrees to pay the required margin money for such extension of a contract. Contracted rate US dollar 42.32. The US dollar quoted on 30/10/2010. This is extension on the due date. This question is extension on the due date. The US dollar quoted on 30/10/2010 spot rate 41.5, 41.52. 3 months premium is given. Margin money for buying and selling rate is 0.0075%, 0.20 respectively. Compute the cost of the importer, cost to the importer in respect of the expansion of the forward contract and the rate of a new forward contract. Simple question. Okay, simple. Originally, what bank? Importer customer. Importer customer means importer buy dollar, bank sell dollar. Originally, bank sell. That means to cancel, bank should buy. The relevant rate is bid rate. First, we should cancel the existing contract. To extend the contract, first we should cancel the existing contract. So bank should buy. So what is the bid rate? 41.5. Okay, from bid rate we should reduce the exchange margin 0.075 percentage. Clear? Okay, 41.47. So that means bank is buying at 41.47, selling at 42.32. The difference amount is the cancellation charges payable by the importer. Clear? So the answer is 17,000. What is the calculation? 20,000 into 42.32 minus 41.47. Answer is 17,000. Next, the rate of a new forward contract. The rate of a new forward contract. He wanted to extend it for next 3 months, another 3 months. So after 3 months, importer has to buy. That means bank has to sell. The relevant rate is ask rate. So from here, he wanted to buy after 3 months. So what is the ask rate? 41.52 plus premium is given 0.393 percentage. So 41.9061 plus exchange margin. Exchange margin is added to the ask rate 0.0838. So 41.99 is the rate of a new forward contract. We should see quote from banker point of view. Yes. In new contract rate also, the banker is a banker only, dealer only, dealer only. Okay. Once again, I will explain you. See the question. Super 19. First, let us see the original. What is the original? Here, importer, right? Importer means question number Super 19. Importer. Understand. Originally, what importer? Buy dollar. Bank sell dollar. This is original. At the rate of what rupees? 32. So now the two cancel. Contract. Bank has to buy dollar. So the relevant rate for cancellation is what? Bid rate of dollar on due date. Okay, Naveen, is it clear? Okay, done. So that means what is the bid rate of a dollar on due date? 41.5. But bank bid rate means buying rate. Bank will reduce the exchange margin and the remaining amount will be paid to the customer, right? So minus exchange margin at the rate of 0.75. 0.075. Okay. So the answer is, what is the exchange margin? 41 point. Exchange margin 0.0311. 41.46. So that means what is the loss? How many dollars? $20,000 into bank is selling at 42.32 minus buying at 41.46. 17,200 rupees. Now for the new rate. New rate means completely new. Simple new rate. Importer. Customer buy dollar. Bank sell dollar. The relevant rate. Ask rate of dollar after 3 months because they are asking you to extend the contract. So what is the rate? New rate 41.5 2 plus premium 0.93% percentage. Premium is given in percentage plus exchange margin 0.2%. In calculator, first you should take 41.52, then add 0.93%, then add 0.2%. What is the rate? 41.99% rupees. Clear? Done? Okay. See the next question. Next question. Super 14. So in this question, as per ICA study material, there is one complicated point, but the actual answer is different. Okay. On 1st October 2015, Mr. X, an exporter, entered into a forward contract with a BNP bank to sell US dollar 1 lakh on 31st December 2015 at rupees 65.40 dollar. Now, however, due to the request of the importer, Mr. X received amount on 28th November 2015. Mr. X requested the bank to take delivery of the remittances on 30th November 2015, that is before the due date. The interbanking rates on 28th November 2015 was as follows. Spot rate 65.22, 65.27. 1 month premium 10 and 15. If a bank agrees to take a early delivery, then what will be the net inflow to Mr. X, assuming that the prevailing prime lending rate is 18%. First, I will write my answer. So that will be simple. And thereafter, I will explain the ICAI study material answer. Okay. So first on 1st October 2015, Mr. X, an exporter, enters into a forward contract. Exporter. Mr. X, an exporter. That means originally customer sold, bank bought. $1 at the rate of 65.40. However, due to the request of the importer, again, what is this importer word? So, however, due to the request of the importer, Mr. X received amount on 28th November 2015. Importer requested to take money, okay, on 28th November. That's what importer requested exporter to take the money on 28th November. So, that's why Mr. X requested the bank to take the delivery of the remittances on 30th November 2015. This is early delivery question. Early delivery. Simple question. Let me write the answer. Super 14. Super 14. So original contract. What is the original contract? Bank buy. Exporter. Customer is an exporter. So customer sell, bank buy. Dollar at the rate of rupees 65.404. Okay. Now to cancel the contract, bank has to bank has to sell. Yes or no? Customer is giving early delivery. Bank agreed to take an early delivery. Yes or no? Bank has to sell. So relevant rate for cancellation. The relevant rate for cancellation is ask rate of dollar on due date. What is the ask rate of a dollar on due date? 65.27 plus 0.15. That is equal to 65.42 rupees. So now the cancellation charges is equal to what is the exposure? 1 lakh into bank agrees to sell at 65.42. Originally agreed to buy at 65.40. You will get 2000 rupees cancellation charges. Okay. But the question is, what will be the net inflow? What will be the net inflow? Clear? So contract is cancelled. The existing contract is cancelled. Now, what about the delivery? Delivery is made on 28th November. Delivery is made on 28th November. That means customer sell dollar, bank buy dollar. The relevant rate bit rate of a dollar. Relevant rate bit rate of a dollar. Clear? So that means inflow is equal to what is the bit rate of a dollar on 28th November? 65.22 into 1 lakh. 65 lakh 22,000 rupees. But they are asking net inflow. Net inflow is equal to 65 lakh 22,000 minus 2,000. You will get 65 lakh 20,000. This is our answer. But I say answer is differing because of interest on outlay of funds, which is not at all logical. But we have to write the ICA answer. So let me explain the ICA answer. Okay. First, Bank will buy from customer at the agreed rate of 65.4. Okay. In addition to the same, if a bank will charge or pay swap difference and interest on a outlay of a funds. So what is this? Let us understand this concept. Okay. First swap difference. I say answer. Super 14. ICAI may change the answer after 1 year or 2 years, but meanwhile, this is the answer you have to write. Okay. First swap difference. Swap difference. So what is the swap difference? So customer is selling dollar on 28th November. That means bank has to buy. Okay, bank is buying. And immediately what bank will sell to other banker and other banker will be buying it. The relevant rate is bid rate. Nothing but this bank again sells at the rate of 65.22. Bank sells at spot rate on 28th November 2015 at 65.22. Clear? So initially, originally what bank agreed to? Originally bank agreed to buy from the customer on 31st December. But now the customer gave hand. That means what? Already bank might have covered the transaction elsewhere. So to meet the existing obligation, if a customer is giving hand, so bank cannot buy the dollar from the customer. So that's why bank has to buy the dollar from okay other bank. Yes or no? So that means other bank has to sell. So nothing but this bank will buy at the rate of 65.4 to 65.27 plus 0.15. So what is the swap difference? Bank is selling at 65.22. So buying at 65.42. That means 0.2. So swap loss is equal to 1 lakh into 0.2. This is 20,000. Let me explain the swap loss again. So here customer unexpectedly came to bank on 28th November and asking you to take the delivery. Yes or no? Asking you to take the delivery. Okay, bank takes delivery dollar. What the next step? Bank has to sell somewhere. Bank has to sell this dollar to some other dealer. The other dealer has to buy. So the relevant rate is bid rate. Nothing but this bank will take the early delivery from the customer and it will sell in the spot at the rate of 65.22. So immediately bank cannot find the customer. Bank has to sell this to other dealer. The relevant rate is bid rate. Okay. What about the next one? Already the existing due date is 31st December. So bank originally agreed to buy dollar from the customer. Okay. So originally bank might have covered this transaction. Yes or no? To honor that cover transaction, if a customer is giving hand, the bank has to buy the dollar from other dealer. So obviously the other dealer will sell and the relevant rate is ask rate. Nothing but bank will buy at the rate of 65.42. So because of this swapping, what is the loss? 1 lakh into 0.2. Clear? 1 lakh into 0.2. Am I clear? Okay. I think here, what is the answer? Okay. Next. Clear? So next, let me explain the next part. What is the next part? Interest on outlay of a funds. Interest on outlay. So here this is little confusing. Interest on outlay of funds. So here the bank is purchasing bank agrees to buy dollar on 28th November at the rate what? 65.22. Already bank what agreed to buy on the due date, bank agreed to buy dollar at the rate 65.4. 65.4. Now the interest, this is illogical actually, but I am trying to justify. Interest on outflow of funds is equal to how many dollars? 1 lakh into, so bank immediate outflow. What is the immediate outflow of a bank? 65.22. Yes or no? Sorry, immediate inflow 65.22. What is the outflow? 65.44. Okay. So bank sells dollar on 28th November at 65.22. Okay. Bank agrees to buy dollar at the rate of 65.4. So that means what is the outlay of funds? 0.18, because on selling a dollar, bank will receive 65.22. Already the bank agreed to buy dollar at 65.4. The outflow is 65.4 and inflow is just 65.22. So the outlay of fund is 0.18 into, what is the rate of interest? 18% or 15? 18% into how many days? 31 days. So 31 divided by 365. How much? 275. Clear? Clear? Okay. Now, what is the next part? Next part, charges for early delivery. What are the charges for early delivery? Charges for early delivery is equal to, what are the charges for early delivery? 20,000 plus 275, 20,275. So what is the net inflow to the customer? Originally customer agreed to sell at 65.4 minus 20,275. You will get 65 lakh 19,725. Once again I will explain you. See the explanation from the beginning. So first here the customer gave hand. Okay. He came before the due date and asking you to take the early delivery. So okay, bank will take early delivery and will sell at 65.22. Okay, clear? Done. What about 31st December? Originally 31st December bank agreed to buy from the customer, but customer gave hand. That means bank has to buy from the other dealer. The other dealer has to sell. That means the relevant rate is ask rate. So because of this swap, the bank is getting a loss of 0.2 rupees per dollar, and the overall swap loss is 1 lakh into 0.2, 20,000 rupees. Clear? This is the swap loss. What is the swap? Okay, originally we agreed to buy from the customer on the due date, but customer is not selling. I cannot buy from the customer, so that's why I have to buy from someone else at the rate 65.42. And today customer is giving the dollar, so I have to sell it on the spot. So I have to sell means other bank has to buy bid rate. So that means nothing but this bank will sell at the rate of 65.22 up to other bank. And original contract is bank agreed to buy from the customer at 65.4, but customer is not ready to sell. So that's why what this bank has to buy from the other bank at the rate 65.42. Swap loss 20,000. Clear? Now, interest on outlay of funds. What is this interest on outlay of funds? Customer on 28th November came to bank and asking for what? You agreed to buy at 65.4. Please give me 65.4. Okay. Bank agreed to buy at 65.4. So that's the bank is paying 65.4 for suppose, let us assume. Okay. Now the bank is selling the dollar at 65.22 immediately. So what is the net outflow for the bank? Net outflow for the bank is 65.22 minus 65.44. That is 0.18 per dollar is the outflow for the bank. Why it is outflow for the bank? Simple, bank is selling $1 at 65.22. Okay, and buying $1 from the customer at 65.4. So that's why net outlay is equal to 0.18 into 1 lakh into 18% into how many days we have to pay interest? 31 days. So 31 divided by 365, 275. Actually, this 275 is not at all correct. If you see our answer and this answer, the only difference is 275 rupees. Okay. So charges for early delivery is swap loss 20,000 plus interest 275, 20,275. What is the net inflow? Customer will receive 1 lakh into bank is paying 65.4 as per agreement. 1 lakh into 6.65.4 minus 20,275. So 65 lakh 19,725. So here one illogical point is interest on a outlay of a funds. Our answer is 65 lakh 20,000 and here answer is 65 lakh 19,725. Done. Okay. Clear. See the next question. Super 20. So this is one of the toughest question in the entire AFM. Super 20. An importer booked the forward contract with his bank on 10th April for USD 2 lakhs. Due on 10th June 64.4. Importer booked the forward contract with his bank on. Importer has An importer booked the forward contract with his bank on 10th April for USD 2 lakhs, due on a 10th June at the rate 64.4. That means initial importer agreed to buy, bank agreed to sell. The bank covered its position in the market at rupees 64.28. That is obvious. So bank covered its position in the market at rupees 64.28 means what? Nothing but bank agreed to sell for 64 point. Sorry, bank agreed to buy because initially bank agreed to sell. To cover the transaction, bank agreed to buy. So that means the profit is booked. So bank agreed to sell at 64.4 to the customer. Initially it covered the transaction. So it agreed to buy at the rate of 64.28. The exchange rates for dollar in the interbank market on 10th June and 30th June were 10th June and 13th June. Rates are given. Spot 1 USD, spot June, July, August, September. Exchange margin. What is the exchange margin? Exchange margin is equal to 0.1%. Interest on outlay of funds 12%. Importer requested on 13th June for extension of a contract with due date on 10th June. So that means extension after the due date. What is the due date? 10th August is the due date. But he came to the bank on 13th June, lazy fellow, and asked for extension of a contract. He asked for extension of a contract. So rates to be rounded off to 4 decimals in multiples of 0.0025. On 10th June, bank swaps by selling spot and buy 1 month forward. Calculate cancellation rate. Amount payable on 2 lakh dollar. Swap loss. Interest on outlay of funds, if any. Interest on outlay of funds, if any. New contract rate. Again, this question is a complicated part, especially third part and fourth part. So what is the first part? Cancellation rate. What is the first part? Cancellation rate. Okay. Now, super 20th question to be practiced. Super 20A. What is the A part? So, original contract. What is the original contract? Original contract. Bank sell at the rate 64.4. Bank sell dollar at the rate 64.4. Now to cancel, bank buy dollar. Okay, so the relevant rate. What is the relevant rate? Bid rate. Generally bid rate on due date. But this fellow came after the due date. Lazy fellow, right? So that's why the relevant rate is bid rate on 15th, 13th. So what is the bid rate on 13th June? Bid rate on 13th June is 63.68. So that means $1 is equal to 63.68 minus exchange margin at the rate 0.1%. That means point what is the exchange margin? 0.06368. So what is the value? 63 point 63 point exchange margin add or minus? Minus 63.68 minus 0.06368. So 63.61 6163 rounded off to the near one. So $1 is equal to 63.6175 rounded off to multiple of 0.0025. Clear? So this is the cancellation rate. This is simple. No confusion. Originally bank agreed to sell. To cancel, bank has to buy. So relevant rate is bid rate on 13th June. So actually we should take the bid rate on the due date. But he came after the due date. We cannot go back and apply the rate which is on 10th June. Yes or no? Okay. Second part. Amount payable on 2 lakh dollar. Amount payable on $2 lakh. What is amount payable on $2 lakh? B part. Amount payable on $2 lakh. 2 lakhs into. So bank originally agreed to sell at the rate of 64.4 minus to cancel the contract. Bank is purchasing at 63.6175. 156,500 rupees. Clear? This is the amount payable on nothing but cancellation charges. These are what? Cancellation charges. These two points already we discussed. Okay. Now C part. What is the C part? Swap loss. What is the swap loss? On 10th June, customer has to come to bank. Yes or no? Customer has to take the delivery. But customer has not came to the bank. So that's why bank sells spot on 10th June. Bank sells a spot on 10th May. So other bank has to buy. I cannot find the customer immediately. So nothing but bank will sell dollar, okay, on the spot. The other bank has to buy. That means what is the rate applicable? 10th June. Bid rate. What is the bid rate? 63.8. So bank sells at the rate 63.8. Clear? Bank sells at 63.8. Yes or no? And next, okay. Now the next point is bank swaps by selling spot. Immediately bank sold to the dealer because customer is not there. I have to sell the dollar to someone else because I might have already covered the transaction. I have already covered the transaction. Yes or no? At the rate 64.28. Cover the transaction means what? Original contract is agreed to sell to the customer. To cover the transaction, I have agreed to buy at the rate of 64.28. That person will give delivery to me. What should I do? I should sell the dollar because my customer is there. He's not there. So that's why what? So immediately I have to sell. The other bank has to buy. The relevant rate is 63.8. So bank sells at the rate of 63.8. Okay. At the same time, what the bank has done is bank entered into 1 month forward buying. Why, sir? Bank entered into buy contract 1 month forward because bank is expecting that the customer will come within a month and ask for a dollar. So that's why what the bank has done is bank agreed to buy dollar from another dealer so that after a month this customer will come to the bank. This bank can give a delivery. Okay. So bank swaps by selling spot what at the rate 63.8 and buying 1 month forward. This bank is buying means other bank has to sell. So that means June ending. What is the rate? 63.95. Okay, bank buys at 63.95. We should take June end rate. Bank buys at 63.95. So that means swap loss. What is the swap loss? 0.15. Overall loss. Are you getting my point? Why bank is entering into 1 month forward buy contract? Because it is expecting that the customer will come and ask for dollar. So that's why bank is buying it. Swap loss is equal to 0.15 into overall $2 lakh. That means 30,000. Okay, clear. Now D part. What is D part? Interest on outlay of funds. What is this interest on outlay of funds? Simple. Customer has not come to the bank. So that's why bank is selling at 63.8. Bank is selling at 63.8. Yes or no? And on the same day, 10th June, already the bank has covered the transaction at the rate 64.28. Nothing but bank agreed to buy at the rate 64.28. Yes or no? That person will deliver the dollar at 64.28. Yes or no? So my outlay of funds, I receive 63.8 on sale of a dollar, and I pay 64.28 per dollar on 10th June. Yes or no? See the first sentence. I have covered the transaction. Covered the transaction means I have already agreed to buy $1 at the rate of 64.28 to honor my original contract. My customer has not come, but I have to buy the dollar at 64.28. My outflow is equal to 64.28. I am selling $1 at the rate of 63.8. What is the swap? I mean, in outlay, net outlay 0.48. So interest is equal to 2 lakhs into 0.48. I will collect interest. Overall, I am collecting cancellation charges, swap loss on 13th June. So meanwhile, what my outflow, net outflow is 2 lakhs into 0.48. So that's why for the next, for the next 3 days, I am going to collect interest. What is the interest rate? 12% into 3 divided by 365. What are the cancellation charges? 2 lakhs into 0.48 into 12% for 3 days. 96 rupees. 360 days. Okay. Okay, fine. What is the next part of the question? New contract rate. New contract rate is what he is coming on 13th June. This is simple. He is coming on 13th June and asking you to extend the contract up to 10th August. That means on 10th August, he is asking you to sell dollar. You are selling dollar. The relevant rate is you are selling, bank is selling. Customer is buying, bank is selling. The relevant rate is ask rate. So that means 64.25 plus margin. So 64.3150 is the answer. Clear? And next, total cost. How do we get total cost? Cancellation charges, swap loss, interest, overall loss is 1,86,596. Done. Clear. Simple. Okay. So special points are third part and fourth part. So without wasting time, let us move on to the next one. Currency swap question. This question was tested recently. Drill Tip INC, a US based company, has won a contract in India for drilling oil field. Swap means exchange. Swap means what? Exchange. So this is a currency swap question. The project will require an initial investment of rupees 500 crores. The oil field along with equipment will be sold to Indian government for rupees 740 crores in 1 year time. US company has won a contract for drilling oil field in India. The project will require an initial investment of rupees 500 crores. The oil field along with equipment will be sold to Indian government for rupees 740 crores in 1 year. Okay. The company is based in US. That's why they have a foreign currency risk because billing is in rupees. Since the Indian government will pay for the amount in Indian rupees, the company is worried about exposure. due to exchange rate volatility. You are required to construct a swap that will help the drill tip to reduce the exchange rate risk. Assuming that there is only one part in the question. Assuming that Indian government offers a swap at a spot rate which is $1 50 in 1 year, then should the company should offer the option or should it just do nothing? The spot rate after 1 year is expected to be $1 rupees 45.54. Further, you may also assume that the drill tip can also take a US dollar loan at 8% per annum. We have to construct a swap. Okay, assuming that Indian government offers an exchange at a spot rate which is $1 is equal to 50. Nothing but what is this Indian government offers a swap means? First, suppose if you are giving $1 as on today, the government will pay rupees 50. Indian government will give you rupees 50. And after 1 year, the government, okay, will be taking the same. If you want dollars, what company will do is, what government will do is, government will give $1 for rupees 50. Give me rupees 50. Give me 50 rupees back and take dollar. Exchange, simple. What is a swap? Swap means exchange. Indian government agreed, offers a swap. What is a swap? Simple. Okay, give me 50 rupees as on today. Okay, sorry, give me dollar as on today. Take 50 rupees and use this money for what? Drilling the oil field. Use this money for investment. So after 1 year, give me 50 rupees and take your dollar. So the bank, the Indian government has agreed to swap. That means what? Today, how much amount you want? You want 500 crores. Today you want 500 crores. That means give me 10 crore dollar. Give me 10 crore dollar and I will give you 500 crore rupees. And after 1 year, give me rupees 500 crores back and take your 10 crore dollar. Clear? So what is expected spot rate after 1 year? Rupees 54. You may assume that drill tip can take a US dollar loan at 8% per annum. Simple. Swap swap a US dollar loan today at an agreed rate with any party to obtain Indian rupee to make an initial investment. After 1 year, swap back Indian rupees with US dollar at the agreed rate. In such case, the company is exposed only on the profit. Yes or no? No benefit for government. So benefit for government is we can attract the investor. Simple, Navina. What we are doing is that foreign company require rupees 500 crores for investment. Yes or no? They are worried about the foreign exchange exposure. So what I am doing is, okay, bring your dollar. What is the present dollar rate? 50 rupees. Okay. That means bring 10 crore dollar as on today. Take 500 crore rupees and do your business. After 1 year, okay, you are worried about dollar exchange rate, right? Okay, fine. Give me rupees 500 crores back and take your 10 crore dollar. That's it. Okay, simple. So with the swap year 0, what is outflow? 10 crore dollar. Yes or no? Year 0, what is outflow? 10 crore dollar. And at the end of year 1, 10 crore dollar inflow again. Why? Because I will give back 500 crore rupees to the government and take back what? 10 crore dollar. So initially 10 crores outflow as on today and again inflow at the end of a first year. Are you able to understand this, Navina? What about the excess amount 240 crores? Indian government will not. Okay. So exchange means what? Same amount. Exchange means what? Same amount. Clear? So the excess amount, what is 240 crores? What is the rate applicable? 54. So 240 divided by 54. You will get $4.44. Nothing but 44.44 million. What is the interest rate? 8%. So we borrowed 100 million from US bank. 100 million into 8%, 8 million. Overall, 136.44 million is the inflow and net receipt is equal to 36.44 US dollar. This is with the swap. For suppose if there is no swap, then what? 740 crores divided by 54. 740 crores divided by 54. So 137.04. I have to pay interest because I'm taking loan in US. 8 million. Yes or no? Then what is my net inflow after 1 year? 129.04. As on today, outflow 100 million. So overall 29.04 million. Clear? Are you getting my point? Done. Since the net receipt is higher in swap option, the company should opt for the same. Clear? Nothing but initially my investment is 10 crore dollar. Okay. After 1 year, I have to pay 8 crore dollar. So not 8 crore, 0.8 crore dollar interest. So what is the amount I'm going to receive in the future? In the future, I'm going to receive amount 740 crores divided by 54. If there is no swap. If there is a swap, then what? I'm going to receive 240 divided by 54 plus 10 crore dollar under the swap. Clear? Next, let us move on to the next question. Simple question. Nostro. This was also tested in the recent examination. Suppose you are a dealer of ABC Bank. You are the dealer of ABC Bank. And on 2010-2014, you found that balance in your Nostro account. Balance in your Nostro account. So what is this Nostro account? Nostro account is an account maintained by an Indian bank with a foreign bank in foreign currency. Example, State Bank of India is having a account with Citibank. Okay. So to save dollars, I mean to deposit dollars and withdraw dollars. Okay. So maintained by an Indian bank with a foreign bank in foreign currency. This is called as Nostro account. So for SBI, it is a Nostro account. For SBI, it is a Nostro account. What about Ostro account? Ostro account is an account maintained by foreign bank. Sorry. Maintained by foreign bank with an Indian bank in Indian currency. For example, if Citibank is maintaining rupee account with State Bank of India, it is called as Ostro account. So Ostro account for what? SBI. And it is a Nostro account for what? Citibank. Nothing but if it is a Nostro account to me, that will be a Ostro account to the other party. Nostro account is an account maintained by an Indian bank, SBI, with a Citibank in foreign currency. Host account means what? Foreign bank maintains account with Indian bank in Indian currency. So lower account is not that required. So nothing but Nostro account means our account with you. Nostro means what? Our account, Indian bank. Our account with you. Host account means your account with us. Foreign bank is having an account with us. Lower account means their account with you. Their account with you. Their account with you means what? Chinese bank is having an account with US bank. Okay, maintained by first case Nostro account maintained by Indian bank. Host account maintained by foreign bank. Lower account maintained by foreign bank. Host account held with foreign bank. Host account held with Indian bank. Lower account is maintained with another foreign bank. Are you getting my point? So Chinese bank is maintaining account with US bank. So Chinese bank, it is a foreign bank, and US bank is also foreign bank for us. Currency. First case Nostro account. We are maintaining account with US bank, foreign currency. Host account, Indian currency. And lower account, foreign currency. So purpose, international payments, Nostro account. Host account, collections and payments. The next word, lower account means interbank transactions. Come to the question, next question. So Nostro account in London is 65,000 pounds. What is the balance? 65,000 pounds. And you had a overbought position, 35,000 pounds. So in Nostro account, there will be two positions. One is cash position, second one is exchange position. Cash position means it like cash basis. Exchange position means what? Accrual basis. Exchange position means what? Accrual basis. During the day, following transactions have taken place. Particulars amount. DD purchased. DD means demand draft purchased. Purchase a bill on London. Sold forward TT. Forward purchase contract cancelled. Remitted by TT. Draft on a London cancelled. What steps you take if you are required to maintain a credit balance of 75,000 pounds or 7,500 pounds in the Nostro account and keep overbought position of 7,500 pounds. First, during the day, the following transactions have taken place. This is a special question. First, you should understand what is the cash position and what is the overbought position. Cash position means all the cash transaction is going to affect the cash position. Example, foreign currency is sold in the spot. Your cash position will get reduced. Foreign currency is purchased. Your currency will, your balance will increase. But you have entered into a forward contract to sell a foreign currency. You have entered into a forward contract to sell a foreign currency. Then your cash position is not going to affected. Why? Because we agreed to sell in the future, but your exchange position will get affected. Exchange position. This exchange position is similar to accrual basis. So immediately after entering into a contract, your exchange position will get affected. Okay. For suppose bank agreed to sell foreign currency under 3 months forward contract. Agreed to sell. Exchange position will get affected. But whereas cash position will get affected after 3 months. But after 3 months, exchange position will not get affected. Clear? So now the DD purchased. DD purchased. First of all, see the exchange position. What is exchange position? Overbought. Overbought means we should take purchase. See the columns for exchange position. Particulars, purchase, sale. Already there is a overbought position. Opening overbought position. Opening overbought balance 35,000. What is the next sentence? DD purchased. DD purchase means demand draft purchased. Demand draft purchased. Demand draft. That means cash position is not going to get affected. DD purchased means demand draft purchased means your exchange position will get affected, but cash position will not get affected. For example, if you're taking a demand draft for registration of a CA final, if you take a demand draft, what happens? Okay. So for example, bank, okay, it has drawn a DD. Bank, it has drawn a DD. Now tell me, will the bank pay the cash immediately to the ICAI? No, ICAI will make a payment to, sorry, bank will make a payment to ICAI. Okay. After this DD is presented in the bank, first student will take a DD. Student will post this DD to the ICAI, and then ICAI has to encash the DD. Then the cash position of the bank will get affected, but the exchange position will get immediately what affected. So DD purchased, DD demand draft purchased. Demand draft purchased means what happens? Purchase. It is a purchase, right? So purchase will increase. Next, purchase a bill on London. Bills of exchange is purchased. So 40,000. Again, the balance will increase. Bill is purchased. Bill is purchased. Again, the cash position will get affected on maturity. Bill is purchased. That means exchange position will get affected. You know the concept of bill discounting. Yes or no? So if a bank is discounting the bill, bank will pay the money. So okay, purchased a bill on London rupees 40,000. It is purchased. Purchased bill means what? So is the cash position is getting affected or not? Cash position is not getting affected. 40,000. Only exchange position will get affected. When we purchase the bill, the cash position will not get affected. But when we do a discount, when we discount the bill, then only the cash position will get affected. Next, sold forward TT. Sold forward TT. TT means telegraphic transfer. Sold forward. That means sold pounds under forward contract. Again, sold forward means exchange position will get affected, but cash position will not get affected. So that's why I'm writing 30,000 in exchange position. Next, forward purchase contract. Forward purchase contract cancelled. So when forward purchase contract is entered, I will write in purchase. Now the forward purchase contract is cancelled. That means I have to write it in sales. Yes or no? Again, the cash position is not going to get affected. But see the next one, remitted by TT. Remitted by TT means what? Remitted by telegraphic transfer. 37,500 pounds are transferred. Transferred means what? Sold. So what happens? Exchange position will get affected. Cash position will also get affected. Clear? So that's why sold. We are writing in sale, exchange position, and also what? Cash position. Nostro account. Nothing but your balance will reduce from 65,000 to 27,500. Your balance will reduce from 65,000 to 27,500. Only one transaction is going to affect a cash position. What about the draft on London cancelled? Draft cancelled, DD cancelled. So the customer has okay drawn a DD. Customer has drawn a DD. Okay, now it has been cancelled. DD purchased means it is recorded in purchase, yes or no? Now the DD cancelled. DD cancelled means sorry, DD cancelled. DD cancelled means what? So draft on London cancelled. Example, if you want to pay university fee, if you want to pay university fee in dollars, what you will do is you pay Indian rupees and you will draw the demand draft in dollars. Nothing but bank is selling dollar to the student. Okay, dollar to the student. Demand draft is given. So this affects exchange position. Why? Because only draft is drawn. Now the student has to submit this demand draft to the university, and the university will encash the demand draft. Then the cash position of the bank will decrease. So the cash position of the bank will decrease. But what happened is demand draft is not encashed. The draft is cancelled. So when the demand draft is drawn, I might have recorded in sale because I sold foreign currency to my student. As for my customer is a student, I have sold foreign currency to my customer, that is student. Now that person has cancelled the demand draft. That means again I'm purchasing the foreign currency. So there is no actual outflow or actual inflow. So when the demand draft is drawn, that has been recorded in sale. Okay, now it has been cancelled. So that's why it is recorded in purchase. Clear? Done. DD purchased means what? You are drawing a demand draft with other bank. DD purchased. DD purchased. Clear? So that's why draft on London cancel 15,000. So this is a special kind of a question. So overall, your purchase is 1,02,500, sale is 82,500, and what is the overbought position? 20,000. Overbought position 20,000, and 27,500 is the what? Closing cash position. But the question is to maintain a cash balance of 7,500. So they are asking you to what? You are required to maintain credit balance of 7,500 pounds in Nostro account and keep overbought position of 7,500 pounds. Okay. So what is the balance now? 27,500. But I want my balance to be only 7,500. Sell 20,000 pounds in the spot. Sell 20,000 pounds in the spot. So that will bring your balance to 7,500, and also your exchange position will become nil. Your exchange position will become nil. Yes or no? Okay, but you have to maintain the overbought position of 7,500. So buy 7,500 in the forward market so that your position will increase to 7,500. Clear? Are you getting my point? Done? Clear? See the next question. Next question. The last question in Forex chapter after long okay gap, we are able to complete Forex. Messrs Omega Electronics Limited exports air conditioners to Germany by importing all the components from Singapore. Very good. We are importing components from Singapore and exporting air conditioners to Germany. The company is exporting 2,400 units at a price of euro 500 per unit. The cost of imported components dollar 80 per unit. The fixed cost and other variable costs per unit are rupees 1,000 and 1,500 respectively. Navina, are you okay? The cash flows in foreign currencies are due in 6 months. Current exchange rate rupee by euro, rupee by dollar, rupee by Singapore dollar. After 6 months, the exchange rate turns out as follows: rupee by euro, rupee by dollar. You are required to calculate the loss or a gain due to transaction exposure. Based on the following additional information, calculate the loss or a gain due to transaction exposure and operating exposure. Operating exposure. This is a special kind of a question. There is a chance to ask if the contractor price of air conditioner is rupees 25,000, the current exchange rate changes to 51.75 slash 80, 27.1 slash 15. Price elasticity of a demand is estimated to be 1.5. This is the special point. Payment and receipts are settled. Payments and receipts are to be settled at the end of 6 months. Okay. First of all, see this transaction risk. What is this transaction risk? It measures the effect of an exchange rate on outstanding obligation that existed before exchange rates changed, but were settled after the exchange rate changes. So transaction risk means the risk we are already discussing. So we started, I told you the example already. It deals with cash inflows that resulting from existing contractual obligation. But suppose if an Indian customer has a receivable of $1 lakh due in 6 months, okay, if the dollar depreciates relative to the rupee, then what? Cash loss occurs. If the dollar appreciates relative to the rupee, a cash gain occurs. Nothing but this is an uncertainty arising in cash inflows or cash outflows due to the foreign exchange rate fluctuations with respect to the existing contractual obligations. This is called as a transaction exposure. Translation risk means what? Also known as accounting exposure. It refers to gain or loss caused by the translation of foreign currency assets and liabilities into the currency of the parent company for consolidation purpose. For example, you have purchased a plant and machinery, you have commenced a manufacturing project in South Africa. Now, what happens due to foreign exchange rate fluctuations? Every time you consolidate the financial statements, so there is a translation risk, yes or no? You have to translate the assets and liabilities in foreign currency to the home currency. So that risk is called as translation risk. Okay. So next, economic risk. Economic risk means this exposure directly impacts the value of a firm. It can have a bearing on assets as well as operating cash flows. It refers to the extent to which the economic value of the company can decline due to the changes in exchange rate. Okay, so let me explain the economic risk or operating exposure with the question. So first one, they are asking you to find out the loss or a gain due to transaction exposure. So how many units are we exporting? 2400 units. Yes or no? What is the selling price? 500 euros. What is the present euro rate? Current exchange rate, euro rate, 51.5. For suppose, so what is the current exchange rate? 51.5. But here the cash flows in foreign currencies are due in 6 months. If I convert these foreign currencies into home currency immediately, then what is the profit I'm going to get? 500 into 51.5 minus, I'm importing the component from Singapore. What is the cost of imported component? 80 rupees. So 80 into 80 or 800? 80, yeah? So 500 euros into 51.5. 80 or 80, 800, I think. I think it is 800. Super, super 23. So first part. For suppose, what is the profit at current exchange rates? What is the sales? Sales is equal to 2400 into 50, sorry, 500 into 51.50. 6 crore 18 lakh minus variable cost. In that first variable cost is cost of imported component. 800 into what is the Singapore dollar rate? First, which rate has to be applied? Bit rate or ask rate? Be careful. Euro. Euro, I'm selling. Customer exporting to Germany. So euro receivable, I sell euro, bank has to buy euro. Relevant rate is bit rate. But whereas I'm importing the component from the Singapore, that means I have to buy Singapore dollar, bank has to sell. The relevant rate is ask rate, 27.25 into 2400. 5 crore 23 lakh 20,000 minus what? Minus the fixed cost. What is the fixed cost per unit? 1000. Other variable cost, 1500 into 2400. 60 lakhs minus fixed cost. What is the fixed cost? 2400 into 1500. So 1000. So fixed cost is 1000, variable cost 1500. So 2400 into 1500. 36 lakhs. Huh? Okay. $24 lakhs. So what is the profit? 34 lakh. 34 lakh 80,000. Clear? Okay. Transaction exposure is what? So the loss arising due to the foreign exchange rate fluctuations with respect to the current obligation. So what are the exchange rates after 6 months? 52, 27.75. So after 6 months, after 6 months. So after 6 months, what? I'm writing the answer directly. 2400 into 500 into 52. Okay, minus. Okay, how many Singapore dollar? 800 Singapore dollars into 27.75 plus what is the variable cost? 1500. Clear? So now I will get contribution minus fixed cost. What is the fixed cost? 2400 into 1000. Clear? Number of units into what is the selling price? 500 into 52 minus what is the variable cost? 800 into 27.75 plus 1500. 30, 1,20,000. So the loss due to transaction exposure. If I receive the amount immediately, I'm going to get 34 lakh 80. But due to exchange rate fluctuations, I'm getting a loss. So to reduce this transaction exposure only, we used hedging techniques. Clear? Now come to the second part. What is the second part? Based on the following addition information, calculate the gain or a loss due to the transaction and operating exposure. This time they are asking you to find out the transaction and operating exposure. If the contracted price of air conditioner is rupees 225,000, the current exchange rate changes to and the price elasticity of a demand is given. Again, they are asking you to find out what the loss due to the transaction exposure. Simple. How can I find out the loss due to the transaction exposure? This time the exchange rates is changing. The current exchange rate, new current exchange rates are given. Okay. B part. B part transaction exposure. So profit after the current exchange rate changes. Profit after current exchange rate changes. So see the calculation. 2400 into what is the selling price? 500 euros. So I can sell 1 euro at 51.75. Yes or no? 51.75. Okay, 1 minute. I'm sorry. Here the selling price is given in rupees. So 25,000. I will take only 25,000 straight away because this time the selling price is quoted in Indian rupees. 25,000 minus what is Singapore dollar? 800 into, okay, 800 into 27.15 because the exchange rate is changing. 27.15 minus, sorry, plus variable cost 1500 minus what? 2400 into fixed cost 1000. Clear? This time the selling price is given in Indian rupees in second part. So 2400 into selling price 25,000 minus variable cost 800 into 27.15 plus 1500. Then you will get contribution minus fixed cost. So the answer is 18 lakh 72,000. 18 lakh what? 72,000. Clear? Okay. Now let us find out the profit after 6 months. Profit after 6 months. What is the profit after 6 months? Calculation 2400 into 25,000 minus Singapore dollar 800 into after 6 months I can sell 1 Singapore dollar at 27 point, sorry, I have to buy 1 Singapore dollar at 27.75 plus variable cost 1500 minus 2400 into 1000 fixed cost. So the answer is 7,20,000. So this time the profit loss due to transaction exposure is 18,72,000 minus 7,20,000. So answer is 11 lakh 52,000 rupees. What is the difference in second part? In difference in second part is selling price is given in Indian rupees, and what different current exchange rates are given. Different current exchange rates are given. Now come to the operating exposure. Next concept, operating exposure. Price elasticity of a demand is, what is the price elasticity of demand? 1.5. I hope you know the concept of elasticity. Elasticity. So elastic, inelastic. So elastic means what? The demand will get affected by the price. So the demand will increase with the decrease in price. Demand will increase with the decrease in price. Inelastic means what? Whether you increase the price or decrease the price, the demand is not going to change. Here the price elasticity of a demand is given. What is that? 1.5. What is the meaning of this 1.5? If the price increases by 1%, demand decreases by 1.5%. Or if a price decreases by 1%, demand increases by 1.5. Clear? So now see the question here. What is the current price of each unit in euro? Second part, 25,000 rupees. Yes or no? 25,000 rupees is the selling price in INR. In INR. Let us find out the current price of each unit in euro. So 25,000 divided by 51.5. That is the present exchange rate. So for 485.44. So after the change in exchange rate. After the change in exchange rate. So after the change in exchange rate. So what is the selling price? Selling price will be for 483.09. Nothing but the selling price is decreasing. After the change in exchange rate, what is happening? The selling price is decreasing. Ultimately, my point is my price is 25,000 rupees. I'm in India, my price is 25,000 rupees. I'm going to sell my AC for 25,000 rupees. But suppose if the exchange rate in Germany is rupees 51.5, then my selling price in euros will be 485.544. Clear? But whereas if the exchange rate increases to 51.75, then my price after change in exchange rate is 483.09. You have to practice these questions. If you see this, I'm taking a bit rate for finding out the price in euro. Why bit rate? Because I sell euro, bank buy euro, relevant rate is bit rate. What is happening here? So due to the change in exchange rate, the price is changing. Nothing but price is decreasing. So price is decreasing by what percentage? Price is decreasing by 485.44 minus 483.09 divided by 485.44. Yes or no? Nothing but 0.48%. So okay, here your operating cash flows are also getting affected. So what happens here? Your price decreases by 0.48. Your price decreases by 0.48 means your demand will increase by the demand will increase by 0.48 into 1.5, 0.72%. So due to the change in exchange rate, what is happening? It is affecting our operating business. So that's why it is called as operating exposure. The size of increased order. Our order increases by 2,400 into 0.72%, nothing but 17 units. Nothing but your demand will increase to 2417 units. Clear? Clear? So here two answers are given. We should follow the alternative. 2417 units. Clear? Because fixed cost will not change. Fixed cost will not change. So 2417 units. So 2417 into 25,000 minus 800 into 27.75 plus 1500 minus fixed cost will remain same 24 lakhs. That's why from the first part onwards, I'm writing the fixed cost separately because fixed cost does not changes with change in number of units. What is the profit? 7,42,100. So due to the change in exchange rate, what is happening? The price in euro is decreasing. So the demand is increasing. So as the demand is increased, what happened? The profit we got is 7,42,100. So what was the original profit before the change in exchange rate? Without change in exchange rate, the profit was 18,72,000. 18,72,000 is the profit. Okay, so before the change in, okay, clear. So at current exchange rate, so that's why what is the decrease in profit? 11,29,900. So this is the decrease in profit due to the operating exposure. Okay, due to the operating exposure. Actually, I'm not convinced with this answer, but you have to follow this answer only. Okay, done. So with this, we have completed the Forex chapter. I do request you to practice each and every super question. Without practicing, you will not be able to do in examination. If the time permits, go for additional questions. Otherwise, what focus only on the main questions. Only on main questions. So we have completed how many topics? Advanced capital bursting, portfolio, derivatives, mutual fund, and Forex. So big topics are completed. All the lengthy topics are completed. So business valuations, mergers equation, security valuation, these topics are with CA interlevel basics. You can understand these topics. I will be again taking class from next Monday, that is April 20. So please do not wait for me if you have a, I mean, because those topics are what are small topics and CA interlevel topics. If you can manage, you can manage. Please try to manage your own, okay, on your own. Otherwise, what, wait till April 20. Okay. So after April 20, I will discuss what business valuation, mergers and acquisition, security valuation, and other minor topics if possible, if time permits. Clear? And I will try to support till the completion of AFM examination. On day before examination also, I will try to support. But do not depend on me. I will try to support. Clear? Thank you all. Thank you so much.